some sanity that seems to be prevailing right now. Iran did on Tuesday fire more than 180 ballistic missiles at Israel, and that will continue to support the prices. But the markets also do understand that even as there are hostilities that seem to be spreading further east, the crude oil production or facilities as of now have not been hit. And what the street is working with is the U.S. Crude inventory surging, U.S. gasoline demand at the lowest in 6 months, the Chinese demand yet to come strongly back, and then OPEC also is looking at a very strong spare capacity. The markets are looking at Russia also lowering its price band, and the next OPEC meeting, of course, is on the 1st of December. So until then, we do not know if there's going to be a change in stance. But this is all about enough and more supplies and not enough demand coming into the market. And while there is premium from geopolitics, but not enough to keep the prices surging towards 80 yet.
Indeed, and there is this still demand-supply imbalance that still remains. Manisha, thanks a lot for that. The market reaction, though, on Wall Street was not very significant because of this, because the major indices ended just above the flat line. Even on Tuesday's session, there was a fall, but we saw a recovery there from the lows as well. The S&P 500, all of them ending on the flat line. And CNBC's Bertha Coombs gets us a wrap of all the action on Wall Street.
U.S. markets were little change across the major indexes Wednesday as escalating tensions in the Middle East put the brakes on a market rally. The Dow was up 40 points, the S&P was up just under 1 point, and the tech-heavy NASDAQ was up 15. New data shows that private payroll numbers actually beat Wall Street expectations in September. Companies in the private sector added 143,000 jobs last month, a big increase from August, according to payroll processing firm ADP. Job gains were widespread, with the leisure and hospitality industry the biggest gainer, adding 34,000 positions. Construction and education added 26,000 and 24,000 jobs, respectively. Meanwhile, the rate of pay actually took a step down, dropping 4.7%. The Labor Department's monthly jobs report is due out on Friday. A federal appeals court today cleared the way for betting on the 2024 U.S. congressional elections by denying an emergency stay of a lower court's order. The court rejected an effort by the Federal Commodity Futures Trading Commission to block the commodities exchange Kalshi from offering essentially yes-no wagers on the outcome of elections. The CFTC had argued that the betting could cast doubt on the integrity of elections, but the court said that the agency had failed to demonstrate that the public would be irreparably harmed by allowing such bets. That's what's happening here in the U.S. Back over to you in Mumbai.
Well, let us also now listen in to what Scott Cronert, the U.S. equity strategist at Citi, had to say about the current U.S. market fundamentals and the U.S. Federal Reserve's rate cut path going ahead.
We still think we're in this less restrictive mode. We're not to the point yet where we can say, hey, look, at the Fed is at this point being accommodative. So what we're looking to do is balance here in terms of growth as defensive as a play into the end of the year. We want to marry it with some cyclicals, and that we've been ongoing overweight financials via the banks, and now we're adding energy to that. So essentially, what we're doing here is avoiding the more defensive parts of the market. When I look at the rate environment, I think the Fed's on a path where they can continue to ease, and I think that's net constructive versus the past 2-year narrative.
And let us now take a short break. Up next, we will tell you how will all of these overnight cues impact our own markets with our Power Prep segment. Stay tuned, back on the other side.
How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into the
Back with us here on Power Breakfast, and we now have our research team joining in with how the trade setup looks like, the stocks that are likely to be in the news, as well as the setup on the F&O side. Well, we are back after a midweek holiday, and there were plenty of developments that took place over Tuesday evening and through the course of the day on Wednesday. And for our own markets, the biggest development that came in was that much awaited SEBI circular from the F&O space. And then it led, on the global front, we saw the tensions between Iran and Israel escalate as well. And as a result, the rebound that was seen in oil prices, which we just spoke about earlier in the show. And there was no significant reaction to this in the US markets, as we just saw. But on Wednesday, Chris Wood of Jefferies reduced his weightage on India by 1 percentage point and called global uncertainty, these geopolitical risks, as the biggest risk for the global equity markets, although Chris Wood still remains overweight on the Indian markets. Now, what happened on Tuesday? It was a pretty listless session for our own markets, looking at heading into a midweek holiday. Both the Nifty and the Nifty Bank ended at the flat line, and if you can see their intraday charts, both of them look very similar. Opened higher, could not sustain at the highs, and then continued to trade around the flat line in some very choppy moves, as it was also the weekly expiry of the Nifty Bank, both the Nifty and the Nifty Bank ending at the flat line. October in general has been a good month for the Nifty. 4 out of the last 5 years, barring that last year, has been positive for our own markets, but we have plenty of factors to deal with, as the GIFT Nifty is also suggesting a gap down for our own markets. The important level on the upside for the Nifty, of course, is 26,000, which it has struggled to cross. Now that we are going to open gap down, it remains to be seen whether we'll see some support from the lower end at around 25,500 or 25,400 levels. And for the Nifty Bank as well, it's the options expiry today for the Nifty. Business updates continue as usual, and we'll see if there is a reaction to these F&O norms as well. For now, it's a 250 point downtick is what the GIFT Nifty is indicating. Heading over to Winnie now, who would list out the stocks that you need to watch out for. Winnie, good morning. What's on your list?
Good morning. I'm going to start with some of the pharma companies today. We have Aurobindo Pharma that we're keeping an eye out on. They received a final approval for manufacturing and marketing of Cephalinix tablets. Now, this is they've received a 180-day shared exclusivity in this drug, and this is a competitive generic therapy designation drug that has been granted to them. So yes, keeping an eye out on that. Expected to be launched in Q3 FY25. Zydus Life also in focus. They've received a tentative approval for a drug that is used for treating castration-resistant prostate cancer. So keeping an eye out on that one. Ashoka Buildcon received 2 letters of awards worth around 1,264 crores from MMRDA for designing, construction, and 2 creek bridges that they will be building. So on the back of that, Ashoka Buildcon could see a bit of an up move. We have Dabur that's in focus on the back of its Q2 update. It's not an exciting update that's come in. Mid-single-digit decline is what one is expecting in terms of consolidated revenue. Not much of a positive commentary that we're seeing there, so keep an eye on that. Hero Motor on the other side reported a good September auto sales number. So two-wheeler continues to shine. They beat the street estimate, and overall total sales were up by around 25% on a month-on-month basis and approximately 19% on a year-on-year basis. BSE, Angel One, IFL Securities, 5paisa, all of these are going to be in focus after SEBI has decided to increase those contract sizes in the index derivative side. So keeping an eye on that. Marico also on the back of its Q2 update is going to be in focus. Strong update that came in from Marico. Sector witnessed stable demand trends is what the company highlighted. Rural sentiment improving as well as revenue growth remained in high single digit. And VMart Retail also in focus on the back of strong Q2 updates, 20% growth in terms of overall consolidated revenue.
Business updates coming in thick and fast. We'll keep an eye out on all of these names. Winnie, thanks a lot for that. Finally, heading over to Mangalam with cues from the F&O space. Mangalam, good morning. It does not look like a very good morning for our own markets.
Well, if you're a bear, it's a great morning. If you're a bull, not particularly. You know, that's what they say about bull markets. Typically climbs walls of worry. And today we have a few of them. The first one, most importantly, over the holiday, we did get escalating Israel-Iran tensions. So that is one of the walls of worry that we'll be tracking. It's Nifty weekly options expiry today. Add to that, speaking about F&O, the SEBI's circular finally was released. This is with regards to tightening the F&O norms. And then you had a Q2 dampener coming in from Dabur in terms of demand. So we have a bunch of hurdles to track in today's trading session, and as a result of which the GIFT Nifty right off the bat is down about 300 points. We'll keep an eye out on that. Over the last couple of trading sessions, the FIs have been selling in the cash market. 2 trading sessions in particular, they've sold almost $2 billion. So nearly 6,000 crores sold on Tuesday's trading session as well. The domestic institutional investors buying around 4,600 crores. Also, in the index futures space over the last 2 trading sessions, the FIs have sold almost 3,200 crores. 1,500 crore worth sale is what we saw on Tuesday as well, with 14,000 long contracts being unwound and 6,000 short contracts being added. The FIs, well, they are still net long on the index futures to the tune of 79%. It's come down from about 81.5% in the last 3 trading sessions. And an absolute level, it's down by almost 40,000 contracts on the long side. Yes, the clients, the HNI retail investors are buying in, the FII selling, but then too, they are still net short to the tune of almost 62%, which has reduced from about 66%. So that's an important trend to track as well. For expiry today, the 25,600 put has been extremely active, telling you 25,550 to 25,600 could be some support. But, the GIFT Nifty indication is something that we'll have to track for. On the way up, there is resistance around that 25,890 to 25,900 itself. The 20-day moving average comes into picture today for both the Nifty as well as the Nifty Bank. So we'll keep an eye out on that. And we have a couple of stocks that we will watch out for too. Birlasoft has entered FNO ban and Balrampur Chini has exited FNO ban.
Important levels. Mangalam, thanks a lot for that update. Almost 300 points now on the GIFT Nifty on the downside. Time for a short break. Up next, market regulator SEBI announces new measures to curb speculative retail trading in the FNO space. More details on that on the other side. Stay tuned. We'll be right back.
From top Indian honchos before putting your money on the line. How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBCTV18.com.
ما يفكروا انه بس حزب الله بوجهه، كل الشعب اللبناني كله بوجهه، وان شاء الله النصر مثل ما وعدنا فيه رب العالمين. ان شاء الله اسرائيلي جربت قبل بمره وما طلع لها مع لبنان. مش بس في حزب الله، كل لبنان بده يحارب هالمره. كل لبنان ناوي على اسرائيل، على المجازر اللي ارتكبتها بغزه والمجازر اللي عملتها بلبنان. ان شاء الله ما حيضل واحد الا ما حيحارب. ما يفكروا انه بس حزب الله بوجهه.
Welcome back onto the much-awaited SEBI circular that was not announced in the board meeting, but then the decisions came in on Tuesday evening. There were 6 measures that were announced by the market regulator and mostly in line with what was proposed in the consultation paper a few months ago. The first one and the most important one being the limitations of the weekly expiry, and that will be limited to 1 benchmark per exchange, and that will take effect from the 20th of November of 2024, and that is expected to have the highest impact as well, because it will have an impact on NSE because it has 4 weekly expiries. BSE has 2 weekly expiries, so there will be an impact because of that. Now, IIFL Securities is expecting a 35 to 40% impact on the premium option premium turnover for NSE and 15 to 20% for BSE. And for FY26, their EPS is also likely to be hit by 15 to 20% on NSE's front and for 5 to 7% on BSE's front. We'll keep an eye out on any reaction in BSE. There was also a revision in the minimum contract size that was earlier set in 2015 and now has been revised from 5 to 10 lakh and now it's been revised to 15 to 20 lakh. That is another measure that has been announced. The lot size has also been hiked, which is now 2 to 3 times lower. Now it's almost 3 to 4x as proposed in the discussion paper. So that is another measure announced. And now there is an additional margin of 2% on short options contracts that will also take effect from the 20th of November. And there has also been an upfront collections of options premium that has been announced, but that measure will take effect from the 1st of February of 2025. And the 6 intraday monitoring of position limits will also take place. So a lot of measures that have been announced by SEBI. Will keep an eye out on stocks like BSE, Angel One and all of these discount brokers in today's trading session. But with that, it's a wrap on this edition of Power Breakfast from me and the team that put this show together. Thank you so much for watching. Bazaar Morning Call sets you up for today's trade.
There is a petition filed in Honorable Supreme Court about the constitution of the SIT. So some arguments went on yesterday. So we've been informed to stall the further proceedings for till 3rd, that is till tomorrow, the day after tomorrow. In the meantime, yesterday evening we were informed that the Honorable Supreme Court said that you hang on for some time. So in adherence to the Supreme Court order, we have stopped for the time being. So once the order comes, we are very sure that the order will come, because after all, it is a criminal case which we are investigating. So is it against the SIT only, about the investigation, about the case? We'll have to see once the order comes actually. But in the meantime, we have been informed, so accordingly, we have stopped it for time being.
The regulations are out. As we said, they were likely to come out today or tomorrow, and they're finally out. And I have to say, they're largely in line with expectations. So in July, SEBI had proposed 7 things. 6 out of the 7 actually have been implemented with very minor changes. So I'll start with what is going to be top of mind. Number 1, higher lot size value. This is going to be effective from the 20th of November. Basically, for index derivatives, which is Nifty, Bank Nifty, and other index derivatives, at the time of introduction, the SEBI is saying that the contract value should be between 15 and 20 lakhs at the time of introduction. At least 15 and up to 20. That is number 1. This is a simple and clean measure to limit the number of people who are able to trade this, trade index derivatives. Number 2, and I think a lot of interest around this, only 1 weekly option contract per exchange. This is also effective from the 20th of November. Remember, right now, NSE has weekly contracts, weekly option contracts on the Nifty, the Bank Nifty, the Midcap Index, and the Fin Nifty as well. BSE right now offers weekly contracts on the Sensex and the BankX. NSE now will have to choose one. They'll have to drop three, only one, and that too a benchmark contract. So most likely they'll have to decide whether to keep a Nifty weekly option contract or a Bank Nifty weekly option contract. Similarly, the BSE will have to choose between the Sensex and the BankX. The benchmark is the Sensex, so most likely BSE will offer the Sensex weekly option contract. So I think this is the one which I think is going to dominate headlines and market participants, most impacted exchanges, brokers, everybody most impacted from this one. Number 3, intraday positioning, monitoring of position limits. This is effective from the 1st of April 2025. Currently, position limits are monitored on an end-of-day basis. Now, this is to be done on an intraday basis. Remember, the limit which was set, I think, in 2020.
India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Thursday morning coming out of a holiday, midweek market holiday. And of course, winding down the week with today, Thursday, and then of course, tomorrow, Friday as well. Lots and lots of stuff to talk about, both local and global. You're with us, of course, here over the next 2.5 hours. We'll do that. We are coming to you from the CNBC TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, hi, good morning.
Hi, good morning, Prashant. Good morning, Nigel. That small holiday, I mean, there was so much news flow coming in. It didn't feel like a holiday, but nonetheless, we're happy that that it happened. And let's start by wishing all our viewers a very, very happy Navratri. The festive season kicks off, and today is day 1. So to your families, to your loved ones, to all of our viewers, wish you a joyous festive season. But, you know, folks, the news was anything but joyous out of the Middle East, that escalation, the barrage of rockets being fired. Frankly, I thought markets, I mean, I dare say, seem a little complacent because the reactions, this is Iran we're talking about. This is not another Hezbollah or whatever. Yeah. I mean, the images coming through, and right now there's an eerie wait and watch going on. The whole world is waiting to see what is Israel's retaliation, what form does it take. Does it target the oil infrastructure or not? But beyond oil infrastructure, beyond markets, I mean, we're just hoping this kind of de-escalates. Because the last couple of months have been pretty difficult.
Yeah, that's right. Just for the good of mankind, you know, step aside in terms of markets, etc. You just want these sort of instances not to take place. So just for the good of mankind, I think there should be some kind of de-escalation. And hopefully that comes about. On a positive side, Saudi as well as UAE, they are on the sidelines for now. So that at least helps the oil market in terms of those supplies and those dynamics.
Well, absolutely. So let's take it straight to, you know, where we are this morning as we begin this almost looks like a sort of a fresh episode, right? Although we've been trading all through with just a holiday yesterday. So from last night, there have been no sort of reported retaliatory attack by Israel. So that's essentially point number 1. Remember, you know, you would have, it's very, very hard to miss. Iran, of course, launched missile strikes on Israel, no reported casualties, etc. But that was Tuesday, you know, post-market, Tuesday for the US, and of course for us it was Tuesday evening as well. Now, the Iranian president has vowed a stronger response if Israel retaliates. So, you know, they're already awaiting a response, and it's about when. This is essentially Israeli officials. This is all sourced, and there are lots of reports doing the rounds. But this one specifically, I want to put out to the political news website called Axios. And they said, this is Israeli officials to Axios, and they're saying that will launch a significant retaliation within days that could target oil production facilities inside Iran. You know, so far, you know, this back and forth between Israel and Iran has had elements of almost coordination. You know, we launched 2 missiles, and you know, you got a safe face, and you will do something, but eventually it kind of goes off ramp in a diplomatic way, and it does not escalate. But over the last 24 hours, this seems a little different in that sense. So, you know, that's where we are at, awaiting what happens in this chapter. Now, a bit of stability in US markets and the VIX cooled off a little bit, 1.25, but the big jump, of course, came on Tuesday as all this happened. VIX went up about 15% odd. US equities were flat. I mean, the Nasdaq was nothing, unchanged, but the big, again, change happened on the cut that the 1.5% cut that we saw on Nasdaq on Tuesday. Oil prices, well, what's happened over the last 2 days? They're up 5% since we closed, right? We were at about 71, we are at about 75 on Brent oil prices. So that's a big jump that you're reacting to as you come back this morning. US Treasuries, they've had a complete round trip. They fell 5 basis points on Tuesday. Last night, they went up 5 basis points. It's largely unchanged as we look at things. Dollar is also stronger. Dollar index, I mean, there is, of course, money goes home, it says, and that's US dollar, and that's up about 1%. Over the last 3 sessions, we are back at about 105.5. So that's essentially what's happened and not happened and what we're awaiting to happen in the Middle East and the market reaction so far. In Asia, Japan, the Japanese currency has been the big mover. And I just want to put this up. The new Japanese Prime Minister made this comment yesterday. He said that we are not in an environment now to raise rates again. That caused a big move on the JPY. We were at 145 yesterday. This morning at about 146.6. So it's the JPY has been the global underperformer. There is, of course, elements of the dollar strength as well, which is playing out. But 146.4 on the USD JPY is where that particular currency is at right now. Now, in macro data out of the US, the jobs data is the big one. That's only tomorrow, right before markets open. So we'll wait and watch for that one as well. There is a fair bit in India which we need to tackle, and we will get to in just a bit. The SEBI F&O rules and some of the consumer companies which have disappointed. It's a bit of a subdued kind of picture as we begin the day, both local and global. So watch out for supports. The 20-day moving average at 25,500 is the important downside level for the Nifty. For the Bank Nifty, that number, the 20-day moving average, stands at 52,538. And below the 20-day, for the Nifty Bank specifically, the 40-day exponential comes into focus, which is 52,150 or so. I think risk sentiment stays muted, not just here, but globally as well over the next couple of days as we await, more than anything else, what happens out in the global markets, especially because of what's happening in Middle East. And it's not as if there is something happening locally which is very, very positive. As I said, SEBI norms, earnings, the previews which are coming through, they don't paint a very, very healthy picture. Nigel.
Well, that's right? The GIFT Nifty is suggesting that we open up with a cut of around 100 points, and the bulls, they have their hands full because plenty of headwinds is what is faced in today's trading session just at the start. Middle East tensions, that's the reason that crude oil prices have moved up, and the dollar as well is at the highest level you've seen in 3 weeks. So that's not very, very favorable. SEBI, they have attempted to curb speculative trading, and those measures will come into play in the next couple of months or so. And the third factor is just in 2 sessions, the FIs have sold closer on $2 billion or thereabouts. In Tuesday's trading session, it was 5,000 crores. The previous session was closer on 10,000 crores. So those are the headwinds up in front of us. What about positioning? The FIs, they continue to remain net long, though the long positioning has come down a little bit in the last few sessions, closer on 40,000 contracts lower. The clients, they continue to remain net short, but they have cut their positions. You have seen this 300-400 point fall in the Nifty from the recent peak. Well, and they've been covering their shorts as well, which normally indicates that they're not too confident that the markets are going to drift a little bit lower. So today's dip, we'll have to see whether or not that gets bought into. Options data, you have the Nifty expiry that plays out today, and between the 25,800 call, 25,900 call, between them, more than 60 lakh shares getting added out there. So the bears are getting confident that we won't get past this 26,000 odd mark, which explains why the PCR is now closer around 0.83 odd. A few sessions ago, it was at around 1.2. What are the levels you're tracking then? The important levels, the near-term technical support levels on the Nifty as well as the Nifty Bank, they're up for you on the screen, which is at the 20 DMA. So for an adventurous trader, you get a 100-point downtick today, you'll keep this as your stop loss and you'll hope that the Nifty bounces out there. Otherwise, it limits your losses to around the 20 DMA. So we'll have to see how that plays out there. The big boy is Reliance Industries. That's been actually a relative underperformer. In the last 6 months, the stock has been unmoved. The Nifty is up 15% in this period. And now it's trading below the 20 as well as the 50 DMA. So it'll be important for Reliance Industries to find its way back towards the 2,960, 2,970 odd mark, because that's a bit of a resistance zone. The other one we're looking at is a stock that's come out of the F&O band, so we'll have to keep an eye out because the technical factor sometimes does play out. Balrampur Chini is a stock we're tracking. So a downtick to kickstart trade, an adventurous trader may be looking at buying this dip and keeping the 20 DMA as the crucial support zone.
All right, Nigel, thanks very much for that. Well, let's run you through some calls which are coming through. This is Christopher Wood of Jefferies who's coming in with a quick view. He says that end of the quarter and following one of the most violent counter-trend rallies in China, greed and fear is ever seen. Some adjustments will be made in the Asia-Pacific ex-Japan relative return portfolio. He says the weighting in China will be raised by 2 percentage points to maintain the marginal underweight position in that market. And India, so it'll be essentially paid for by reducing India by 1 percentage point.
All right, so a bit of a tactical change by someone who's a long-time India bull. That's been the ferocity of the Chinese pullback. Well, let's discuss all of these developments. Pooja Sriram, US economist at Barclays, is with us. Pooja, good to have you on, and morning to you. Thanks for taking the call. So let's start by looking at the market's reaction and interpretation of the events in the Middle East. Of course, Tuesday was a day of volatility, but the market seems fairly sanguine. For some reason, it seems to believe that this will be contained. What is your sort of thought on what we're seeing right now, the uncertainties, and just the way risk assets are poised, equities? Oil saw a mild pullback, but in general, I mean, markets were not too unnerved.
Yeah, hi, good morning to all of you. Yes, it's been interesting. We're clearly following the developments quite closely. For now, like you said, the sentiment still surprisingly seems to be fairly risk on globally. It does seem like there's a sense that this might remain contained, that it's unlikely to get out of hand, just given that it could have pretty large repercussions should it become an all-out war. And just to sort of comment on the risk-on sentiment, since I'm sitting here in the US and I cover the economy here, the sense that we're getting here is, the US growth, story still looks pretty good. We're seeing, an easing in monetary policy, which the Fed kickstarted with a very strong move. And then we've, also seen a broad monetary policy easing by other central banks in the developed, as well as some developing economies. So against that backdrop, I think there's some sort of an offset to what's happening in the Middle East.
Okay. Hi, Pooja. Good morning and good to see you in. What are you factoring in terms of Fed action, though, from here on? If you could tell us, are you factoring in another 50 basis points for the remainder of this year? And also, I wanted your comment on crude oil prices. For now, the UAE as well as Saudi Arabia, they're sitting on the sidelines. And if needed, they could ramp up production as well. So I guess that's one of the factors that's weighing on crude oil prices. What's the range you're working on? Comment on both Fed as well as on crude oil.
Sure. So I'll start with the Fed call first. Our baseline is 2 more 25 basis points cuts this year. So one in November, one in December. And that's exactly what the FOMC had penciled into their projections as well. And, the rationale there is, there is the data in the US, particularly on growth, on consumer spending, still looking quite healthy, which suggests that there is, a fair bit of momentum left in the economy. Of course, the one pocket of concern remains the US labor markets, which is why the data that comes out on Friday will be critical to how things proceed. But our base case is, even the labor markets seem to be cooling in a very gradual, disciplined manner. And we think, 225 basis points is likely to be the way forward, unless the data tells us otherwise. And just coming to your second question about crude oil prices, it's, surprisingly, they haven't reacted as much as one would have expected. And, there is definitely a bit of that supply boost that we're talking about, which is possible. Our own sense is that we could see a scenario where it goes up to about $85-90 a barrel by the end of the year, should these should the war sort of continue and exacerbate. But there are likely to be offsets from the inventory situation as well.
Okay, so as of now, Pooja, to sum things up, you are still going in for the expectation of a soft landing in the US and a resilient economy and positive markets, right?
Yes, that is right.
With the caveat being, if you could just repeat the level on oil.
We're about 85 to 90 by the end of the year.
85 to 90. So that still gives plenty of cushion and comfort from where oil prices are right now, even if there is an unfortunate flare-up in the Middle East. Thank you, Pooja, very much for joining in. Good to get that perspective. So that's a view from Barclays on, of course, how the US economy is poised right now and what potential the flare-up in the Middle East, what potentially that could do to oil prices. Well, let's quickly move on and talk about all the corporate interactions that are lined up on the show today. Coming up at 8:35, we have Pralay Modal, MD and CEO at CSB Bank, joining in to decode the impact of RBI guidelines on gold financiers. At 9 a.m., we will be joined by Rajesh Baheti of Crossseas Capital Services to discuss the latest SEBI announcements and changes for the F&O segment and how this could impact market participants. At 9:20, Yogesh Patil, CIO Equity LIC Mutual Fund, talks about the market perspective from here on.
Okay, well, at 9:30 this morning, we'll have the management of NLC India who will be with us to discuss the new electricity plan and also outlook for FY25. A little later at 9:50, Ben Powell of BlackRock Investment Institute will join in to discuss the outlook for markets going forward amid rising geopolitical tensions. And of course, on It's the Economy, Lata will get chatting with Harry Murphy of Credit Suisse, will get chatting with Moody's Analytics, Louis Kui at S&P Global Ratings and Jeremy Zook at Fitch Ratings. Those conversations come up at 10:15.
Well, time to slip into a short break. On the other side, we'll focus on all the top stocks we're tracking for you.
Was 500 crores based on notional value of trades. So this was monitored, but at the end of the day, now they're saying it has to be done on an intraday basis. Lots of feedback in terms of how this is going to be finally implemented. There is time, as I said, only effective from the 1st of April 25. Number 4, increase in tail risk coverage on the day of options expiry, effective November 20th. Basically, if you are carrying a position or if you take a position on the day of expiry, all existing positions on the day of expiry, old and new, will attract the extra ELM, which is extreme loss margin of 2%. So this is number 4. Number 5 and number 6 are pretty straightforward. Number 5 is upfront option premium, effective 1st of February 2025. And number 6, removing the expiry day calendar spread benefit, which is also going to be effective from the 1st of February. So I think these are the 6 changes which SEBI has implemented, largely in line with expectations. But I think the lot size increase and the fact that SEBI is limiting weekly options contracts to 1 per exchange will attract maximum amount of discussion and debate in terms of what this does for market volumes, exchange volumes, and what this does to market intermediaries as well. Back to you.
Right, Prashant, very quickly before I let you go, a lot of comments coming in, a lot of questions and queries coming in from the viewers as well on our social media handles asking about the impact and the implications. Just in the near term, from a market perspective, you've probably been speaking with experts. What's the impact likely to be on the markets when we open tomorrow?
Shireen, so through the course of the day, we spoke with lots of market participants. Markets are prepared for this. I mean, we put out the story in the morning that this is to be expected very soon, that this is imminent. There was some expectation in some quarters, and we had clarified yesterday as well that this was not to come up along with the board meeting. And we said that, well, this is going to come soon this morning. So I think this is widely advertised. And the fact that what has been done is largely in line, actually mostly in line with what was proposed in July, I think does not come as a shock or a surprise. And also the important point is this.
Welcome back. You're with us on Bazaar Morning Call. Well, we're dealing with multiple cues, and all of it put together is implying a little bit of caution as we start things off. We'll get the implied open up for you in just a second. There are lots of individual stocks to track as well, and our team is standing by with the CNBC TV18 list of top stocks to watch. Let's kick it off with Vinny. She's been tracking all the auto sales numbers that were coming in over the midweek holiday. Vinny, Hero, Moto, and a couple of others. Tell us more.
Absolutely. Hero Moto, Eicher Motors, as well as Maruti Suzuki that came out with their September auto sales numbers. So the two-wheelers, both of them have managed to do well. Eicher Motors also, we're expecting it to open in the green, beating the estimate of CNBC poll. Overall, a 10 to 11% growth in terms of total sales numbers. Exports have seen a very good growth. 77% growth for Royal Enfield is what we're seeing coming in. And number of units sold is around 7,652 in the export market. So that growth momentum continues for Royal Enfield. Even Hero Motor, that is also managed. We are expecting it to open in the green. Good set of numbers in terms of auto sales. Growth of around 25% on a month-on-month basis, 18% growth on a year-on-year basis. Domestic sales, exports, both the momentum on both these fronts have continued. Whether you look at it versus last year or the last month, strong growth there as well. Maruti, on the other hand, we're expecting a bit of a red for this stock today. The estimates and the sales volume, what we're comparing, it's in line with what the street was also anticipating. Not much of a growth in terms of total sales, just around a 2% growth. PV sales have been seeing a decline, so down 3% on a year-on-year basis. LCV exports not exciting there. And lastly, Bharat Forge, we have the NA Class 8 numbers that have come in for the month of September, where we are seeing a very good growth in terms on the month-on-month basis, 124%, and year-on-year basis a 4% growth. So keeping an eye out on that. September orders have been at a 10-month high, so expecting a bit of a green here.
Got it. All right. Thanks a lot for that, Vinny. Well, let's go across to Mangalam. He's here to tell us about Dabur as well as Marico's business updates. Mangalam, morning.
Good morning. So Dabur will well be the stock on the way down in today's trading session, and that's largely because of a big dampener coming in from them in the second quarter update. Two things. One is that their consolidated revenue will decline in mid-single digit, and as a result of which the EBITDA margins will also decline to mid to high teens versus earlier guided 20%. Why is that? Because of two reasons. One, heavy rains and flooding in parts of the country impacted out-of-home consumption, and as a result of which the beverage category saw a bit of a dip. And secondly, the more important one, due to high growth in quick commerce and e-commerce, the company has decided to rationalize inventory that is there in general trade. And this is an interesting trend that we'll be watching out for, not just from Dabur, but all the other FMCG companies over the next couple of quarters as well. While we've been talking about growth in quick commerce, it's actually now beginning to impact growth in traditional trade as well. So as a result of which, expect the stock to be lower. It is already down 10% from its 52-week high level, but let's see how much further lower does it get today. The other stock we're watching out for is Marico, and this may well be the stock on the way up today. Why is that? Because the consolidated revenue for the company grew in high single digits. Domestic business posted mid-single digit volume growth. And importantly, remember the stock underperformed when Bangladesh had that impact out there. The company said Bangladesh posted high single digit growth in this quarter. So we'll keep an eye out on Marico. See green on Marico and red on Dabur.
Maybe deep red on Dabur. We'll see. Mangalam, thank you very much for that. So that is FMCG in focus, and perhaps we'll watch implications otherwise in that sector as well. Well, Aurobindo Pharma had some negative news flow on Tuesday. Well, it's got some positive news flow this morning as we start. Ekta is here with that. Ekta, morning.
Morning. Well, maybe the stock should probably be in the green on the back of this approval. They've received final approval from the US FDA to manufacture Keflit generic tablets, which is basically an antibiotic. Aurobindo has been granted competitive generic therapy designation for this drug. So that means that they're eligible for 180 days shared exclusivity, expected to be launched in Q3 of FY25. But remember that this news comes in context of regulatory issues which they've been facing in the past couple of months. So maybe, there could be, the upside could be limited on account of it.
Okay, all right, got that. Ekta, thank you very much. Let's move on. Vivek is watching out for JSW Energy. Vivek, morning. What's the news?
Well, good morning. An important development coming in as far as the company's renewable energy ambitions are concerned. The company's renewable energy subsidiary known as JSW Neo has received an LOI, letter of intent, from the Maharashtra State Electricity Department. Now, this particular LOI is for going ahead and supplying 15 megawatt, which is moving up to almost 20,000 megawatt per hour. And this is for providing energy storage capacity for a period of almost 40 years. So again, a long-term commitment coming in from the Maharashtra State Electricity Board. Now, what does this mean for for JSW Neo. Number one, the total locked-in storage capacity now stands at 16.2 gigawatt hour, where pumped hydro is almost 14.4 gigawatt hour and battery storage is 1.8 gigawatt. It's a positive development. Expect the stock to be in green today.
Okay, all right. Thanks, Vivek, for that. Well, let's across to Sonal. She's here to tell us about Jubilant Ingrevia. Sonal?
Good morning, Nigel. Well, there's a big order win that has come by for Jubilant Ingrevia, the wholly owned subsidiary. It has entered into an agreement with a global agrochemical company. This is to supply agro intermediate for one of the key agro actives of the customers. And here the consideration is huge. It's around $300 million plus to supply these agro intermediates to the customer, and this will take place once the commencement of production happens over a couple of years. But yes, this is a big amount which would come into the books of the company. The company says subsidiary will be investing in the manufacturing facility. We don't know the quantum of investment. That'll be important to track. And manufactured agro intermediate will be exported from India. It is not for domestic usage but for exports. So we'll have to look out for margins from this product as well.
All right. Thanks very much, Sonal, for that. Well, oil prices are a big headline, and that's a big macro marker. 5% since we last closed at 3:30 on Tuesday and went into that holiday. So almost knocking at 75. Manisha is here with more. Manisha.
Thank you for that, Prashant. Well, yes, the 5% of a knee-jerk reaction prices have started to gain for a third straight day today as well. Iran on Tuesday fired more than 180 ballistic missiles at Israel. Hostilities seem to be now seeping further into East. And remember that Middle East produces 1/3 of global crude. As of now, we haven't seen any threat to the oil supplies. But if that happens, if that is a retaliation, and Iran being one of the major prominent members of OPEC as well, you could be looking at further premium coming in for the prices. At this point in time, also the prices are contained because the U.S. Crude production continues to increase. The U.S. inventories also surged by 3.9 million in the previous week. And also the U.S. gasoline demand is at the lowest in 6 months. So, and these are just U.S. numbers. The Chinese numbers continue to be on the weaker side as well. OPEC has said that they will increase production from the month of December. The next OPEC meeting is on 1st of December. So the markets really are rising only because of the geopolitical tensions. Because otherwise, when you look at the supply and demand situation, that still continues to be bearish.
Oh, yes, Manisha, we remember you gave us the numbers. I think it was a 9 or 10% decline in September otherwise for oil. But October has started off on a very, very different note. Thank you so much for joining in. We'll track it through the course of the day as well. With that, let's quickly recap our list of top stocks to watch. The ones that have positive news flow are Eicher Motors, Hero MotoCorp, Bharat Forge, Marico, Aurobindo Pharma, JSW Energy, Jubilant Ingrevia. The ones that have negative news flow around them are Maruti Suzuki and Dabur. Crude users, of course, could be negatively impacted as well as prices remain well bid and the uncertainty continues. On that note, let's take a very quick break. On the other side, we will be in conversation with Pralay Mondal, MD and CEO at CSB Bank. We'll talk about, of course, the trends in the second quarter and the impact of the RBI advisory that's talking about a lot of the internal compliances and regulatory issues that need to be carefully monitored. Talk about that and more on the other side.
Manner. It's not as if everything is being implemented by the end of the month or from a certain date. I mean, there's November 20th, there is April 1st, there is February 1st, all the way into 2025. I think that also kind of eases the impact a little bit.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBCTV18.com.
first of all, I mean, we are seeing very strong momentum in the market, and clearly this is on the back of some very good rainfall. Of the 36 agri-climatic zones that we have in the country, 33 zones have got either normal or above normal rainfall. And even in terms of, if you see the state stratification, for only the states of Bihar and Punjab do we see little bit deficiency in the rainfall, but broadly all the agri states also have very good rainfall. In terms of revising the guidance, no, we will still maintain at 5% level because we want to see through the festive season and then maybe take a call at the end of Diwali. That would be our view. But most of the heavy lifting will happen in H2 of this year.
Welcome back. Now, you'd remember the chatter from Monday when the RBI issued an advisory. So, over Monday and Tuesday, there was some pressure on the gold financing stocks because the advisory didn't point out fingers towards anybody, but it did say that there are a lot of internal issues, especially where banking correspondents are involved or third-party service providers are involved, where perhaps proper due diligence is not being done. The RBI raised issues like when gold auctioning happens, whether all the norms are being followed or not, whether the end use of gold loans, whether that's being properly monitored or not. So it in general was advising for more caution and higher due diligence. Well, we have to discuss that and a lot more with our next guest. We have with us Pranav Gundapalli, Senior Analyst, India Financials at Bernstein. Pranav, thank you for taking this call. So let's start right there. What did you make of the advisory? It wasn't penalizing in nature at all for anybody. But it was pointing out to a lot of potential discrepancies which are there in the system, a little unusual. What's your stance on the listed gold financing plays right now?
Right. See, I think it was in line with the series of actions that RBI has been taking on the consumer side. So given that the gold loans have seen a significant increase, was not a big surprise. But I think on the positive side, the lack of any specific changes to the product, credit risk weight or something of that sort, was probably a sign of relief, number one. And number two, given that they had a long list of observations and have left it open for the lenders to go and fix it over the next 3 months, suggests that either A, we have this as a more widespread issue, and two, is something that they would prefer the lenders to solve themselves, not something that can be solved by extra regulations or extra risk weights or interest rate caps and stuff like
that. Got that. So, Pranav, just a quick, should we differentiate between companies which have been in the gold finance business for a long time, like Muthoot and Manappuram, right? And companies and banks who have gotten into the segment because it's such a fast-growing area. Because I remember even at the time when that, the IIFL ban happened and they clarified that you can only disburse so much in cash, right? There were conversations that, companies which only do this or have done this for a long time, I mean, there are set processes and the regulator also kind of understands how this has been happening, etc. But from some of the is this more directed towards some of the newer players who've come in that sense?
Definitely. Yeah. In fact, we actually think this set of regulations are positive for those who've been doing this for a long time, like Muthoot or Manappuram. Because if you look at the list of observations, those almost seem like 101 stuff that most of the gold lenders would have solved by now. And they've survived 2 decades of RBI audits. So I'd be very surprised if there is a slip up from the monoline gold lenders on some of these areas, right? And also, given that they don't have the hassle of doing agri gold lending, which is what a lot of banks focus on, I think the whole end purpose monitoring and agri documentation, etc., would also be less onerous on them. So, I see this as like you said, a greater change for banks and also other fintechs or NBFCs that have entered into the segment, especially in the context of a slowdown in unsecured lending. So there is a general shift towards more secured lending. So this is more a preemptive move from RBI to say, let's kind of tighten this before we see a flurry of new players coming.
Okay, all right. Pranav, request you to stay with us. Let's also get in the management of CSB Bank, since we're focusing on the gold financiers, and they have a fair bit of their portfolio as well that's inclined to this part of it. Mr. Mondal, the MD and CEO of the bank, joins us on the show. Hi, Mr. Mondal, good morning, and always good to have you on the show, sir. The RBI has asked lenders, they've raised some queries out there. Could you tell us, what is your analysis of it and what is the feedback you have got?
Good morning, Nigel, and good morning to your viewers. Yes, I think there was a communication from RBI on gold loan business and broad directions. And we have been working it for the last 2 years because one good thing about the supervisory process which we have now, where it's a constant supervision, is we have that opportunity to communicate with RBI and their views constantly. And as you rightly said, that we have a larger gold loan portfolio as a proportion. There has been conversations happening, which has helped us in doing a lot of the things which is being communicated through this circular. So to that extent, as a bank, we are broadly ready with most of the points. Maybe one or two we have to still work on that, and we have to communicate that compliance to RBI. But we are quite comfortable with the implementation of the circular as it has been advised.
Pralay, morning, Prashant here. We just had Pranav from Bernstein, who tracks this space as well. And I was asking him whether this actually is directed towards some of the newer players. When I say newer, I don't mean, I mean recent entrants into the space over the last couple of years. Because as Pranav was saying, that some of this reads like lending rules 101, right? So this is kind of reiterating how you're supposed to go about doing this. And Pranav was saying that maybe for older lenders, and you're an old lender in this space, in the gold finance space, especially in the state of Kerala, Manappuram, Muthoot, etc. as well. So for some of the existing incumbent older players, this actually may be a little bit of a positive, just because it may be a little negative for others. I don't know how you look at it. Quick thoughts.
Yeah, good morning, Prashant. I have always taken the view that anything which is for the industry, and there is no negative, positive, everybody has to be on the same page. And hence, good long-term players will always find a way to do the business in a compliant manner. So to that extent, I don't look at it as an opportunity or as a threat. I look at it that we have to do the right things. And if you ask me what Pranav just said also, that gold loan is a very touch and feel business. And customers themselves are very comfortable when they walk into a branch and do business. And as lenders, we are also very comfortable because it's just not knowing the customer, knowing the collateral, which is the gold, and understanding that there's a lot of experience and a lot of touch and feel there. So to that extent, I think the kind of a traditional method, going through branches, doing it through the branches, having experienced people doing that business do help. And that is definitely an advantage to us for sure.
Mr. Mondal, hi, good morning, sir. You just said that you are in conversation with RBI and then sort of you're ensuring all the regulations and the compliances are up to the mark, and there could be one or two areas where sort of you're pulling things up. Could you elaborate a little bit on that? What specifically, for a bank like CSB, what would be the concern where RBI would want you to pay greater attention? Because the advisory that came in was very wide. Right from end use of those loans, which, I mean, that end use is not being monitored, to the way auctions are happening. Just trying to understand what the Reserve Bank's concern would be from the older, more established players like CSB.
So you know, in a touch and feel business like this, where value of the loan is small and hence the number of customers and number of transactions are very high, and where the tenor of the loans are also not very long. So to that extent, there has to be a lot of proper documentation processes. Like policies are all in place for us right now. But what I think RBI wants everybody to do, I think we are a little ahead of the curve in terms of what we have already done. Thankfully, we are ready for most of it. But what we need to do more is checking on the ground that what policies and what we have rolled out is happening in 100% cases or not. And to be fair, it is very difficult to have 100% compliance on everything on the ground when you're dependent on individual people, whoever is doing it. And hence the audit processes has to be a lot more stronger. We have implemented that over the last 1 or 2 years, but we will significantly enhance that part. So I think that's the part where we need to do more audits. Let's say if you're doing 1 audit or 2 audit branches, we may need to enhance that a little bit. I think those are the areas where we want to do on the documentation and the process part.
Got it. So you need to make sure that the regulation is being followed in letter and spirit, and therefore more scrutiny and audit at the bank level or the NBFC level, as the case might be. Will this mean that there's a bit of a slowdown? I mean, the business is almost 45% of your total business, right? What was the growth that you had in mind for the gold loan portfolio? And as you go about ramping up some of these compliances and the audits, will the growth come down in the near term?
So, Surya, let me put it this way. The growth has not happened really because of any of these issues. Growth has happened because if you look at the price of gold has gone up by anywhere between 25 to 30% in the last 1 year. And hence, if you look at the gold view, people are saying it can touch $30 to $100 also in the long run. I'm not taking a punt on that, but I'm just saying what I'm reading. So to that extent, I think that's the reason why gold business has gone up. And hence tonnage has not gone up that much. It is mostly value. And we are very conscious of that. Given all these perspectives, I think we'll continue to do well as long as our processes and compliance is good. And let me put it this way. We saw it in microfinance also many years back. Once better governance, better compliance comes, in the long run, actually business grows and business doesn't decelerate. Only the players who are following it to the letter and spirit actually takes advantage of that. So to that extent, we are very focused on what we want to do. And I don't see this as a dampener for the business. Of course, if gold prices starts coming down someday, obviously there will be a dampener. But right now, this is not a dampener. If at all, this will be an accelerator in the long run for good and compliant institutions, whether it is NBFCs or banks.
All right, Mr. Mondal, so tell us, what are you factoring in? I recall Q1 was disappointing because of strategic reasons and regulatory reasons as well, but Q2, you're bounced back. Now, give and take everything with the current price of gold, what are you factoring in for your overall book as well as for gold for this fiscal? Earlier, I think you were alluding to around 18 to around 20% growth in your book. Now, what is the revised estimate, particularly with gold? As you said, tonnage hasn't gone up, but pricing has gone up.
Yes, Nigel, you're right. So, yes, Q1, we had some tactical, strategic, whatever reasons for a softer quarter. I think we have bounced back. We have continuously focused on the deposit. If you look at our deposit growth is around 25%. We have also got enough borrowings to ensure that our other liability parameters like LCR and SFR and all of that is in control. Our CD ratio is also looking good. Overall, only deposit growth is almost 35%. So I think we have focused a lot on the deposit because we thought there is a risk emerging there from a liquidity perspective. So we have invested into that and growing there. On the asset side, as I said before, that irrespective of what the market does, we will grow 30 to 50% faster than the system. We have done that. Hopefully we have done that because we know our numbers. We have to see the industry numbers. We are around 20% growth on assets, and gold has grown by around 27%. So I think gold is still sort of nose ahead of our overall portfolio growth. But I think our wholesale business will start picking up in the second half of the year, and so will SME. And retail is also growing. So to that extent, I'm pretty confident that we'll grow anything between 30 to 50% of the system faster than the system. And that kind of a projection still I hold.
Okay, and we'll quiz you more on the numbers, margin, outlook, etc. when you join us post your Q2 numbers. But Mr. Mondal, one final question before we let you go. You have admitted in the past, that you all were interested in inorganic growth. One of those assets that we have quizzed you about is Bank of Maharashtra. Is there some more inorganic growth that you're looking at as of now?
As I said before, it's not in I think it's a conversation is not with CSB. So I can't comment on that, but not that anything which we know of, which says that we are looking at a large inorganic growth at this point of time. If one of our investors looks at anything, I will not be able to comment on that. But at this point of time, CSB is purely focused on organic growth. Maybe some portfolio here, there will always look at depending on the pricing and the valuation. But a larger acquisition, we are not looking at as a bank. So that's the way we are looking at it.
But what if the promoter is looking at another asset? Then it's possible that they'll want to bring both these two assets together?
You have to ask them. I am not privy to that, and they have not.
We'll do that. We'll do that in the next month or so.
We'll ask Fairfax. And thank you very much, Pralay. I appreciate you joining in, and good speaking with you here on CNBC TV18. Thanks very much.
Thank you,
Pranav, thank you for waiting. Just a quick word. So what are your sort of top ideas from your coverage universe, Pranav?
Yeah, so I think amongst the larger banks, we like HDFC and Axis at this point. We are not too bullish on the consumer lenders. We still think that there is some more downside on the asset quality. We are probably a few quarters away from what I would call the bottom of the consumer cycle. So we like the larger banks, and amongst them HDFC and Axis. Amongst the NBFCs, we like the gold loan lenders. We like Muthoot a lot. I think at this point, while there is a tailwind of a rate cut, we would stick with the secured lenders, which is the likes of Muthoot.
So, Pranav, if I could request you for a sneak peek into the season that's about to kickstart. I think one issue that everyone's going to watch out for is credit cost and any deterioration in credit quality with all this conversation around microfinance and unsecured, right? So, from that perspective, if you could single out entities that may be worse off, so we need to just watch for those managements, the commentary and the numbers as well. And from the margin perspective, because that's another debate, what's happening to margins considering the rate environment that we're in? What should we watch out for? And which are the entities that could perhaps preserve margins and which are the ones that could see the maximum stress?
Right. See, I think on the asset quality front, it's all the ones with the exposure to microfinance. So the pure play microfinance lenders, you've got quite a few of them that are listed. So they will be the ones to watch out for. In terms of the larger banks, I think microfinance will be an important consideration for the likes of IndusInd, where I think the stock has most of things going for it, except that they need to know where the bottom is in terms of the microfinance credit cost. So that's on the credit cost front. And in terms of the NBFC space, the consumer lenders, SBI cards, Bajaj Finance would be the ones where the credit costs would be the main thing to watch out for. We've seen some deterioration in the last quarter, a prolonged one for SBI cards. A continuation of that would be a negative, especially given the run-up in the last month or so, where there seems to be some assumption of bottoming out of credit costs. If that does not hold true, then we could see significant downside. So consumer lenders on the NBFC front and on the bank side, IndusInd is the one more exposed to the microfinance side. Now, on the margin side, I think we are starting to see some improvement in liquidity, which I think is a positive. So which means that we are probably at the bottom in terms of the margin pressures. Right? So I think this quarter would probably be the one with the last piece of deposit pricing increases. And the ones with fixed rate books will start getting better position as we move into easier liquidity and potentially rate cuts as well. Again, IndusInd stands out there as the one with a greater share of fixed rate book and therefore could benefit from rate cuts. And HDFC, while its loan book is not too different from the others, could see their liability costs move down with rate cuts. So they again will stand to benefit. So amongst the larger banks, with margin pressure almost coming to an end, us looking forward to rate cuts. I think IndusInd and HDFC do stand out as our topics from a margin perspective.
Got it.
Yeah.
Got it. Little short on time, but this is very, very helpful. Pranav, thanks for joining in. And we promise to get you back once the numbers start rolling in. It'll be helpful analysis. You have a good day. Thank you very much for being with us on the call this morning. We'll take a break on that note. Come back on the other side and it's time to talk technicals. What's today's trading setup looking like? Mitesh Thakkar and Sudarshan Sukhani join in with some perspective.
So overall 5% growth rate. September has been a slow month for us in exports, and there are two factors to it. One is that in our neighboring countries, there are some geopolitical challenges being played. These are all very big markets for brand Mahindra and Swaraj. And even in the US market, we are seeing that 11 quarters of continuous degrowth in US tractor industry. Now that is, we know the factors, that is on back of very high interest rate cycle and people were waiting for Fed to start cutting. And now that has happened, I think the transmission will take 3-4 months time. And even in our US, which is our second largest market after India, the sentiment will revive. So that will again give us growth getting into our Q4. But I think for next 3-4 months, the exports might be a little slow.
CNBC TV18, an unending pursuit for excellence. A pioneer, A leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC TV18 India's #1 business news brand.
Okay, welcome back. There's 13 minutes to go for the pre-open session. We have Mitesh and Sudarshan with us with what they're making of things and what trades they'd want you to take. Gentlemen, good morning. Good to have both of you here. Mitesh, the GIFT Nifty is indicating a lower start. Will the 20-day, both on the Nifty and the Bank Nifty, be the sort of markers from here as we look ahead? And what's the trade for today?
Good morning, Prashant. So, we were talking about a test of 25,800, which was a support pivot. And on Tuesday, we closed right there. And today we'll open gap down. So that's not a very good sign, though I think the key supports, as you were rightly highlighting, some of the moving averages, they will come closer to about 25,450, 400 zone. So I think that should be the next logical target area. I hope that those levels will hold and we'll get a good bounce back from there. But the structure in the short term is turning negative. So I think, now getting past 26,150 odd levels will be very difficult. Until that is captured, I don't think we'll start a new leg of the up move. And just hoping that this 25,450, 500 zone holds. And then if you can get a bounce back, do some sideways choppy range bound kind of an activity. After that consolidation, there could be a possibility of an up move. So in the short term, I think, reduce your long exposure, look at adding some kind of short exposure on the stock side or on the index via options route. And till 26,150 is crossed, I think, we'll be slightly cautious.
Okay. All right. Got that, Mitesh. Sounding a little bit cautious this morning. Let's get in Sudarshan into the conversation. Good morning, Sudarshan. What's your view on the index? We're bracing, I think, for a sharp decline to kickstart trade. Your view?
Yeah, good morning. My view is that we are in some kind of a correction and we should wait patiently for this decline to come to an end. That sign will come when the market becomes stable, it starts moving sideways. It's essentially it stops falling, and that's not just for 1 hour. It has to do that for a couple of days. So that hasn't happened yet. I don't think there is any buy on dips opportunity in either the indices or in most of the stocks. Some stocks will always do outperform. So the focus should be on selected stocks, and we should completely avoid the indices.
Okay, got it. Avoid the indices, remain with stock trade. So Darshan, morning. Let's get to the stock list then. What are you working with today?
Yeah, that's fair enough. See, Deepak, there are a number of buying opportunities. There were a lot of stocks that actually went up on last trading day. So Deepak Nitrates is a buy with stop under 28.46. HAL, which is now moving sideways after a decent correction, is a buying opportunity with a stop under 43.22. I don't have to tell you the context in which defense stocks may outperform. ICICI General Insurance is an intraday short with a stop above 22.92. And Jubilant Foods is an intraday short with a stop above 704. So it's a mix, 2 buys, 2 sells. And position traders can easily focus on the buys.
Okay, got it. Mitesh, what about you?
So I also have a mix of buys and sells and on the buying side, a couple of fertilizer names. I think that's one sector which is showing strength. So Chambal Fertilizers on a mild decline or a pullback, let's say around 540, 538, buy with a stop at 528. Possibility that the stock could do 560 here, and GNFC is a buy with a stop at 684 for targets of 730. On the selling side is Airtel with a stop at 1720. Look for a corrective decline to about levels of 1640, and Dabur is a sell with a stop at 627 for targets of 595.
Gentlemen, since we have you with us, and I think we'll have Chandan also joining in, Chandan Daparia from Motilal Oswal in just a bit. Before we let you go, just wanted to get your quick 30-second take on the fact that we're moving to a very different F&O regime, tighter norms, higher extreme loss margins, fewer number of expiries per week. Just quick thoughts on whether this hits sentiment or volumes or what really happens now from the 20th of November. Sudarshan?
Well, I think it'll hit sentiment very badly because stocks options will become untradeable. They'll be valued in lakhs of rupees. So we just see how much of a sentiment hit it will be, but it will be.
And Mitesh, your take?
This is on, sorry?
On the new F&O norms, Mitesh, from the 20th of November, we moved to a new regime, tighter regime.
That's right. So in fact, to me, it is a good step. I think, you should have some capital before exposing yourself to the derivative segment. And I think that's a decent requirement of one, increasing the margin requirement and the margin collection norms which have changed. And two, I think, also the increasing the contract size. I think both of them should be actually good and progressive steps. Let's see how it plays out because that's very difficult for me to comment upon. But to me, it prima facie looks like a positive step.
It's a positive step for overall market stability. All right. That's Mitesh's view. Thanks very much, folks. We'll come back to you a little closer towards the market opening. Chandan Daparia, like I said, is also with us for the usual F&O picks. But Chandan, before we talk about the picks, big news. It's finally come through. And I think we'll just put up the graphics as well. A lot of sort of tightening is happening, right? First of all, the number of expiries is going to go down. Then the calendar spread, that's also being taken away. I mean, rules are being tightened over there. There's going to be a monitoring of margins, I think 4 times in a day now. So lots of steps. Your thoughts on what the market impact could be over the next couple of days till the rules get implemented?
Good morning, Surbhi. Thanks for having me. So as per the previous proposal, they came out with the 7 measures for F&O guidelines and finally most of them implemented. And they also given the dates. But I believe whatever the regulator had decided is good for market or retail participants as a whole. But there are a few points we need to keep in mind. First, that earlier there used to be the everyday as expiry day. We actually entered into the world of everyday as expiry day, but now there will be very selective expiry. Question will be whether there will be Nifty and Sensex. If Bank Nifty weekly expiry doesn't happen, then it will be on monthly. But in NSE, highest business and activities happen in the Bank Nifty. So we need to change the automation and algo product accordingly. And I believe the most of the algos will change their ticket size, drawdown, and modus operandi. Talking about the retail participations, as your contract value increase, so participants has to go in deep OTM strike with the view to lose less. But again, if they enter into the deep OTM, there will be comparative lesser probability to make money in the market. Again, new norms of margin tightening and they have avoid the calendar spread benefits. But I believe as a whole, the market will try to absorb all the guidelines and slow and steady market will be in a healthy side. But yes, as of now, slightly negative on the sentiment point of view. But I believe that is good for the Indian market as a whole for long term because in Indian market, the derivatives turnover has gone 400 times than the cash market. And that is the highest in the entire world. Now looking at the specific,
Yeah, absolutely. So, Prashant, actually, you were tracking this from, the time it came on Tuesday, right? I don't think the exchanges have come out with anything. I think that's the question he asked. Is it going to be Bank Nifty or Nifty? What will be the weekly product? That's the big question, right?
So there was some confusion because they said that they can choose, but they also said benchmark.
Okay.
So benchmark typically would mean Nifty. And the case of BSE, it would mean Sensex. But they also said choose. So there was some confusion, but we checked. And there is actually, they can choose. I mean, the SEBI does not really, they're saying, well, they can choose Nifty or the
any
bank.
Index.
Either of the two. But there is one view that if they choose, actually, logically, they should choose Bank Nifty. But because they choose the Nifty, the BSE BankX is going to eat their lunch. But we'll see. The point is, for many, it is the fact that they will sort of stick to Nifty, but the exchange needs to say, as Chandan was also saying. Chandan, quickly your trades and your sort of strategy for today.
Yeah, thanks, Prashant. Nice point you highlighted. So talking about the Nifty index started to form lower top, lower bottom on daily and hourly scale from last 2-3 trading session. It negated the positive stance and seen the negative crossover on most of the mechanical indicator due to the weakness in the global market. So we may open on a negative note until Nifty holds below 26,000 zone. Some more profit booking could be seen towards next key support of 25,500 and 25,333, which is 50% and 68.1% retracement. Now looking at the bank Nifty, here also we have witnessed some bearish divergence. So some more decline could be seen till it holds below 53,357. Profit booking could be seen towards 52,000 to 51,750 marks. Now looking at the stock specific, first that is buy on HCL Tech. We believe that selective IT counters are likely to do well. Major setup of the counter is positive and HCL Tech has seen the buying interest. We have seen a better rollover, which also indicate the bullish stance. So with support of 1780, one can look for an upside target towards 1900 in HCL Tech. Second trading idea, that is buy on Chambal Fertilizer. The stock has been making high tops, high bottom from last 6-7 trading session. It has surpassed a falling supply trend line and holding the current zone after a long consolidative move of previous couple of months. So one can buy with support of 540 for an upside target towards 570 level. Last trading idea, that is sell on PNB. We have negative view on most of the PSU name, and this is one of the weakest structure in the market. PNB has been making lower top, lower bottom on the weekly scale. So weakness could continue with stop loss of 109. One can sell for a downside target towards 100 level in PNB.
Okay. All right, Chandan, thanks very much for that. We'll take a very quick break. On that note, come back and we'll have the pre-opening rates as well as more guests on the other side.
Change, growth and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC TV18, your trusted partner and investment ally.
We like to stick to the fundamentals, and we won't draw first blood. But I mean, if there is a gunfight, we'll not go to it with a knife. So, one does end up participating. But having said all that, it just serves to advance the customer, the sales, but the customer expects it because that is the whole atmosphere during the festive. One participates in it. But once the dust settles down, it's back to good product, proposition, and customer care.
Let me address that constituency that you just spoke of, which is, of course, one of the most crucial constituencies, which is the regulator. And I think that is the big overhang today as far as the Kotak Mahindra Bank story is concerned, with the RBI imposing restrictions on account of deficiencies in the digital and IT infrastructure, not allowing you to onboard mobile as well as digital customers, as well as putting restrictions on your credit card business. Now,
welcome back. Well, we'll start getting the pre-open rates. Let's wait for them to settle a little bit. That's the implied open, 200 points on the lower side. And the first of the rates are kicking in. I mean, it's a 300-point dip, but let's just see how this plays out because the market's dealing with a lot. The F&O norms coming through, all the action on the holiday that we missed as well. So let's wait for it to settle. Right now, it's looking like a massive cut. Let's revisit this maybe after 5 to 7 minutes. Prakash Diwan is with us. Prakash, morning. Lots to discuss today. Let's start with Dabur, actually, because, we are all cheering the rural recovery. But here comes Dabur with a not very inspiring sort of update for the second quarter. They're saying sales might fall in mid-single digits. Your view?
Good morning, Surbhi. So I think this is quite in line with what one of the brokerages had brought out a week back, I guess. Remember, we spoke about whether there's enough juice in Dabur left because of the juices category being under stress. And that's where, the beverage category is where the management has indicated there could be softness. But, the beauty about these multi-products segment FMCG plays, and especially multi-geography, multi-segments in terms of rural and urban, is that something or the other will give way, but something or the other will actually take its place in terms of growth. So I think if there is a softness because of this, and remember, this doesn't contribute more than just barely to double digits. So it's something which could be an opportunity to load up these names. Festival season is the best time. We've had a very good monsoon all around. I don't see any reason. Input prices are fairly benign. These are opportunities to actually build a little bit of an allocation towards FMCG, especially the larger ones. And when I say larger ones, it's beyond the ITCs of the world. Whether it's Marico, whether it's Dabur, whether it's Godrej. So I think it will be an opportunity to buy because of the softness. But there could possibly be some softness given the overall market condition.
Okay, all right. Hi, Prakash. Good morning. Good to see you in as always. Well, we've got a couple of steel notes that came in today. Morgan Stanley has gone ahead. They've upgraded their estimates. The pricing estimates, they believe that spreads will improve, and also they are working with domestic pricing now at par with imported steel. So they like the steel sector, and that's why they've upgraded, and they believe it's well placed. Nomura as well has initiated coverage on two stocks, JSPL as well as JSW Steel, and they've given elevated target prices. Your view on the steel stocks?
So, good morning, Nigel. Very positive. This is on the back of non-ferrous doing well as well. Remember, the rally was kind of led by copper and aluminium and zinc, of course. But steel is now kind of coming into the party. The interesting part is if you look at data for the first half of FY25, which has just started coming out, cap goods has continued to see a lot of expansion. The kind of spending that's happening in trillions out there means that it's not something which gets over in 6 months or 3 months. You will see that follow-up happen, follow-through happen. And as we go into these 2 quarters, which are probably better than the first 2, you'll probably see steel consumption rise phenomenally. So I'm sure that the domestic demand is there to back you up. Very good headwinds from there. And the tailwinds in terms of price rationalization, given the Chinese dynamics, is also kind of going to help them. Whether you would buy an OEM or an derivative is a question. I would still believe HEG from the graphite pack is kind of looking up very smartly in terms of inventory build-up, in terms of demand. I think you'll probably get a little bit of a surprise move from there. And for the simple reason that the global setup also, everybody is wanting to demand graphite rods. So it's not something that only India is doing it, and HEG will kind of be very well poised to balance that. So I would look at something like that, but stick to non-ferrous as well. Don't ignore that, the Dalcos and Nalcos of the world. There's lots of juice left there.
Dabur, you started with juice and juice. Prakash, hi, morning. Just a quick word on, look at the market, by the way, 400-point cut, which means that right at the word go, we'll be starting below the 20-day moving average for the Nifty. So that's the Nifty. Let's look at the Nifty Bank as well. The 20-day here is 52,538. Okay, I think
we still need some time.
We have
3 minutes more.
3 minutes more, so we'll have something coming up there as well. Just look at BSE, the stock. In the pre-open session, and maybe we could look at names like Angel One, which is of course the most traded name. BSE nothing. I mean 1.5% lower on BSE. Angel is down about 2.7, and the others are Motilal Oswal and IIFL Securities and MK and a few other sort of names as well. So that's the other pack to really watch out for. Prakash, any specific thoughts on BSE? I mean, lots of debate. I was reading a note from Jefferies. They say, well, they cut their earnings estimate for BSE. There are others who believe that, this would turn volumes towards BSE, and it's a big one, in a positive way. What SEBI has done in terms of having one weekly option, a weekly contract per exchange. What's your sense, BSE?
Yeah, so good morning, Prashant. So on the surface, BSE doesn't seem to be in a spot to lose much.
Yeah.
It's NSE that would be worried. And you know, as the F&O segment activity starts phasing out a lot of the smaller players, there could be a propensity to move to micro caps, which are predominantly listed on the BSE. You know, but I'm not saying, you know, those penny stocks that people like to do and start kind of having wishful, you know, trades on. It's not something which will last long. Can I build that into the BSE revenue model? The answer is not really. So what's going to help the BSE is general organic growth of demat accounts, of activity, the kind of IPOs that are coming, Prashant. I mean, I think BSE, we don't realize, but BSE benefits equally whenever, you know, there's new paper that comes into the market. And some of these exchange fees structures are such that the more activity in the IPO market has an accelerated return profile. So I would believe there will be growth. Now, whether at 3,800, 4,000, is it worth buying into it from a valuation perspective is the key question. I would believe a softer valuation will give you better risk reward. And the market is in such a condition that state that it is vulnerable to corrections. So if there is a correction, you will probably see 10, 15% come off very easily. So build it for the long term into your portfolio, but I'll be, you know, at a lower level so that at least you can be comfortable holding it for a slightly longer term.
So your shopping list is ready, and BSE is one of the names perhaps on it. It's a question of when to go shopping, right, when that correction comes. Prakash, stay on. In fact, let's bring in Vamakshi because she's detailing out all the changes that have happened and, of course, what the view is on the street. What are brokerages making of this? What will be the impact on listed stocks like BSE? Vamakshi, fill us in.
Well, absolutely. The first measure that has been announced is limiting weekly expiries to one benchmark per exchange. Now, this is expected to have the highest impact among all the measures, but the impact is expected to be relatively higher for NSE given that it has 4 weekly expiries as compared to 2 expiries for BSE. IIFL Securities has quantified the impact. They expect a 35 to 40% impact on NSE option premium turnover as compared to 15 to 20% in case of BSE. Earnings impact, however, is expected to be lower on account of shift to the flat tariff structure. They are estimating a 15 to 20% hit on NSE FY26 EPS and 5 to 7% for BSE. The other measure that they've announced is increase in minimum contract size for index derivatives to 15 to 20 lakh rupees from 5 to 10 lakh. This hike is lower as compared to what was proposed in the discussion paper. The third measure is additional extreme loss margin ELM of almost 2% on short options contract on expiry. Keep in mind that 8% was proposed in the discussion paper. So again, this is lower than what was proposed earlier. The other 3 measures could have a larger impact on institutional players, and this includes upfront collection of option premium as well as removal of calendar spread treatment on expiry day, and both of these measures will be implemented from February 1st, 2025. And the last measure that they've announced is intraday monitoring of position limits for index derivatives, and this will be implemented on April 1st, 2025. We have a note coming in from Jefferies which highlights the impact on market players. They expect the impact to be divergent. Retail-focused discount brokers, which includes the likes of Zerodha, Angel One, 5 Paisa Capital, are likely to be most impacted, followed by exchanges, which includes NSE and BSE. The impact for traditional brokers, however, is expected to be relatively lower, which includes IIFL Securities, ICICI Securities, and several others. AMC's wealth managers and depositories, however, will remain largely unaffected in Jefferies' opinions. Overall, Kotak believes that the regulatory overhang is now behind us. There are no fresh negatives, and therefore the market may look at it positively.
Okay, pretty comprehensive and quick. Vamakshi, thank you very much for that. Rajesh Baheti is with us now as well of Crosseys Capital. Rajesh, 6 minutes, 5 minutes to open, market open. So this will have to be a rapid fire. First of all, your view whether this will direct volumes to BSE and whether this is a long-term positive for BSE.
So it depends actually if the regulator is a little silent on what SEBI considers to be the benchmark index.
A bit of
then for any
let's just Rajesh, sorry, apologies if you can hear me. The line's a bit patchy. We're just going to come back to you in a few seconds as soon as we are able to fix that line. We've got the pre-open and just 5 minutes to go, actually, counting down to the market opening. And it's down 344 points. So we are basically going to start 50 points below the 20-day on the Nifty. It'd be interesting. The Bank Nifty, I think, also perhaps below the 20-day as well. The 20-day for the Nifty Bank is 52,540, and we're going to start at about 52,300 or so. Actually, it's a culmination of things altogether. From Tuesday close, Middle East, the F&O norms, not exactly positive cues from corporate earnings previews as well, especially Dabur, which is a bit of a shocker. We should actually have the Dabur stock as well.
Down
Take a look at
6.5% now, so that's a nasty cut. Actually, even on the large cap screen, the fall is all over. L&T, Reliance, you name it. Bank Nifty is anyway down 1%. A lot of auto stocks are continuing to cool off. That was a trend we saw in the earlier part of the week. Bajaj Auto, Tata Motors, many of these stocks negative. ONGC, for obvious reasons, is the one green tick that we are getting right now. Let me watch out for Oil India. Likewise. So it's a very obvious trade. The beneficiaries with this bounce, tactical bounce maybe in oil prices. So these are the little green spots that we have.
Okay. Rajesh, we'll have you back later for a longer chat. But just a quick word on BSE, you were saying. Rajesh, go on if you can hear me.
Yeah. It depends what SEBI considers a benchmark index. Now, if NSE is allowed to retain the Bank Nifty as a weekly contract...
They're allowed to retain. They're allowed to retain, Rajesh. They can, if they choose to.
Then my suggestion to the NSE would be to retain the Bank Nifty as a weekly contract and move the Nifty to the monthlies. I think that would mitigate some of the losses we are talking about in terms of volumes for the NSE. Because clearly the day trading and market making and the weekly of the Bank Nifty is far more lucrative, both for the trader's point of view as well as the NSE's point of view. If that were to happen, then I think the losses can be contained at 15 to 20%. But if they decide to retain the Nifty, then I'm afraid, we're looking at a 30-40% drawdown for the NSE in its earnings.
But I mean, if this is so stark and clear, then they would go with the Nifty Bank, right, Rajesh?
I mean, it just depends on what the thinking of the board of directors of NSE would be, because the Nifty is like a globally quoted index. The Bank Nifty is more of a regional sectoral index. It just depends on what they think should be their flagship contract. Although I think the Nifties and the monthlies has always been there, and it has done reasonably well throughout its life of 20 plus years. The Bank Nifty was a relatively newer contract because of the volatility. It attracted the weeklies a lot more than the Nifty. So if they were to play only going by revenue, then I think they should choose the Bank Nifty. If there are other considerations, then I don't know.
Rajesh, you mentioned 15 to 20% loss. I mean, you were talking about the hit to NSE. Can you just repeat that point? This is going to be a drop in revenue, 15 to 20%?
Yeah, it'll be a drop in revenue for sure, to the extent of 15 to 20%, provided they keep Bank Nifty as a weekly. If they move to Nifty as a weekly, I'm looking at 35 to 40%.
Okay, all right. Anything else which stood out to you? It's largely in line with what they said they'd do.
It's largely in line with what they said they will do. One factor that might even affect the markets even more is the intraday monitoring of positions. Do remember, these position limits came into being in 2020 as a response to COVID. It was pegged at 500 crores now. With everything else, SEBI has said that the market has moved 3x since then. I think the limits ought to be revised 3x. If we go by that same logic. And if it's kept at 500 crores, then I'm afraid it will be quite stifling for brokers to manage that on an intraday basis.
I think they are. Rajesh, thank you for joining us. I think they are going to be revised. The way that those are calculated, perhaps, will come up for reconsideration. We got the market open. It's a 1% cut straight up. 0.8%, 25,590 is where the Nifty is at. So it's not as bad as what the GIFT Nifty or the pre-open was indicating. It's 200 down though. The Nifty Bank is down about 1%, 52,400 on the Bank Nifty. You've got the Sensex, which is down about 700, 83,560. The IT Services Index is once again down about 0.6. A complete flip-flop. Friday down sharply. Monday down sharply. Tuesday up sharply. And today it's down sharply once again. Look at the heat map on the Nifty. It's largely all down. Just about 5 names on the Nifty up in the green, everything else starting down in the red. So we are starting, I think there was a bit of a swoon to the 20-day, but now we are above the 20-day moving average, which is about 25,500 or so. That's the 25,505 is the 20-day moving average. So we're trading above it for now. The Nifty Bank, 52,400. That is about 100 points below the 20-day on the Nifty Bank so far.
Yeah, so the day's low, just to revisit that level, was 25,451. From there, there's a decent sort of a recovery, but it's really moving all over the place right now. Let's talk about where the weakness is. The worst of it is seen in the auto names, Eicher Motors, M&M, and this is despite Eicher coming out with good numbers, by the way. Even Hero's numbers didn't look that bad, the monthly sales numbers, but the market's dealing with very different sort of sentiment at this point in time. Big cuts on M&M, Eicher, even Tata Consumer, Asian P&C stocks have not been spared. Obviously, there's a crude corollary impact as well on the stocks like Asian Paints. Tata Consumer is down, Lever is also down, Nestle. So if you thought FMCG could be a bit of a safe haven, it's not turning out to be that way, at least right now. Then you have the big boys, ICICI Bank, L&T, Reliance. They're not helping the Nifty's cause, at least as of now at all. All of these stocks are down over 1%. The only thing that's working is commodities to some extent. So metals are being bought. The dips on metals are being bought. Nigel mentioned the point on steel as well. So JSW Steel 2.5% up. There's some buying on Tata Steel as well. ONGC, like we pointed out in the pre-open, with the flare in oil, people are gravitating towards ONGC. Not so much on Oil India. Oil India is actually starting quite negative, down 1.5%. Speaking of the oil-related plays, let's pull up BPCL, IOCL, HPCL, down about 2-3%. But remember, the narrative has shifted very, very dramatically on oil marketing companies. And we'll get to that with our guest a little later. From talking about a windfall gain because oil prices crashed in September to now talking about geopolitics and a revival in oil prices. It's really moving all over for the likes of IOC and BPCL.
Well, that's right. Bazaar Style, that's a stock that's actually flying away in today's trading session. So I think they had put out an update out there. And, that stock, in fact, is up and about in today's trading session. Bazaar Style Retail, I think that's the new listing out there. So that one's higher. Suzlon, that's seen some profit taking. It's down closer on 3% as we speak. Geo Financial as well is a little bit lower. These are some of the top volume movers. You have Tata Motors as well, that's down close on 2%. And big boy Reliance Industries. We've been making this point that it was underperforming a little bit, but as we speak, well, that stock as well, it's down below that 2,900 odd mark. That needs to be the swing factor, needs to find its form from a bullish perspective. So that's about that. One crucial point though, on the Nifty as well as the Nifty Bank, we started below the 20 DMA, but as we speak, both those two averages now, indices have moved above the averages. So that's good news as well. So just keep an eye out on that. And BSE Limited, clearly with these regulations that have come about, they stand to gain more than NSE. So after opening up with a cut of around 1.5%, the street is now penciling in that market share will start moving to BSE. And they are better placed in comparison to NSE. So explains why the stock is quickly up 4% from the low point of the day. Marico as well had started in the red. That's done a U-turn. That stock is up close to around 2% odd. So we're down, but I don't think we're out as of now. 20 DMA by the end of today. The bulls will like to see a close around that mark.
No, absolutely, and we'll see how it goes. But, what we were discussing earlier, right? BSE, that's now up 4%. Although I think the debate will continue, right? I mean, there is a lot of thinking what NSE will do. I mean, will NSE do something to, can it protect its share of the market on the option side? There is, of course, this thing between Nifty Bank, Nifty. Rajesh Baheti telling us that the hit will be much lesser if they choose the Nifty Bank. And they're allowed to do it. So that we'll see if that is the thing. But can they do something else? There was some talk whether, they can introduce fortnightly options. Well, guess what? It's not allowed. Only weeklies and monthlies. There was some talk that maybe they can stagger, the monthly expiries on various products, right? But all of this will need to go back to the regulator, and they will need to come back and say, well, this is okay, that is not okay. So we'll have to see. And of course, I mean, the response of what BSE will do will determine how much share of the market and BSE you can gain. So for now, it's up about 4% higher at this stage. What else? You've got Angel One, which is the #1 volume-led loser right now, but the cut is not much. Beg your pardon, it's Dabur. Dabur with a 5% cut is the #1 volume-led loser. Number 2 is Angel One with a 2% cut. Varun Beverages is down about 2%. Hindus HPCL is down 4%. As Surbhi was saying earlier, IOC and BP perhaps should also be there. Nuvama is down 3%. So these wealth managers, right? That's the other one. So 6,300 on Nuvama. Edelweiss Limited is down about 4.5%, but It's seen a very sharp rally recently. KEC is down about 2 3/4%. 361, which is another wealth management firm, is down about 4% or so. There is Medi Assist, which is down about 3% or so as well. So there is a fair bit happening as far as overall markets are concerned. Market sort of advanced decline is slam dunk in favor of declines. So about 1,800, 1,900 stocks are down, and about 400 stocks are higher at this point in time.
You know, I was just looking at BSE, Prashant. It's remarkable the way the market's now buying into it. And BSE, by the way, through all the volatility and all the chatter, is practically at the 52-week high. So I guess the whole expectation and hope that ultimately whatever happens, whatever contract the NSE chooses, from 4 they're down to 1. So that should kind of limit their gains and, be good for BSE in the longer term, right?
Incrementally, it is positive. I
mean,
think about it like this, right? I mean, most people do something every day on the NSE,
yeah.
right? Now, if they do something every day on the BSE,
yeah.
I mean, there is a bit of a network effect, right? You will start doing something in the cash side. You will start doing something somewhere else. So it's essentially familiarity and doing something on one exchange, which was NSE so far. And will that change habitually to the BSE?
Yeah.
That's the question, which we don't have answers to, but I think...
But in terms of, I think, product offerings for the first time in I don't know how long, it's pretty much like a level playing field now, because you can't do more than one product per week, right?
Yeah, absolutely. Yeah. And, we'll have to track this one, probably invite the exchanges over as well and ask them, right? I mean, how they view this, if they want to really talk, and we're trying that. But for now, it's about 2.25% higher on the day for a BSE. Yogesh Patil is with us, Chief Investment Officer, Equity at LIC Mutual Fund. Yogesh, good to have you with us here. Thank you very much. Market's down 200. And of course, from the all-time highs, this is a pullback underway, but still a lot of debate whether this is a quick one or there is more here. Would you be a buyer here, Yogesh, or would you let markets consolidate, go sideways, some time correction? What's the sense?
Good morning, everyone. It's a lot depend on the valuations basically and earning growth. Today there will be temporary setbacks and like in past, but again fundamental will continue to drive the stock specific and sector specific approach. Till now, I completely agree. We reached a valuation point where earning need to perform here, and either earning growth or outlook on earning growth. Because what drives the broader market is basically liquidity, valuations, and earning growth. So valuations have reached the optimal level, liquidity is there, but today earning growth is lagging. So it's a completely sector-specific approach. Maybe we can ignore short-term event global issues, which is temporary in nature. But again, coming to your point, when we make an investment decision, is completely based on so many parameters that includes your interest rates and economic environment and growth available in the sector, basically. If you ask me, today, considering the bond valuation, equity valuations are actually fairly valued. The only thing drive from here is earning growth. If you get earning growth, then only you get a returns from here. So everything is depend on earning growth and sector outlook from here.
Hi Yogesh, good morning. Good to see you in. So what kind of earnings growth are you penciling in? Most on the street are in mid-teens for the next few years. Do you think that we'll get that?
Yeah, for Nifty, we are expecting roughly double-digit earning growth. But if you see the higher earning growth, we are expecting mid and small cap, where the most of the industry leaders are there. And the kind of capex we see, especially in power, data center, railways, defense, oil and gas, where 90% of our leaders are only available in small and mid cap. So we see higher earning growth in small cap because of the capex drive, and there are a lot of changes happened globally. And because of China plus one supply diversification, Indian companies are getting much more business traction, and their addressable market has increased compared to last 5 years. So because of this traction, the earning growth could be higher, and more traction could be in small and mid cap compared to large caps.
Yogesh, I wanted to ask you about these capital market plays. That's been where the big party has been, right? You've seen the only listed exchange, BSE. Even in the unlisted market, you have NSE that's done very, very well. Brokerage firms have done well. Depositories have done well. What's your view currently? Because the equity cult in India will continue to grow from here on. Though some of these stocks have run a little bit ahead of themselves in terms of valuations. Your take?
I completely agree. But we need to also understand, okay, this segment is growing, right? And one should not only look the historical valuations or growth rate of sector. Look at the demat accounts, look at the mutual fund SIPs, and look at the awareness nowadays is very much. In fact, if you ask me, considering the F&O volume as a percentage of the cash market, we are actually much more matured now. The only thing is regular, we need to set some discipline so this sector will continue to grow, and most of the investors should look for long term rather than a trader mindset. And there could be a, again, lull period or maybe negative period for some time, but structurally India is heading for a good growth in economy as well as fundamentally, and that will reflect in capital market and participants.
So you'll continue to be bullish on this theme then?
Yeah.
Okay. And which, sorry, and which segment, Yogesh, are you? Do you have exposure to without naming names?
Sorry, can't explain. It is a combination of direct, indirect exchanges and broking houses.
Broking houses, got it. No, fair enough. You know, Yogesh, we got numbers. You would have now seen numbers from Dabur, right? It's a bit of a shocker. So what's your view on FMCG? I mean, do you think even two-wheeler sales? I mean, the auto sales for the last month, which came through, it showed a bit of a spike, but looks like there was a fair bit of channel stuffing ahead of the festive season. Actually, if you look at the last, say, 6-7 months, the difference between retail sales and wholesale sales, it's actually quite wide, which means that there is a lot of inventory now in the system. So the next couple of months, perhaps sales numbers drop off. The local market, the India market, not exports. So just your overall view on consumers out there.
Yeah, you're absolutely right in terms of inventory. But again, for let's take automobiles, especially Q2 and Q3, it is because of a lot of changes in festival dates. We should look exactly quarter versus quarter. But I completely agree what's happening, and we need to monitor next 15-20 days. But we should keep a quarterly approach, and especially on FMCG side, we do see some improvement in rural and urban consumption based on so many factors that includes your favorable monsoon, government measures, and increasing wage rates. So last 4 quarter was not very good, and today inflation is coming back, and again growth in rurals or rural wages also coming up. So we expect some positivity in consumer business, including discretionary and non-discretionary. And at the same time, automobiles, we need to again monitor for 15-20 days would be very crucial for this sector. And we should only take a decision based on quarter, not on month, because month on month is keep changing based on monsoon, based on festivals.
Okay. Yogesh, finally, what is your take on the oil and gas space? Because there's so much going around, oil marketing companies or even upstream companies like ONGC. I mean, how do you take exposure to the energy space, and what's the stance on it? Do you like it at all?
Yeah, definitely. We cannot ignore this space. But again, we would be positive on basically retail companies or maybe gas company compared to a crude company. Because we do, our internal assessment is there would be a oversupply in gas and crude oil for next after maybe 1 or 2 years. So India could be beneficiary. Both are we are importing, and that's why we are more positive on distribution side and retailing side here rather than we see the core commodity like crude oil and gas.
All right, Yogesh, thanks a lot for joining in and filling us in with your take on the markets. Wishing you a good day ahead. Well, let's move on. Let's connect with the management of NLC India. India's new national electricity plan aims to meet the peak demand of around 458 gigawatt by 2032. So what are the opportunities lined up for the power and the renewable companies? How is business momentum shaping up? To discuss this and more, we're joined by Mr. Prasanna Kumar Motupalli, the Chairman and Managing Director of the company. Hi, sir. Good morning. Always good to see you, Ben. Tell us with regard to this new electricity plan that's been laid out. What kind of opportunities does it throw up for a company like yours?
Yes, this new electricity plan, that is 2020 to 32, That is envisaging demand increase of almost 7 to 8% up to 2031-32, and then subsequently 5.76% for the next years. And in all the three areas, there is certainly encouraging initiatives are there in thermal power generation, overall power generation, transmission and distribution. In thermal capacity addition, compared to current capacity of 4.59 lakh megawatt capacity, it is expected that the total capacity will reach to almost 9 lakh gigawatt by 2032. So, and in the transmission system also, many transmission corridors are coming for evacuation of the renewable power. Both these things are giving an opportunity to our company. As we are into mining, we are into thermal power generation, also we are into the renewables. So in line with the National Electricity Plan, we are also targeting huge capacity addition. As on date, our company is 6 gigawatt company. We are targeting to become a 20 gigawatt company by 2030 and around 22 gigawatt by 2032. So in line with
Sir, just if I could interject, please, to get more clarity on this target of 20 gigawatts by FY30. How much is going to be traditional thermal and how much is it going to be by renewables? What is the plan on the generation side and on the renewable side in particular?
Madam, as on date, our total capacity is 6 gigawatt. Out of that, 1.4 gigawatt is renewables. So we are at 24% of renewable capacity as on date. So by 2030, we are targeting to become 20 gigawatt company, 10 gigawatt conventional capacity and 10 gigawatt renewable capacity. So our proportion of renewables will be more than 50% by 2030. That is our target capacity addition.
Okay, that's quite interesting. And also just to get the math right, I mean, between generation and the main business, which is mining, lignite and coal, what is going to be the mix again by, let's say, 2030, since power generation is growing in a big way for you?
Yes, madam. In line, along with the power capacity addition, we are targeting for increasing our mining capacity also almost double. As on date, we are around 50 million metric ton company, 30 million metric ton lignite and 20 million metric ton coal. This we want to take to 100 million metric ton by 2030. And all actions for reaching this 100 million metric tons are on. Recently, we got the Machakata coal mine, which is having huge reserves of 1.4 billion and 30 million metric ton capacity. So along with the power generation and renewable capacity addition, we are targeting to increase our mining capacity to almost double the current capacity.
So, sir, you know, the reason I ask you this, because if we look at some of the brokerages on the street and the ones that are quite optimistic on NLC India, one such broker says that over the course of the next 2 to 3 years, FY24 all the way up to FY27, they are expecting you to do a top-line growth of 15% across businesses, blended top-line growth of 15%, and an EBITDA CAGR of 20%, and also PAT also growing at 20%. So 50% top line, 20% at EBITDA, and 20% profits for the next 2-3 years. Is this possible? Is it a reasonable expectation to have?
Yes, madam. That is a reasonable expectation. We are also targeting more than that. So our top line, our EBITDA, and our PAT all will increase at a good rate till 2030-32.
Rate, sir, you said you will do better than what some of these brokers are saying. What is the target you are setting for the company? The growth rate?
Madam, we are not setting any target for the top line or this thing. We are targeting mainly the capacity addition aggressively in both conventional as well as renewable capacity. And we are also increasing our mining capacity. So we expect returns more than 16% and increase at the CAGR of around 15%.
Okay, all right. So for a company like yours, regulated equity is very important, right? So could you tell us what it is right now and how do you see it moving up? A brokerage note is suggesting that you can move to around 19,000 crore by the end of this decade. Your take?
Yes, as you rightly said, ours is mainly in regulated business. And as on date, we are having regulated equity of around 7,800 crores. Where in the mining sector, we get return of 14% post-tax, and in thermal power generation, 15.5% post-tax. So going forward, we are targeting to increase this share to 23,000 crores by 2030. So in next 1 year period, this will be increased by around 4,000 crores. We will reach around 11,000 crores regulated equity in 1 year, because our Ghatampur thermal power station as well as our Pachwara South coal block, both are will be operational, and that regulated equity gets added to our regulated equity. So end up in 1 year, it will be increasing to 11,000 crores and 23,000 crores by 2030. That is our target.
No, in 1 year, when you say, sir, it will touch 11,000 crores and Ghatampur will come on stream, that's this year, FY25 by March?
Yes, FY25 March or by the first half of the next financial year. The entire capacity will be added.
Okay, so 11,000 crores, let's say by first half of FY26 would be the sort of the fair assumption. Got it. Sir, just to talk about more about the here and now, we've spoken a lot about the FY30 targets. Our colleague tells us that, there were some issues in terms of land acquisition for some of the mines at Navili. So could you tell us what the status is over there, and what is the recovery in the business that you will envisage? By when do these issues go away?
Madam, in the year 23-24, first half of the financial year, we faced problems because of the land acquisition. There were some communication gap, and because of that, some land acquisition issues were there. And our thermal power generation, lignite production, both were getting affected. But in the middle, by December of last financial year, we completely addressed all these issues. Whatever the problems were there, there was one river which was required to be diverted. We diverted that river, and subsequently we have taken around 560 hectares of land into our possession. So from January 2024 onwards, our lignite production as well as the generation are at peak, and there is no generation loss on account of lignite shortage. So all the issues of land acquisitions are sorted out, and we expect that there will not be any problem because of land acquisition and subsequently lignite generation and power production.
Okay, all right. Very quickly, before we let you go, sir, you have given us a broader timeline, targets. Coal production for this year, I think you were targeting around 16 million tons, and I think lignite was at around 24 million tons. Both those two are on course?
Yes. Last year we produced all-time highest ever coal and lignite, that is 36 million metric ton. This time, as you rightly said, we are targeting 16 million metric ton of coal and around 25 million metric ton of lignite, and we are on course, and the production is happening in line with our targets.
All right, and very quickly, that IPO, last time around you had briefly hinted that the IPO could be due of the renewable portfolio. By Q4 of this year, markets are quite buoyant and they like this story. You think you'll come to the market with that offer?
Exactly. As on date, the process of transfer of our renewable shares to our newly formed subsidiary, NIRL, is in progress. And we are expecting that to be completed by the end of this calendar year. So we expect that in the last quarter of this financial year or the first quarter of the next financial year, this IPO will come.
Navily Renewables IPO could come either in Q4 of FY25 or first quarter of FY26, right?
Exactly.
Okay, so we'll have NTPC Renewables and Navily Renewables. It is the era of green energy. Got it, sir. Thank you so much for joining in and to get that perspective as well. Really appreciate it. Thanks so much. So there's so much changing, right? So much underway that traditionally what we're seeing as dirty businesses, coal mining, lignite mining, thermal power generation, they're all trying to change and look at the energy transition. Speaking of energy, that is the big global headline as well, right? As we start our next conversation, let's actually pull up, crude oil prices. Last I checked, there was a minor sort of 0.5% kind of a move that was still visible. So basically, the Middle East situation has taken Brent at least back towards 75. That's where we are at this point in time. Now, what does this mean for the entire oil and gas complex here in India? We have Mr. M.K. Surana with us, as well as I think Prabal is also with us, Prabal Sen joining in to give us some perspective. Mr. Surana, thanks very much for joining in, and Prabal, good to have you on. If I could actually start with Prabal, because we were looking at some very different numbers till I think Monday. Prabal, the word on the street was the kind of windfall gain that oil marketing companies are sitting on because oil prices crashed in September, right? I think I saw an ICRA note saying that on the marketing side, maybe they're looking at a 15% boost in profitability. Now, where were you on that debate in terms of the cushion that OMCs had, and now we're in a very uncertain territory? So what happens now?
No, I think both the things I think have to be looked in perspective. At the time that the marketing was making remarkably strong profits, which is most of September, once the crude prices, sort of reversed to somewhere around $70 to $72 levels. At the same time, refining margins have obviously seen a steep downturn. So, if you look at Singapore margins, they have been pretty much flattish at somewhere between $2 to $2.50 a barrel. And that means that, on an integrated level, while margins are certainly strong, but, typically, if I look at consensus and our estimates, integrated margins, say for HPCL, those estimates are basically around 6.5 rupees a litre. Those numbers are still, prevalent at more than 7.5 rupees. So to that extent, it was obviously still a comfortable situation. Right now, what was the fear earlier was that there could be a price cut in terms of retail fuel prices, and to what extent can the OMCs absorb it? Our sense was earlier at about $70, $71, a 3 to 4 rupee price increase could have been easily absorbed without impacting earnings below, what the street was already factoring in. Now, of course, crude, at this level, let me absolutely clarify that crude is still at a very comfortable level. The reaction that you see is more around the fear of what happens if this conflict escalates and crude prices basically go on a one-way tear back to $80, $85 levels. At this point of time, I think margins, earnings at $75 are not a concern at all.
Not a concern. Got it. So just for clarity, on up till Monday, what is the kind of fuel price cut you would have perhaps penciled in and the companies could have digested as well, given the comfort on the marketing margin side? And now, are you completely ruling out the possibility of any cut at the pump?
No, I am not. I don't have the foresight or the capability to rule out anything. All I can say is that till let's say a couple of days ago, I think anything around 3 to 4 rupees should have been comfortable because the marketing margins on retail fuels, as per our calculations, were close to about 10 to 11 rupees, and they needed margins to be at 5 to 6 rupees to offset the fact that GRMs are basically about $3 lower than what they would have been in a normalized environment. Now, again, I think they will probably take a call, and Surana sir is there, so I won't want to say too much on how the thought process works, but they will probably look at this situation for a while before taking a decision.
All right. Gentlemen, morning. Prashant here. Mr. Surana, good to see you back on the channel after a while. Appreciate you joining us. So, this price cut, whether it'll be a price cut or I was thinking maybe price cut, I don't know, but excise hike, maybe yes. Because the logic would have been if you cut prices, maybe states will undo that by increasing VAT, etc. I don't know. If you can comment on this, I think Prabal also wants you to. So what's the sense? What should we expect?
Okay, so I think Prabal and you had made already a broader commentary, and that is very much true in the sense that what was the situation, let's say 3 days back, is different today when the crude price again jumped up because of the some sort of tension in the Middle East. And I had been telling always that people tend to take a one-sided view that whenever there is a fall in the crude price, we should cut the price. But when it is going up, probably there is a clamor against that the prices are too high. But we cannot have the one-sided view, and actually we need to account for both. So when the prices were high, the prices were not increased. So when there are prices, we have to absorb the under recovery which are there earlier. And therefore, I think we should be appreciating that fact that when the crude prices goes down, there will be a period when the prices cannot be reduced. Now, there are two issues that we need to see the marketing companies or OMCs as an integrated margin, which includes the refinery margin, which includes the marketing margin. And as Prabal has said, and you are all maybe aware, the refinery margins are quite low right now. It is in the $2.5. And the crude prices are increasing. And we also need to factor in the inventory gains and losses which will happen, especially considering that the prices are increasing after 1st October. And the prices have fallen down before 30th September. So the last quarter may have the impact of the inventory variations also. So if you ask me personally, as of today, I think even though there may be a lot of clamor for reducing the prices, I think we need to watch for some time to see that how the crude prices move, considering the tension which is developing. And second thing is that also considering the future elections, the possibility of increasing, if it is reduced, will be limited. The third part is that the taxation part, you have rightly mentioned that if the central government reduces the taxes and the state government increase the taxes, the customer is not getting a benefit of it. And it is only a transfer of the revenues from, let's say, central level to the state level without any benefit to the consumer. But in the whole process, the pressure remains on oil companies. So I would say that it's a time to watch before we take a call on reducing the prices.
Okay, all right. Hi, Mr. Surana. Good morning. Good to see you. Well, how do OMCs manage their inventory, the raw material supplies basically, in times of issues in West Asia? Crude prices have now surged. Does it impact supplies immediately?
So the question is, it is not that what you need the crude today, you're ordering today. So at least a month back, that would have been booked. And normally there are different terms depending on the payment, whether it is 30 days, whether it is on the lading date, or what it is, N+1 month, N-1 month, depending on the risk management policies which the company will have, or it may be a mix of all this, and also whether the companies are hedging. So what will be the impact in terms of the ultimate impact on the companies in terms of the price variation, that depends on a combination of it, in addition to the base pricing of the crude.
I wanted to comment on this rights issue for IOC, Mr. Surana. That's been withdrawn. The government is not putting money in OMC as promised. Your view?
I think IOC should be okay with it, because when in the oil companies are able to generate the money even from the debt market in a much comfortable way. So why should there be need of getting the money through the equity market as of today? That was, if it is not going to the P&L, if it is going to the balance sheet side, I don't think that it makes sense. So I think IOC should be okay not getting it now.
Okay, very, very quickly, Prabal, since we have you with us, what's the advice at a stock level, considering this is going all over the place? And as you mentioned rightly, I mean, refining margins are also under pressure. Oil and gas, at least with the next 6 to 12 month perspective, what stocks to be in and which ones to avoid?
No, I think we continue to sort of be structurally positive on HPCL. That view hasn't really changed. Specifically with respect to FY25, it's almost, as you rightly mentioned, it's very, very difficult to pin our earnings number down at this point of time. And the vulnerability or perceived vulnerability to marketing obviously makes it a tough call at this point of time, given the uncertainty in retail margins and crude prices. Having said that, two things that one needs to keep in mind. One, consensus earnings, which, for standalone HPCL, if you look at them today, they were already factoring in fairly low retail margins as well as subdued GRMs. So the chances of earnings down are limited at this point of time unless there is an outsized price cut, number one. Secondly, the business mix that is changing for HPCL for the next 2 to 3 years in favor of refining, if one looks at the expansions that are going on, as well as the petchem capacity that they're adding, should actually improve the businesses because the marketing dependence is going to continue to reduce. Leverage, I think, will probably continue to reduce over the next 2 to 3 years because their capex cycle is almost getting over, unlike some of their other larger peers. So to that extent, and valuations continue to remain comfortable, we would probably remain a buyer at this point of time. Having said that, the risk reward seems weighed in favor of risk for the next 6 months. That is something investors need to keep in mind.
All right. Gentlemen, we'll leave it there. Mr. Surana, great to have you back and hope we can do more of this. Appreciate you joining in. Prabal, thank you very much, as always, for running us through what you make of the situation in your stocks. HPCL, sort of structural overweight for Prabal. We'll take a break here. Markets down 170, but look at the BSE stock. which is flying. And that's the name we were discussing pre-open as well. That's, there was that indecision. It started lower, then it was about 0.5%, 1% in the green. It's up a full 7% now, 275, 276 rupees on BSE Limited at this point in time. We'll take a quick commercial break here. We'll come back. We have Ben Powell of BlackRock Investment Institute joining in on Global Markets. Stay with us.
Two 6-week periods during which the inflation rate has fallen, that can give a lead to cut the repo rate. Choice is between 25 basis points and 50 basis points. If you want to be cautious, we can cut 25 and store something for the next time. Or we can take front-loaded cut of deeper thing. There are two ways of creating competition in the system. One is really letting new private sector banks to come in. The other is privatize some of the nationalized banks or increase the private content in the national. We have now reached a stage in which we should really be able to get more banks in the private sector. So I would really say that let an atmosphere and environment be created where new private entities can enter.
We are revising 100% booking value guidance to 4,800 crore to be done in FY25. So this is in summary the response to Estate 360. We have some units remaining. That's why the total 100% booking value guidance is now 4,800 crore, of which 4,100 crore has already been booked.
Okay, welcome back. We have Ben Powell now joining us, Chief Investment Strategist for APAC at BlackRock Investment Institute. Ben, good to have you with us here. Thank you very much for your time. Let's talk about what's top of mind. Global markets have largely ignored all the fighting around the world, right? And there's a lot of fighting going on. There's Russia, Ukraine, there's stuff in the Middle East, but markets have made new all-time highs. Oil markets have been largely unaffected by all of it. Do you think, we had a one-day large reaction in oil and wicks, etc. in the US because of the Iran missiles. But do you think markets will fade these moves very quickly? Or do you think this is a little different, especially with regards to Iran and Israel? So far, the conflict looked a little coordinated, right? I mean, there'll be some attacks and the other side will attack, provide an out, some face saving for the other side. So there was some element of coordination. This seems a bit uncoordinated, if I can use that word. So could spiral. Your thoughts, Ben?
Hi, Prashant. Yeah, great to be with you. I think, unfortunately, the market is getting used to this kind of event. We've entered a much more volatile environment geopolitically over the last several years. Perhaps that's really a consequence of moving into a more multipolar world, US-China tensions and all of that. And kind of under the hood, what we're seeing is historical fault lines, pre-existing fault lines are coming back to the surface, Russia-Ukraine, Middle East and elsewhere. So sadly, I think this is likely to continue in the years ahead, and we're going to have to deal with more and more of these episodes. What that means, though, as I mentioned, is the market is becoming kind of more efficient discounting these relatively quickly and looking through them to focus on some of the other obviously very important drivers, be that Fed cutting, be that China stimulating. And for now, of course, the human situation is tragic, but from a market perspective, the market seems to be much more focused on top-line growth globally and by different economies, falling interest rates, and that combination continues to be rather positive for risk for the moment.
Ben, hi, good morning, great to have you on. You actually just preempted my next question, because the word I was going to ask you about was complacent. Are markets getting more complacent, ignoring a lot of risks, being at elevated levels? But you said, no, they're actually getting more efficient. So from here on, what would be the key triggers to track? Because your view is quite positive on US equities overall, right?
Yeah, we're pretty constructive. So for the moment, of course, as investors, we're always nervous and anxious about everything. But for the moment, we'd be more nervous about being underinvested than being overinvested. So we'd still be risk constructive, let's say. In the US in particular, of course, we have this artificial intelligence mega force, as we call it at BlackRock, the world's largest investor. And this is really continuing and actually broadening out. So we've seen a lot of the excitement so far quite reasonably has been centered around the foundational technology, the chip makers, the web services, and that's totally fine. But what we think should happen now is a broadening out of some of the excitement into more of the ecosystem, the architecture around the AI. So things like utilities, energy, materials, because for now, AI is still a technology you can stub your toe on. It still exists in the physical world, and it needs, in particular, an energy architecture to kind of feed it the calories to think it's great thoughts. So we are nuancing our AI excitement a little bit and focusing more on that broader ecosystem, critically including energy, rather than just being focused on the big seven, magnificent, no doubt, though they have been.
All right. Hi, Ben. Good morning and good to see you, Ben. This is Nigel on this side. You like the US markets, but what about an emerging market like India? As you've highlighted in your note, demographics are in our favor. Working population will be moving up. We have got earnings growth as well. But at current valuations, is that a bit of a headwind?
I think, look, there's a lot to like in India, as you guys are extremely aware. So the combination of demographic plus productivity gains, digital inclusion, infrastructure, and so forth. I think the big picture in India continues to look very, very favorable, but always there's nuance. I actually think the short-term issue is nothing really to do with India. It actually could be the gravitational pull of China. So China, as we're all aware, India has become, recently, a few weeks ago, became the biggest constituent in MSCI emerging markets, taking the crown from China. And that's great, right? We've all enjoyed that. But I do think if China is going to follow through on its stimulus promises, which we may see as soon as next week, it's quite likely that some of the money that global investors have put to work outside of China, be that in other emerging markets or other parts of Asia, probably gets pulled back into China. So I think there might be a little bit of a headwind, really nothing to do with India, but to do with global capital flows moving back into the world's second largest economy as they put their foot on the gas. So maybe a short-term kind of a challenge, again, no fault of India, but to do with China. So a short-term headwind caused by this, but again, from a bigger picture perspective, a lot to like in terms of growth dynamics, reform, and inflation context, which is radically different to where we were just a few years ago. So a lot to like.
Ben, just two questions, and if just want brief answers on these. Running out of time. One is, do you think if you look at over a period of time, when you get when China gets money, emerging market funds get money. History shows that all emerging markets get money. So is it this or that? If funds go into China, does India will it be negative for flows into India? That is one. And second, just to go back to the geopolitics, if over the next, say, 24, 48 hours, oil infrastructure in Iran, within Iran is hit, do you think it will cause ripples and asset markets around the world will react? Go on.
So on the first of these, I think it's both. If I can have my cake and eat it too, I think it is both this and that. So I think in the very short term, you might see a few buying of China funded by not China. So I think that can be a slight headwind briefly. But your broader point is the right one, which is overall, and this is why we at BlackRock are overweight emerging markets strategically, this backdrop of Fed cutting and China stimulating normally is pretty encouraging for emerging market risk writ large. So I think, yes, if the big one, I guess, China within the emerging market framework goes from really being flat on its back, right? Sentiment, positioning, and more broadly, thinking towards China has been extremely negative for the last many quarters. If that perks up, I think you're absolutely right. It should be encouraging for the broader asset class, including India, as an important part of emerging markets. On the second of your question, yeah, look, I mean, for the moment, it looks like this is a relatively, of course, we shouldn't underestimate the human element, that's for sure. But from a market perspective, I think the market is considering this to be something as unfortunately, a normal part of the mood music in the backdrop. Of course, we are all watching the escalation cycle with both eyes. And if it looks like it is starting to spiral and move to a totally different level where perhaps other powers are getting involved, then of course we would need to reassess. So let's see. It isn't that for now. If that changes, we will adjust accordingly.
All right, Ben, we'll leave it there. Good conversation. Thank you very much for joining us, and hope we are able to do this more often. Thank you. And good to have you with us here on CNBC TV18. Well, I think we'll take a quick commercial break here. We're going to come back with, I think, okay, let's just do one thing. Let's go across to Mitesh, who's with us. By the way, before I go to Mitesh, BSE is up 8%. That's the number one volume-led gainer by far. So with the, I mean, you know, it was... we were discussing this pre-open, that maybe BSE does benefit, to what degree, etc., would have to be seen. But it started 0.5%, 1% higher. From there, you know, it's moved up a full 8. And, you know, even something like an Angel One. Look at Angel One. It's the second largest volume-led gainer, and it's a complete U-turn. So it started sharply lower. The day's low on Angel One is 24.50. And the stock's now at 2,700. So that's the kind of turn we've seen here on Angel. Mitesh is with us. Mitesh, your thoughts on markets, your trades, and a quick view on BSE and Angel One. Go on.
So, Prashant, on the market, you know, we were talking about 25,450, 500 zone. We've got a low over there and managed about 100-point kind of a pullback. Just watching and hoping that this level holds. And if that, you know, does happen, then I think we might see a few days of choppy consolidation before again turning on the upside. The worry would be only if we start breaking below today's low, which is 25,450, and then we might get into a, you know, a short-term corrective mode. This still being classified as a pullback. Having said that, I think Angel One is something, you know, which I like a lot. In fact, it appears to have done a good correction from highs of 3,800 plus to about lows of 2,000, and then now is reversing on the short to medium term charts. As long as it's about 2580, I think this stock has the potential to go to a target of 3050 to begin with, and in a good case scenario, 3400 as well. So very positive setup over there. BSE I'll avoid. I don't have a very clear view. I think it's been, you know, doing very well. So it's just a good stock, but the levels and all, I think I'll hold my horses for the time being. And on my trades, JSW Steel is something, Jindal Steel is something, you know, which I would want to recommend as a short-term trading bet on the upside. Buy here with a stop at about 1,030, look for targets of 1,120. And Jubilant Foods is on the negative side, so a sell with a stop at 652 and a target of 615.
You know, Mitesh, you really read my mind as you were talking about Angel One. Just before that, I was looking at a one-year price chart, right? In the market, it's all about pricing things in. And that one-year chart tells the story of why today Angel is not, you know, reacting adversely at all. Because from 3,800 falling down to, I think, about 2,100, the stock priced on a lot of the regulatory headwinds, including flat fee structure, you know, when that was rolled out, the anticipation of these tighter F&O norms. Perhaps all of it got factored in as the stock cooled off from 3,800. And we've seen a lot of accumulation actually at lower levels in the last few weeks. That's Angel One. We'll take a very quick break, come back on the other side. Yeah, that's what I was talking about. So it's been correcting for the past many months in anticipation of these tighter norms. Now they're here. It's all done and dusted. And you move ahead. And perhaps the market still believes that overall the business growth will continue. Let's take a break on that note. We'll come back with more stocks and more news on the other side.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube.
Investing.
Welcome back. Well, some select steel names continue to do well. In Morgan Stanley, they have come out with a note. So let's address that first. They believe that the Chinese recent stimulus will drive positive sentiment and also support prices. They're saying that they're seeing lower risk of imports, and that should support spreads in the near term. The other factor that they're highlighting is there are various green shoots that are visible for the spreads in the near term at least. An important part on pricing, they're saying now the domestic prices are at par with imported steel. Earlier it was at a discount, it was a premium. Imported steel was at a discount in comparison to domestic steel, So the fear was that since Indian steel is trading at a premium, there could be a correction. But now they're highlighting that it's pretty much evened out. So that risk in terms of price cuts, that goes away. Because of all of this, they've gone ahead, they've raised their estimates in terms of pricing as well as in terms of spreads for all these companies. And they've done a U-turn on a lot of companies. For JSPL, they've upgraded the stock. Target prices moved from 970 all the way to around 1200. JSW Steel as well, they've upgraded the stock. From 895, now the target price moves to 1150. And on Tata Steel, they now upgraded it to an equal weight. The target price from 135, it's moved to around 175. And on SAIL, they still maintain the underweight stance, but they've increased the target price from around 105 to around 125. So that's about Morgan Stanley. Nomura, they've initiated coverage on two stocks. That's on JSW Steel as well as JSPL. Buy rating on both of them with the respective target prices coming up for you on the screen. The few reasons that they are citing: strong domestic demand, continued deleveraging will support Indian steel majors from now on. The cost drivers, that's what will keep cost under check and in turn improve profitability. And also they have highlighted that Chinese HRC prices, well, they have hit drop. And now from here on, they're expecting a recovery. Though they have highlighted some risk as well, they said the downside risk could be weak in domestic demand, some monetary tightening as well as expansion delays. So explains why a couple of those names are doing quite well. JSPL and JSW Steel, both of them outperforming because of this note coming in from Nomura. Just one more stock, guys, I want to highlight is ITD Cementation. In the last 30 minutes, suddenly the stock has gone up close to around 15%. The promoter entity had come out there and said they want to find a buyer. The street believes maybe that they're closer to finding that buyer as well. 15% higher on that name.
Maybe announcement around the corner. The last, of course, bit was that the Adani Group, was perhaps was leading the race to buy the promoter stake of ITD Cementation. So we will see. We had the management of KEC, who was one of the other sort of players rumored to be in the race, and we asked them, and but they sort of refused to comment whether they're still in the race or they are out. Stocks sharply up about 621 or so. Markets down about 250. It's kind of strange, right? I mean, markets taken a bit more of a dip, but broader markets are doing better. You know, lots and lots of names up 3, 4, 5% with volumes as well. I'll mention a few others in a bit. But Dabur is what we want to focus our energies back on. Stocks down sharply after the sort of earnings, the pre-earnings report. Mangalam is here with more. Mangalam.
Well, Dabur has reported a dampener in their second quarter update. The consolidated revenue for the company has actually declined in mid-single digits, and that's largely on account of two factors. One, because of unseasonal or heavy rains and flooding in some parts of the country, out-of-home consumption was impacted, and as a result of which their beverage portfolio saw a bit of a hit. But the bigger reason was they are rationalizing their inventory in general trade, and that's largely because of the big growth that we've seen in e-commerce and quick commerce in particular, and as a result of which their primary sales are down. That's something that the street is a little worried about. And because of this decline in primary sales and continued spending on marketing and advertising, the operating margins of the company too have come down from their guided 20% to mid-teens to high teens sort of number. And that's exactly what has the street worried. Remember, the stock had corrected about 10% from its highs already going into the second quarter update. But at the start of the year, the company had guided for double-digit revenue growth for the entire year as well. And in light of that, this decline of mid-single digits is something that the brokerages aren't very happy about either. Marico, on the other hand, doing extremely well in today's trading session for three reasons. One, consolidated sales have grown at high single digits with mid-single digit sort of volume growth. But importantly, the stock had underperformed because of Bangladesh tensions. And out there, the company said in the second quarter, Bangladesh business has actually shown high single digit revenue growth, telling you about the resilience of the business in that country despite internal troubles in Bangladesh itself. The margins of the company have seen a bit of a lag this time around, so that's one important trend to monitor going forward. But they reiterate double-digit revenue growth in the second half of this year and the full year as well, and that's something that is sitting well with the street.
Okay, all right. Thanks very much for that, Mangalam. Dabur definitely reeling under that impact. And with that, we actually have to take a very quick break. When we come back, it'll be time for our special segment. It's the economy. Actually, today it is full-blown Indianomics. Lata will be in conversation with a host of guests to discuss how the ongoing geopolitical tensions and macro developments in China impact the Indian market.
How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBCTV18.com.
ما يفكروا انه بس حزب الله بوجهه، كل الشعب اللبناني كله بوجهه، وان شاء الله النصر
The Iran-Israel flare-up may be shocking the world for now, but a far more sustained impact on the global economy will be the stimulus blitz announced by China's government and central bank recently. The PBOC, the People's Bank of China, announced a 20 basis point repo rate cut, but more importantly, a 50 basis point cut in reserve requirements. Now, this 50 basis of RRR cut basically gives the banks more cash, which the government intends will be used to buy government bonds. And the government is going to issue a lot more bonds. 2 trillion yuan of special sovereign bonds. This cash raised will partly be given to families who have more than one child and partly to local governments to lighten their debt and help them stimulate their economies. So is this time different? Will this stimulus work and trigger a faster growth, pull China out of its, 4-year slowdown? What are the implications for the world suffering from an onslaught of cheap products from China? I have with me economists from the 3 top global rating agencies. I have Louis Squeeze from S&P Global Ratings, Harry Murphy-Cruz from Moody's, and Jeremy Zook from Fitch Ratings. Gentlemen, thank you very much for joining me. Thank you so much for your time. Louis, if I may start with you, the China stimulus this time seems to be encouraging consumption. Are you on the verge of increasing your GDP forecast for the country? Do you think this one works?
Well, good question, Lata. We actually just published an outlook the morning before some of the announcements by the PBOC and other regulators came out. We are a little hesitant to make a big change to the outlook for the simple reason that, yes, we've had some monetary easing. Unfortunately, at the moment, monetary easing probably won't make a big dent in the economy. We're waiting for the fiscal side. And there are rumors that that is going to come, but we haven't had an announcement. So for now, we are, encouraged by what's happening. We see the authorities care about growth, which is a good sign. We are reluctant to already start to change our growth outlook.
No, I agree with you. What even I was speaking about distributing money to families seems to be sourced information. But if that indeed were to come, Louis, if we were to see, income transfers to families, as well as, some trade-ins for those who want to, those who are stuck with houses, do you think that will make you change your mind?
Well, I think, a meaningful fiscal easing, and hopefully also with some of those measures, that will make people feel more comfortable about spending, people feel more comfortable about, their access to health and education so that they will reduce their saving rate. Yeah, I think these kind of measures would really help improve confidence and probably shore up growth.
Well, let me come to you, Harry. What's your sense? 2 questions, actually. Will this help China? I mean, will it propel it to even 20 basis, 30 basis faster rate of growth? And more importantly, will that mean that China will stop being such a disinflationary force? Will it consume more steel and iron and thereby push up global prices a bit?
Well, what we're most encouraged by is exactly what you're talking about, with a focus on the consumption side of the economy. If we look at stimulus in the past, so often it's looked at infrastructure, it's looked at big building, it's looked to kind of manufacture growth in tough times. Whereas the reports that we're seeing on the fiscal side of the stimulus this time is very much trying to address the problems that are in China's economy. And at the heart of that is a household sector that isn't confident enough to spend. It's not confident in the future of the economy. And so righting that is going to be incredibly important. I think the supports that we saw last week, and certainly, the official announcements are what we're going to need to see before we really pull the trigger and start lifting our growth expectations. But from what we've seen, if we do see that fully implemented and implemented in the right ways of targeting household consumption and trying to, boost that consumer confidence, then we expect it to add around 0.2 percentage points to growth this year. So for us, that would push it to that around 5% growth target that officials have set. But also given that this spending is coming so late in the piece, and also that really I think it's a flag that there's more supports to come, well, that suggests that next year is probably going to look a little bit better as well.
Okay, well, same question to you, Jeremy. Would you agree that at least the outlook looks like China's on the right path, or are you still not convinced?
Well, I think with the latest announcements that we saw last week, we are seeing maybe a bit more of an effort to coordinate monetary and fiscal policy. And so this is quite an important signal, I think, in the authorities' willingness to try to tackle some of these issues when it comes to flagging domestic demand in the Chinese economy. Now, I think, the monetary measures that we saw last week, the big announcements there, again, we think those only have a relatively modest impact on the growth outlook. When it comes to demand for credit, it's really about the demand side rather than the price of credit. And so monetary policy at this point is somewhat limited in its scope. So the fiscal announcements that we have yet to see, I think, will be very important for our expectations of where growth will go this year and next. Already this year we've seen fiscal support running below our the expectations that came out of the budget in March. So we'll also have to assess whether the new fiscal stimulus is kind of filling in that potential gap. Or if this is kind of new fiscal stimulus, and again, how this is targeted, if it is targeted.
Okay, so basically, Jeremy, you're not convinced both about the quantity of stimulus, and also you're not convinced whether it is for income transfers and consumption. You would wait to see. Is that your thesis, much like Lewis?
Yeah, I think we have to wait on the details of the fiscal stimulus, because that is what will be most important.
Fair point. Lewis, the bigger problem that the world is grappling with China, I mean, before I come to the internals of China, is this huge disinflation that China is engendering. Because until now, they were, as all of you have said, they've been investing more in investment, in production. And since there's not enough people inside China consuming them, they've dumped it on the world. You have Indian steel companies complaining that the steel from China is $50 lower than their own production cost. Do you think this disinflation will somewhat recede because the government appears this time not to be concentrating on production?
Yeah, I think there are, of course, China exports a lot of things to a lot of countries, right? And I think there is a structural issue, and that is that, I'm sorry to say, the Chinese manufacturing sector is very competitive. And so they're able to crank out stuff at pretty low prices. Now, of course, that has been amplified by cyclical problems, cyclical issues, and the real estate downturn is the biggest one of them, of course. So if the Chinese government is able to turn the local housing market around, that would really change the dynamics on the steel market, its own steel market, and that would dampen a bit that pressure that you have from those steel companies. But I think the competitiveness of Chinese products globally won't go away, even when we have a pretty meaningful resumption of growth in China.
Okay, your thoughts, Harry? Do you expect that disinflation is going to remain as bad? Solar panels, EVs, steel, furniture, toys, will they continue to face anti-dumping duties from across the world?
That's certainly the global trend at the moment. We've seen that in the US, we've seen that through EU, we've seen that most recently in Canada and also parts of Latin America as it relates to steel. Now, those price pressures are, they're not going away. As has been said, China has very competitive domestic markets. They have invested heavily over a long period of time for those efficiencies, and there have been some subsidies that obviously have helped there as well. The better growth outlook doesn't necessarily change that for China. Yes, some of that would be absorbed, and a turnaround in the property market would certainly add to the demand for steel, which would help with prices globally. But I think that broader question as to where is the world headed with tariffs on China, if we look towards November, certainly there is a risk that things only become far greater with global tariffs than the opposite would be true.
Okay. Oh, yes. The November question I'll come to in a bit after the commercial break. But before the break, I want to get two of these big global developments out of the way. Louis, would you worry that the Red Sea flare-up can have a debilitating impact on global growth, at least in the near term, at least in 2024?
Lata, anytime we have issues in the Middle East, we see the oil prices responding, right? And we all depend on oil. So if the oil market were to really, end up with 10, 15, 20% higher oil prices, then definitely that will increase inflation in all our economies, and that will make it harder for all our central banks to continue easing their monetary policy. This is not only true for India, it's also true for the developed economies. And so this is clearly something that we all need to watch.
No, but, let me make the question stand on its head, Louis. We've had so many central banks cutting rates, a stimulus in China, a higher than expected rate cut by the Fed, fairly strong growth in India, rate cuts in Europe as well. And the Red Sea flare-up has been there. It's just gotten accentuated a little bit more. It's not that Iran is new to the war. In spite of all this, crude is just $73. It's far away from those 80s and 90s that we saw even as recently as April. So do you think it can really rock global growth? Should a central bank like India be really so scared? $73 is something we have seen, and we have seen 25% more than that.
Yeah, I think your point is very fair, that we are entering this situation with an oil market that is pretty benign, right? And we've actually, if we also need to look at why are these prices, why have they been pretty benign? Oil market experts have scaled down their forecasts for growth, global growth of the demand for oil. That, of course, by itself is not necessarily a good sign for the global economy. But yeah, that's a fairly benign market. But of course, if you look, for instance, at the RBI, they have been basing their, we are all basing our expectations of the RBI starting to cut later this year on a fairly benign oil market. And if that were to, if that picture were to change, we might have to revisit some of those timetables.
Oh, yes, they are meeting on October 9th to give us their policy, and they have a very, very good excuse not to even sound dovish. Just a very quick question on the US port strike as well. Harry, what's the reading from Moody's? I saw your press release. You think that this can jeopardize and pull down growth for now?
It all depends on how long this lasts for. So the most likely situation is that the strikes last for a week or 2 weeks. If that's the case, well, we don't expect there to be any significant macro implications beyond key areas where, the port is a key economic lifeline for those areas in the US. So places like Savannah is a good example. It's when we start to see the strikes extend 2, 3, 4, 5 weeks longer that we start to see bigger impacts where, on both sides, in the US and globally. In the US, it's shortages develop. That pushes up prices for things in the US. On the other side, for particularly Asian exporters, well, if you've got things that can't get off ships, that's more costly, as well as the fact that people are simply not going to be buying if the wait time to get into the US is so long. So it really depends on the time frame that these strikes continue on for. As I say, we think it's going to be shorter rather than longer.
Okay, well, as we speak, we don't know the end date. But apologies for this minor digression. I want to come back to the big China question and, to what extent, what more are you all expecting from that economy, the impact on the global economy, all those questions in a minute after the break. Bazaar viewers, you will get to view the whole show after market hours. For the moment, after Bazaar, it will be Chartbusters.
العالمين ان شاء الله اسرائيل جربت قبل بمره وما طلع على مع لبنان مش بس في حزب الله، كل لبنان بده يحارب هالمره، كل لبنان ناوي على اسرائيل على المجازر اللي ارتكبتها بغزه والمجازر اللي عملتها بلبنان. ان شاء الله ما حيضل واحد الا ما حيحارب، ما يفكروا انه بس حزب الله بوجهه.
There is a petition filed in Honorable Supreme Court about the constitution of the sit. So some arguments went on yesterday. So we've been informed to stall the further proceedings for till 3rd, that is till tomorrow, the day after tomorrow. In the meantime, yesterday evening we were informed that the Honorable Supreme Court said that
The market opens with major cuts tracking geopolitical worries. Frontline indices open 1% lower, with the Nifty and the Nifty Bank slipping below the 20-day moving average.
Dow Jones comes under pressure and is more than 5% lower, following a guidance of decline in revenue and margin in the second quarter in the company's Q2 FY25 business update.
On the other hand, we have Marico, which climbs, though off highs, following a good business update for the second quarter. The company guides for consolidated revenue growth in the second quarter to be in high single digits.
Steel stocks like JSPL, JSW Steel gain after brokerage firms Nomura and Morgan Stanley issue bullish calls on the stocks. Nomura initiates coverage and issues a buy call with citing domestic demand, among other factors. Morgan Stanley to upgrade stocks, citing visibility of some green shoots.
HPCL, BPCL and IOC come under pressure as crude prices gain for the third day to near $75 per barrel as hostilities continue to rise in West Asia. You're watching us here on Chartbusters. As you can see at the top of our screens, a deep shade of red in the markets tracking all that's happening in the world. So we'll keep an eye out on that. A bunch of stocks in focus as well. At the bottom of your screen, you have metal stocks doing well, ITD cementation as well. They won an order worth nearly 2,000 crores coming in, but there's more than just the order win that would move the stock more so. Any sort of clarity coming in on the deal. So a lot of stocks moving around on the way up, but largely it is a bright red screen, Nigel.
Well, that's right. Only select counters are doing well. Case in point being BSE, that's up close to 10%. ITD cementation is up close to 19% post the large order win, but we'll have to find out whether or not they're going to get a new promoter entity. But the sector that's been buzzing off late has been metals, and it's been twinkling off late. Now, NMDC, they have gone ahead and increased prices by 400 rupees per ton. To help us out with how production is shaping up, how is demand on ground, and what about pricing, we're joined by Mr. Amitava Mukherjee, the CMD at the company. Hi, Mr. Mukherjee. Good morning, and thanks a lot for joining in here on CNBC TV18. Well, let's talk about pricing first up. You've increased prices by around 400 rupees, but that's after you reduced prices by 1,100 rupees per ton. What's your take in terms of difference of NMDC's pricing with competitors, whether it's with Odisha miners or with regard to imports? And do you believe there's a case to increase prices even further from here on?
Well, after almost 3 months, we've been able to take a price increase. So that's the good news. That's the light at the end of the tunnel. I hope so. Of course, with respect to imports, we are still in the East Coast at 65% FE. We are still lower by around 35%. And in the West Coast, it is lower by around 27-28%. As compared to the other domestic miners, well, you will see that on a landed cost basis, we are at par. We are reasonably at par. We have taken this price increase as most of the steel prices, whether it is rebars, etc., pellets or billets, they've gone up. Except HRC, it has not moved in the last 2-3 weeks. But the other prices were showing signs of northward movement. So we thought that this is a correct time to take a price increase. We hope that if this trend continues, and the international prices have also gone up by around $10 from 96 or 98 to about $108. So if this trend continues, hopefully, let's see, next month we are keeping our fingers crossed, but hoping for the best.
Right. So you expect, the prices to increase next month as well if the international trend continues. Would you be able to give us a sense of the quantum of that price increase that you may take next month, all things being constant right now?
It will be very difficult to speculate on what we'll do next month. Let's see how the market thinks.
What we're trying to get at is that do you have a rule of thumb that this is what NMDC prices would trade at a discount to versus the global? You said that you're about 55 to 65% lower. Would you like to narrow that gap?
No, it's not 55% lower. It's 35% lower in the West Coast. But then it is neutralized by the export duty. So it has always been never at par with the international prices. Indian ore prices have always traded at around 25 to 30, 35, sometimes even 40% lower than the international prices. That's been the trend throughout. So I don't think there is a case for import price parity of our ore. It has never been the case. And I don't think it's going to be there in the future as well.
Let's talk about your operational update then. We have the numbers for the first 6 months of the year, and they're a little bit lower because of that, there was that worker strike, then there were some logistical issues as well. Earlier, you were talking about production number of around 50 million tons. That's going to be a tall ask, and most on the street believe it's not possible. What's the fresh guidance you can give us on sales as well as production numbers for this fiscal, FY25, since there's a degrowth so far?
So if you see year-on-year basis for the H1, we are about 2 million short than last year. We'll make this good. There's absolutely no doubts about that, and we'll exceed that. 50, yes, we'll still try to be 50, but we should be comfortably at around 48, should be comfortable. And if things go well, then we can do 50 million tons. Remember, last year, after January, almost there was no production in Kumaraswamy because we had reached the MPAP level of around 7 million ton. This year, we have around 8.63 million ton for MPAP at Kumaraswamy. So that in the next 2 months will obviously, in the last 2 months of the year, will obviously come. So I think around 48 plus should be the production guidance. Dispatch would be 50. Dispatch, I don't think there is an issue. dispatch should be around 50 million ton. We are only 1 million short as compared to last year, if you see. And we have had a few new sidings at Bailadila. So I think our capacity for dispatches have increased, and we have a new rapid wagon loading system in Kirandul as well.
So 48 million tons production and dispatches at 50 million tons. You still believe you can do that, correct?
Yeah, I think that should be.
And you briefly mentioned Kumaraswamy, you've got the clearance to do around 8.6 million tons, if I heard that correctly. For the company on the whole, what clearance do you have to do? I think the last time, if I'm not mistaken, it was around 53 million tons EC clearance.
It is around, last time we talked, it was around 51 million tons. Now it is 53.8 million tons.
And how you see this go up from here? By when?
Yeah, well, I think progressively by this year end, around February, March, we should see another 4 to 5 million tons of EC capacity coming in, because some of our mines are, as you know, 5-star mines. So we can increase our EC by 20%. We have applied for that. They are at various stages of approval. We hope that by the last quarter, it could be January, it could be February, but I think that the last quarter, those approvals should be available.
All right, so 57, 58 by the end of this year. You know, you had this target of 67 million tons in terms of production by FY26 and the ambitious one of 100 million tons by FY30. Those targets are still on, right?
Oh yes, definitely on. In fact, we are rather serious about it. We have catalogued the investment that is required. As per our latest estimate, it's going to be around 70 to 75,000 crores of investment that will be required in the 4 to 5 months. So we have done the first thing of cataloging it. We are the various projects are under at various levels of approval. Some are at the board level approval, some are lower down, but we are approving various projects. So I hope that by the end of FY29 or 30, we should have completed execution of these projects as well. So we are very confident that 100 million ton by the end of the decade.
You know, these numbers that you're talking about, 70 to 75,000 crores in terms of capex. Over how long are you looking to deploy that, and where do you get this money from?
5 years. We would expect that to be completed in the next 5 years. Mostly it will be internal accrual. I think we have cash reserves of around 14,000 crores right now, even if we account for dividend and the future cash flows. I think almost all of it can be financed through internal accrual.
Okay, all right. You know, Mr. Mukherjee, you don't talk to us too often, so we'll have to ask you on NMDC Steel as well. You know, and we're going to talk about the other company. What is the current volumes you're doing? You know, if you want to give it to us on a monthly basis, what is it looking like? By the end of this year, what is the total volumes that you'll do from NMDC Steel? And when does it break even?
Your last question first. It should break even by the end of this quarter on a monthly basis at an operational level. So we should be, all our problems we have been able to solve, except one, which was dispatches. Now, dispatches, I'll just explain it to you a little bit. We had a 5-kilometer stretch which was non-electrified, and as a result, the rake placement and drawal was taking a huge amount of time. Now that has been electrified, it is being tested, and I think it should be operational in the next 7 to 8 days. So once we are done, we have done production of around 130,000 per month of HRC in the month of August. And we just need 150,000 to break even. Not really much. So we are almost there. Of course, September we had to throttle down our production, essentially because we could not make the dispatches and our stockyards were full. And because our stockyard was full. But going forward from October onwards, once we have solved the problem of dispatches, production is not going to be a problem. 160,000, 170,000 per month, yes. And by the end of this quarter, on a monthly basis at operational level, we expect to break even.
So you'll break even in Q3 of this fiscal, correct?
Yeah, Q3 should be a break even, but of course, because we have lost money on Q1 and possibly will lose on Q2, and an annual break even, it might be beyond March, but on a quarterly basis, yes, Q3 should be a break even.
So for the year, you'll do 1.5 million tons? Approximately?
Yes, we wanted to do around 2.2 million ton. So the last month last 6 months we should be doing about 1 million ton, and we have done around 0.6 already. So we should do around 1.6 or 1.7 billion ton by the end of the fiscal.
Got it. And is this asset on the block? Earlier, the government was talking about Dipam was saying that they want to sell it. Then after that, there was an election in the middle and, things went away. In fact, the steel producers, they asked me, Nigel, is there asset on the block? We have already, submitted our EOI. Is it on the block?
Well, I have no comments to make on that.
You have no comments, or do you?
No, I don't. I'm not privy to any further information on that.
You're not privy to any further information, but it could be on the block, is what you're saying.
I couldn't, but you can't answer on my behalf. I don't think I've made that answer. No, I have no information.
No, because there's
on that.
constantly news, so we just thought that you'd be best placed to understand this.
No, I'm not the best placed. I can assure you I'm not the best placed person on that question.
Okay. All right. So you will keep going as if the asset is not on block.
Yeah. I'm running a steel plant. I'll make it profitable. That's my job. And I'm going to make it profitable in 3 to 4 months' time.
Okay. All right, Mr. Mukherjee, appreciate you joining in, giving us all those guidelines with NMDC Limited as well as NMDC Steel. Look forward to having a chat with you at the end of Q2 numbers. For the time being, though, we'll slip into a short break, come back. We'll focus on the technicals of the market.
Hang on for some time. So, in adherence to the Supreme Court order, we have stopped for the time being. So, once the order comes, we are very sure that the order will come. Because after all, it is a criminal case which we are investigating. So, is it against the sit only, about the investigation, about the case? We'll have to see once the order comes actually. But in the meantime, we have been informed, so accordingly, we have stopped it for time being.
The regulations are out. As we said, they were likely to come out today or tomorrow, and they're finally out. And I have to say, they're largely in line with expectations. So in July, SEBI had proposed 7 things. 6 out of the 7 actually have been implemented with very minor changes. So I'll start with what is going to be top of mind. Number 1, higher lot size value. This is going to be effective from the 20th of November. Basically, for index derivatives, which is Nifty, Bank Nifty, and other index derivatives, at the time of introduction, the SEBI is saying that the contract value should be between 15 and 20 lakhs at the time of introduction. At least 15 and up to 20. That is number 1. This is a simple and clean measure to limit the number of people who are able to trade this, trade index derivatives. Number 2, and I think a lot of interest around this, only 1 weekly option contract per exchange. This is also effective from the 20th of November. Remember, right now, NSE has weekly contracts, weekly option contracts on the Nifty, the Bank Nifty, the Midcap Index, and the Fin Nifty as well. BSE right now offers weekly contracts on the Sensex and the BankX. NSE now will have to choose 1. They'll have to drop 3. Only 1, and that too a benchmark contract. So most likely.
Welcome back. The market's still holding at lower levels today, closer to 300 points lower on the Nifty. Let's get in a quick technical check. Sachidanand Uttekar joins in. Sachi, your thoughts on the indices and individual stocks quickly?
Good morning, Mangalam. Good morning, Nigel. I think clearly both the indices are in the negative grip. Both are trending lower below the 20-day exponential moving average support. So if you look at the Nifty, I think the trading could be restricted within the space of 25,440 on the lower side. And on the higher side, it may find itself difficult to sustain at 25,680. So the writing at 25,700 looks very dominating, and probably we may end up in a consolidation mode. So it's better to avoid any fresh long positions when it comes to the indices, and probably on the lower side near to that 25,400, 420 mark, one can look for some buying opportunities in Nifty. When we look at Nifty Bank, clearly I think there is pressure, and this particular pressure may continue to push the index lower towards 52,000.
Okay, all right, Sachi, individual picks?
Good morning, Nigel. Nigel, I think there are some pocket of strengths which are still doing fine, and pharma looks very consistent here. We are recommending buying positions in Divi's Lab. The overall structure is still bullish. We have a bullish flag formation on the daily scale. The immediate target that we are looking at is around 56.50, and that's why we are recommending building long positions with a stop loss at 54.80. We have recommended this particular position to our clients, so this will be a disclosure. And on the short side, for the last 4 weeks, Indigo has been facing a lot of pressure near that 4,900, 5,000 mark. Right now, it has breached below a critical support level. The daily RSI has given a breakdown, and there is a 5 and 20 negative convergence, which is a good sign of negative momentum. So we are expecting that Indigo can break down towards 4,700, and that's why we are recommending building fresh short positions, keeping a stop loss somewhere close to around 48.65 on a closing basis.
All right, Sachi, thank you so much for that. Indigo aviation at the low point of trade. In fact, one of the reasons could also be rising crude prices. So what we'll do is take a short break. On the other side, we'll put focus on the rise in crude prices owing to these geopolitical tensions. Stay with us.
Decide whether to keep a Nifty weekly option contract or a Bank Nifty weekly option contract. Similarly, the BSE will have to choose between the Sensex and the Bankex. The benchmark is the Sensex, so most likely BSE will offer the Sensex weekly option contract. So I think this is the one which I think is going to dominate headlines and market participants, most impacted exchanges, brokers, everybody most impacted from this one. Number 3, intraday positioning, monitoring of position limits. This is effective from the 1st of April 2025. Currently, position limits are monitored on an end-of-day basis. Now, this is to be done on an intraday basis. Remember, the limit which was set, I think in 2020 during COVID period, was 500 crores based on notional value of trades. So this was monitored, but at the end of the day, now they're saying it has to be done on an intraday basis. Lots of feedback in terms of how this is going to be finally implemented. There is time, as I said, only effective from the 1st of April 25. Number 4, increase in tail risk coverage on the day of options expiry, effective November 20th. Basically, if you are carrying a position or if you take a position on the day of expiry, all existing positions on the day of expiry, old and new, will attract an extra ELM, which is extreme loss margin of 2%. So this is number 4. Number 5 and number 6 are pretty straightforward. Number 5 is upfront option premium, effective 1st of February 2025. And number 6, removing the expiry day calendar spread benefit, which is also going to be effective from the 1st of February. So I think these are the 6 changes which SEBI has implemented, largely in line with expectations. But I think the lot size increase and the fact that SEBI is limiting weekly options contracts to 1 per exchange will attract maximum.
Right, Prashant, very quickly before I let you go, a lot of comments coming in, a lot of questions and queries coming in from the viewers as well on our social media handles asking about the impact and the implications. Just in the near term, from a market perspective, you've probably been speaking with experts. What's the impact likely to be on the markets when we open tomorrow?
Shireen, so through the course of the day, we spoke with lots of market participants. Markets are prepared for this. I mean, we put out the story in the morning that this is to be expected very soon, that this is imminent. There was some expectation in some quarters, and we had clarified yesterday as well that this was not to come up along with the board meeting. And we said that, well, this is going to come soon this morning. So I think this is widely advertised. And the fact that what has been done is largely in line, actually mostly in line with what was proposed in July, I think does not come as a shock or a surprise. And also the important point is this is being done in a phased manner. It's not as if everything
investing.
Welcome back. Markets holding at around the 25,500 odd mark. But let's turn our attention from the equity markets to the commodity markets. Crude prices have been on a tear following the tensions in the Middle East. Manisha joins us to fill us in with a quick analysis on that. Manisha.
Well, thank you for that. Yes, the crude oil prices are trading higher for the third straight day today. And we did see a 5% of an immediate knee-jerk reaction after we did hear about those Iran ballistic missiles over Israel there. Still holding around that 75 mark right now. Well, it is about Middle East now as the escalation and violence really spreads further east. Let me remind you that 1/3 of global crude oil production comes in from Middle East. And this is the area that the markets are keeping a keen eye on. Having said that, the reason that you still are way off this year's high, which was $92, we are just about holding 75 right now. We've come off the low of 68 to 69. The reason the crude oil prices haven't run up further from here is because the global markets are looking at a huge supply surplus at this point in time. OPEC plus spare capacities stand at around 5.7 million barrels per day. This is much higher than what Iran does in sense of production at around 3.4 million barrels. Also, we are looking at a weak bearish quarter behind. Crude prices in the month of September declined by nearly 9%, 17% of a decline in the previous quarter as well. If you look at the US crude production, that has been increasing as well. Currently stands at 13.4 million barrels and could end the year at 13.5 million barrels. That is also putting pressure on prices. The US gasoline demand has been the lowest in 6 months. And apart from that, EIA says that the US production is not the only thing that is increasing. The US inventories have been increasing as well. The latest count has been 3.9 million barrels there. The OPEC output cut, which as of now stands at 5.9 million barrels, they could start to see that also ease gradually going forward. 180,000 barrels per day is what you could see start coming back into the markets from the month of December as well. The Wells Fargo report should come in on your screens because that says that the global production as of now is at 102.6 million barrels, which is expected to increase to 104.8 million in the next year. So you are looking at higher supplies, higher production, higher inventories, and the demand clearly not matching up. Is the reason most of the banks and brokerages are looking at lower prices for crude going forward in 2025. Highest really comes in from Goldman Sachs at 77. Rest everybody else is talking about 75 for the next year as well as an average, whether it's UBS, Bank of America, JP Morgan. The least bullish clearly is Citi, which is talking about $60 a barrel of a probability as well going forward. So unless there is an impact of war on oil facilities and oil supplies, you perhaps are looking at crude oil prices not clearing above 80-85 in a hurry.
All right, not going above 80-85 in a hurry. That should be good. With that, thank you so much for that update, Manisha. Markets still holding slightly above that 20-day moving average for the Nifty. We'll wrap up on this edition of Chartbuster. Stay tuned. Trading Hour comes up next.
by the end of the month or from a certain date. I mean, there's November 20th, there is April 1st, there is February 1st, all the way into 2025. I think that also kind of eases the impact a little bit.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBCTV18.com.
First of all, I mean, we are seeing very strong momentum in the market, and clearly this is on the back of some very good rainfall. Of the 36 agri-climatic zones that we have in the country, 33 zones have got either normal or above normal rainfall. And even in terms of, if you see the state stratification, for only the states of Bihar and Punjab do we see little bit deficiency in the rainfall, but broadly all the agri states also have very good rainfall. In terms of revising the guidance, no, we will still maintain at 5% level because we want to see through the festive season and then maybe take a call at the end of Diwali. That would be our view. But most of the heavy lifting will happen in H2 of this year, and that would give us an overall 5% growth rate. September has been a slow month for us in exports, and there are two factors to it. One is that in our neighboring countries, you know, there are some geopolitical challenges being played. These are all very big markets for brand Mahindra and Swaraj. And even in the US market, we are seeing that 11 quarters of continuous degrowth in US tractor industry. Now that is, we know the factors, that is on back of very high interest rate cycle, and people were waiting for Fed to start cutting. And now that has happened, I think the transmission will take 3-4 months time. And even in our US, which is our second largest market after India, the sentiment will revive. So that will again give us growth getting into our Q4. But I think for next 3-4 months, the exports might be a little slow.
The Sensex slumps 1,000 points. The Nifty lower by 300 points at 25,500. We're staring at a cut of more than 1% on the benchmark indices. You're watching Trading Hour. It's a Thursday morning. I'm Reema Tendulkar. With me is Sonal Bhutra. There's so much to, the markets are gravitating. I mean, just, figuring out whether it's the rising Middle East tensions, the spike in crude oil prices, the SEBI curbing F&O rules and regulations. There's a lot happening.
It was a very busy holiday, actually. Yeah, the 48 hours, they seemed like a lot happened then. And we are talking about a lot of macro issues now. We have crude prices. They've surged again around that $75 per barrel. And this cut, it is coming in after a big rally that we've seen as well, right? So this is something which was expected, largely expected. There would be some profit booking, but we did not really think that this would be the reason. So Brent crude prices at $75 per barrel. We have a 300-point cut on the Nifty. We saw a recovery, but again, that is sold into, and we are at the day's low right now. Metals, they are doing well, and that has been one space which has continuously done well. So 0.3% higher there. The defensive pharma space has come back again. So that is absolutely flat, but we are seeing some green there. Apart from that, all the sectoral indices, they are in the red right now. The realty space, the biggest loser today, that's a 2.5% cut. Nifty Auto, Private Banking Index, we have a lot of updates which have come by now as well. We'll soon have the RBI policy meet outcome, then we have the earnings, then there's festive season. October is going to be very, very busy, definitely very busy, but we've started with a lot of work already.
Oh, indeed. 10th of October is the date I'm watching because that's when TCS reports their numbers. So that's Thursday, 1 week from now. But let's drill it down to individual stocks that we're watching. Jubilant and Grevia. What's the latest here?
In a market like this, there are some stocks which are still doing well, and Jubilant and Grevia is one of them. It has been an outperformer so far in the month of September. And today, the company has informed the exchanges that the wholly owned subsidiary of the company, that is Jubilant Agro Sciences, they have entered into an agreement with an agrochemical company. They say it is for production of agro intermediate for one of the key agro actives of the customer. It's a big agrochemical company, which is an MNC. The overall consideration, that is what the street seems to like. It's $300 million plus, and this is over the period of supply. So, of course, the supply wouldn't happen immediately. Once the supply happens over years, the company will be paid $300 million and more, and that is the term of the contract. The subsidiary will be investing in a manufacturing facility. So, of course, they will not be using the existing facilities right now. But how much will they be investing is something that we don't know. Also, the company says that these will largely be exported out of India. It's not for domestic consumption. So we'll see what kind of margins this will enjoy if it is largely exported. So some things that we still need to know. But considering that this is going to be a big amount that the company is going to be receiving, and this chemical cycles seem to be turning in their favor as well, the stock is higher by 7% right now.
Okay, let's talk about the FMCG updates that have come through. So Dabur is under severe pressure, 6% down. Marico, though, is flat. Mangalam joins in with what the companies have said, how Q2 has shaped up for them. Mangalam.
Well, for Dabur, it's been a dampener. The biggest reason for that is that there were, heavy rains in many parts of the country with some flooding as well, which have impacted the out-of-home consumption. But the second important reason is this rapid growth that we're seeing in e-commerce and quick commerce, which has led to a lot of inventory stockpiling at dealers itself, and this is with general trade. So not particularly good news for their primary sales, because those guys are now rationalizing their inventory, and it's because of these two reasons that the consolidated revenue for Dabur will decline in mid-single digits. The street does not like that, because remember, at the start of the year and at the end of the first quarter as well, the company reiterated their guidance of a double-digit revenue growth in this year itself. So after this decline, does the company still hold on to that or not is the big question. The stock had already seen a decent rally as well. Add to that, because of lower primary sales, the EBITDA margins too will decline to mid-teens to about high teens versus a guided band of about 20% as well. So that's something, again, which has disappointed the street. Let's see where it goes from here, largely because the company said that some parts of their business, including the international business and Badshah, have done extremely well. October, they expect sales to revive as well. And this temporary disruption with regards to inventory will be more than made good. So let's see how the stock will perform going forward. But as of now, the street is disappointed. For Marico, the key positive is that, there is a high single-digit revenue growth coming in. And at the same time, remember, last quarter, the company saw a decline in share prices, largely because of the political, turmoil in Bangladesh. Out there, the company has gone ahead and reported high single-digit revenue growth in Bangladesh, indicating the resilience of the business in that geography itself. So that's something that the street likes. But the stocks come off highs largely because, one, there is inflation in raw material prices once again, and they expect a moderate lag in operating profit growth versus revenue growth. So triggers for margin expansion from here on seem a little limited. So those are a couple of factors we'll be tracking for Marico as well.
So these FMCG stocks, they are on our radar on the back of these quarterly updates. Thank you so much, Mangalam, for making sense of what these numbers look like this time around. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll discuss what's buzzing in the commodity space. And trust me, there's a lot. We'll get in Manisha Gupta for that update.
CNBC TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC TV18 India's #1 business news brand. Foreseeing change, growth, and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC TV18, your trusted partner and investment ally.
we like to stick to the fundamentals. And we won't draw first blood, but I mean, if there is a gunfight, we'll not go to it with a knife. So, one does end up participating. But having said all that, it just serves to advance the customer, the sales, but the customer expects it because that is the whole atmosphere during the festive. One participates in it. But
Okay, more than 300-point cut is what we are seeing on the Nifty right now. Most of the sectoral indices, they are in the red. But what's doing well, of course, is the commodity space. Manisha Gupta is joining in now. And today we are focusing on gold. Manisha, what is it looking like?
Well, as you said, all tangible commodities are doing well with the kind of escalation that we have seen in Middle East, whether it has been about energy or precious metals or base metals for that matter. We seem to be doing quite well across sector, whether it's copper at an 11-week highs or steel or iron ore prices, which have gained up by 11% in matter of last 4 or 5 days. For the gold prices also, after hitting an all-time high of $2680 an ounce on the higher side, we are holding very close to those all-time highs right now. The Middle East crisis is something that continues to lead a safe haven buying in case of gold there. The only reason that you are looking at a bit of a red on your screen is this is after the strong labor data that came in from US that's weighing onto the market, and a 66% expectation now of a 25 basis point rate cut in the month of November. This was as high as almost 70% before this data came in. So that's what's weighing onto the markets. But that clearly has not deterred the global banks and brokerages or the long position holdings that we've seen in case of gold prices. Even now, as per the latest data that I have collated for outlook for gold for 2025, most of the banks and brokerages are putting in a very high number there. Goldman Sachs, for one, in a latest report that came in last week, says $2,900 an ounce is what they're anticipating. So they have advised their clients to continue to hold their long positions. Commerce Bank is talking about 2,600. ANZ talks about 2,900 by the end of next year. Macquarie says once 2,600 is crossed, 3,000 is their next target. UBS has talked about 2,700. Bank of America says 2,750. Once that crosses, 3,000 was there looking at as well. JP Morgan talks about 2,850 and Citi talks about 2,700, 2,800 and 3,000. With those kind of targets breaching, could be looking at all-time highs yet again for 2025. So staying long is something that almost everybody seems to be advising on.
Thank you very much for that. By the way, order wins continue for many of these infrastructure companies. So J. Kumar Infra has just announced an order win of close to about 1,800 crore rupees. And earlier in the morning, we had ITD Cementation announcing an order win worth 1,937 crore rupees. And that stock is locked in an upper circuit of about 20% since the order win announcement. Big order win coming through for ITD Cementation. Get into a break. On the other side, we'll invite Vishal Salvi, CEO of Quick Heal. The company's just announced a new product. So we'll discuss that anti-fraud.ai product with the CEO of Quick Heal. Stay tuned.
down, it's back to good product proposition and customer care.
Let me address that constituency that you just spoke of, which is, of course, one of the most crucial constituencies, which is the regulator. And I think that is the big overhang today as far as the Kotak Mahindra Bank story is concerned, with the RBI imposing restrictions on account of deficiencies in the digital and IT infrastructure, not allowing you to onboard mobile as well as digital customers, as well as putting restrictions on your credit card business. Now, if you can share with us details on what you've been specifically able to do to demonstrate to the Reserve Bank that you are adequately or appropriately addressing those deficiencies, and where do you believe that you stand? I mean, there is, of course, an external audit that's also been sought, but where do you believe you stand in the remedial measures?
So, Shirin, first things to start, where we started with is, look, India has the best digital public infrastructure compared to any other place in the world. I've worked in every other place in the world. I've never seen anything like this, right? Now, obviously, that has led to the demand for digital services having gone up dramatically. And it's about the bank systems having to keep up pace with that. So we've been spending the last couple of months really focused on how we grow and make our systems foolproof. And like in every crisis, there's an opportunity. So we've taken this as an opportunity to really say how we'll really leapfrog and make our systems really resilient and relevant for the day, for the days to come. So I think we've made very, very good progress. Obviously, we've been in continuous touch with the RBI, sometimes even every week, updating them, getting their guidance, making sure we're on the right path. And I think we've made tremendous amounts of progress, and we'll continue to do it. You know, obviously the RBI is exceedingly important, but the customer, I've got to get it right by the customer.
Yeah.
I got to stay resilient for the customer. I need the best customer experience for the customer. And, you know, yeah, RBI has told me you got to do it. So
CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda.
Welcome back. Let's invite the management of QuickHeal now. The company has launched an anti-fraud AI solution, which is India's first made-in-India fraud prevention solution, which can provide consumer protection against evolving digital and financial frauds for all age groups. To discuss this and more, we have with us Vishal Salvi, CEO of the company. Mr. Salvi, morning. Thank you for joining in. This is Reema here. So tell us a little bit about this latest product launch of yours. How is it different from the company's existing products? What's there in the market already? And what is the opportunity? Have you identified, the total addressable market that opens up? Do you have any revenue potential in mind? Have you spoken to any of your existing clients or fresh clients?
Hi, thank you for having me here today. I think, QuickHeal has been a pioneer in the antivirus industry for almost 3 decades now. And we have been solving the problem of viruses, advanced malware for many years. One of the biggest challenge right now for the industry and for the consumers is the rise of cyber crime and cyber frauds. And given our background and our innovation experience on tackling with these issues, this was obviously a very important aspect of working on anti-fraud and see how we can give a solution which will address the current problem of end consumers not really knowing what's happening on their devices with so many apps coming in and so many banking transactions happening on your mobile phone. I think it's very important for us to have a solution which can actually constantly keep protecting you from all these new age digital frauds. So that's really what antifraud.ai is. And it focuses on making sure that all aspects of the fraudulent transactions happening or fraudulent apps which are working on your phone or your credentials which are being harvested by threat actors, you're constantly kept updated and informed of how you can protect yourself and your mobile devices from these attacks. So that's really what the product is.
Okay, yes. So Vishal, this shareholders would like to know that once this product is launched, what would the market size be which you're tapping? Once it's introduced, will you start booking those revenues in the immediate year? What is the outlook and impact on your P&L?
Yeah, so see, basically, it's a completely new category, right? So, so far we've been focusing on cybersecurity and antivirus. This is a completely new category of product that we are launching in the market, first of its kind, not just in India, but globally. And so, once this launch is done, we expect that, we start delivering and shipping these solutions for all our customers. Being in silent period, we can't be talking about our future revenue growth from the product and how it will impact overall top line and bottom line of the organization. What I can tell you is that we have a very clear plan, business plan for this, not just for this year, but I think going forward. And when the launch happens, it's actually a global pan-India launch, and so we'll start accruing revenue from day one.
So Vishal, when are you planning to launch it? Will you be making huge investments in this? And on new product launches like this, what's the kind of ROI do you see? At least that would be a number that you can share with us.
Yeah, so see, basically, we have been investing in this for many years, and that's why we are able to launch it now. So the product has been, in the silent development mode for, few quarters now, and very happy that we are able to launch it now in the market. We obviously have a proper plan in terms of ROI and how we are going to generate revenues. How our revenues have been for the B2C product, our flagship antivirus, and we expect something similar to happen for this product as well. There's a huge potential because India is inching towards $1 billion smartphone devices, and so potential is immense in terms of how we protect these devices from this new age solution. Unfortunately, I'm not able to share the exact numbers, primarily because of the board meeting coming up soon and being silent period. But I'm sure we will be able to share some of these, in coming interactions with you.
Directionally, can you tell us, Mr. Sarvi, if Q2 has seen a pickup compared to Q1? Because Q1 you did see a revenue drop. You indicated that central government orders got deferred, etc. So without getting into numbers, are we seeing growth in Q2? Quarter on quarter and year on year?
Fortunately, Rima, I can't give you a color on that. But I can tell you that whatever we have shared so far in terms of the focus on pivoting to enterprise security, I think that plan is executing quite well. Our hiring strategy is executing quite well. The pivot in terms of the sales organization is executing quite well. All the things that we wanted to do in our R&D investments and execution is, going quite well. We have been constantly talking about bringing in more predictability and consistency in our, results. And, in the last 4 quarters, we have demonstrated that, and we want to continue to go on that path. We have always maintained that we want to calibrate our growth in a manner where we show a very stable quarter-on-quarter predictable growth. We are on path of doing that. I can't give you exactly the numbers in terms of how Q2 is going to look like. It's a matter of just a couple of weeks, and you will get to know how that's going to pan out.
And we'll have a conversation with you once again when those numbers are reported to the exchanges. But thank you for joining in today with those insights on what this new product launch would look like. We'll do one thing. We'll slip into a quick break. On the other side, we'll talk about more stocks and sectors which are in focus. Stay tuned for that. India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
2 6-week periods during which the inflation rate has fallen, that can give a lead to cut the repo rate. Choice is between 25 basis points and 50 basis points.
Welcome back. Extending its fall now. It's 25,400 on the Nifty. The Sensex is down close to about 1,200 points. We're at the day's low, and in the last 30 minutes, the selling pressure in the market is picked up. So earlier, at least the metal index was holding up in the green. Pharma had a little bit of a green tick. Now all the indices are in the red. Even the Nifty metal index has dipped into the red. It's a minor cut there, but it's down in the red. Pharma index too has a cut of about 0.25%. IT stocks are seeing some incremental selling. So Nifty IT index is down 1.5%, with names like Wipro, Tech Mahindra, HCL Tech, LTI, Mindtree all selling off in the last 30 odd minutes. So we've breached the previous low that we had in the morning, and we're also now trading below important levels that the markets were tracking. The 20-day moving average is something that we were tracking very closely, and now that level is also gone.
And a lot of pressure coming in from banks as well, Reema. So some of these big banks, there's Axis Bank, which is at the day's low. We have Kotak Mahindra Bank, which is at the day's low. ICICI Bank. You mentioned IT names not doing so well. Reliance Industries is the other big weight on the Nifty, which is not doing so well. So it's across the board, and all the sectoral indices now in the green. Even the metals index that we were talking about earlier, which was giving some support to the Nifty, is now in the red. And let's talk about that sector itself. The steel sector, that is in focus after a note from Morgan Stanley and Nomura. Nigel is joining in with details from this one. Nigel?
Well, that's right. Morgan Stanley is sounding far more optimistic on steel in comparison to what they were prior to this report. So a few factors that they've stated is that the Chinese recent stimulus, well, that bodes well, and that's giving a bit of a positive sentiment to the steel space. And that in turn could, support prices as well. They've also said that the risk of imports, well, that's come in a little bit lower now, and they expect that to be subdued, which is good news from a domestic demand point of view. They go on to highlight that there are green shoots that are visible, which in turn will be reflected in better spreads. And finally, the fear from a India steel perspective is that India steel prices in comparison to imported steel was at a sharp premium in comparison to imported steel. So the problem was that every time you fear that steel prices will have to correct to come at parity with imported steel. Now they say this has evened out, and from being at a premium of around 8 to 9%, now it is at par with imported steel, which is good news. So they've gone ahead and they've changed their rating on all of these key ferrous names, and they've upgraded the target price as well, because they're factoring in better pricing and better spreads. For JSPL, they've upgraded the stock. Target price moves to around 1,200 from 970. On JSW Steel as well, they've upgraded the stock. Now they have a target price of around 1,150, which is more than 300 rupees higher in comparison to what it was earlier. Tata Steel, they have upgraded from underweight to equal weight, and the target price moves to around 175. And on SAIL, they maintained the underweight stance, but earlier they had a target price of around 105, now it's 125. Nomura as well, they've gone ahead, they've initiated coverage on JSPL as well as on JSW Steel. They are highlighting that domestic demand is strong, and the continued deleveraging measures by Indian steel makers, well, that's what will hold them in good stead. They're not only focusing on the pricing side, they're also focusing on the cost side. And those steel prices have been tepid, but the cost focus will help them in terms of profitability. The risk, though, they highlight is weakening domestic demand in case there is some monetary tightening, and also expansion delays, though are downside risks. But both these two notes today, they've excited the steel stocks. Back to you.
Okay, thank you very much for that. BSE, Bombay Stock Exchange, is higher for the third day in a row. Remember, overnight, we had SEBI's measures to curb speculative F&O trading. Well, it appears to be it's more negative for its competitor NSE, which is why NSE's pain today is BSE's gain. Vamakshi is here to tell us more about the news and what brokerages have to say on this development. Vamakshi.
Well, absolutely. NSE's loss is BSE's gain. In fact, over the last couple of days, we saw that SEBI introduced 6 measures as compared to the 7 measures that it had proposed in the consultation paper to tackle surge in speculative trading. Now, one of these measures is limiting weekly expiries to 1 benchmark per exchange with effect from November 20th, 2024. And brokerages are in fact expecting the highest impact to come through from this particular measure. We have a note coming in from IIFL Securities Securities, and they say that the higher impact on NSE could be seen as it has 4 weekly expiries as compared to 2 expiries for BSE. They've also quantified this impact. They're expecting a 35 to 40% impact on NSE option premium turnover, which is much higher as compared to 15 to 20% in case of BSE. Earnings impact, however, is expected to be lower on account of the shift to the flat tariff structure. For NSE, they're expecting a 15 to 20% hit on FY26 EPS, and the same for BSE is again much lower at around 5 to 7%. BSE's option tariffs additionally are nearly 7% lower as compared to NSE, and to that extent they believe that BSE has an opportunity to offset the lower volume impact. BSE market share gains could also accelerate in their opinion, thereby further negating the earnings impact. Overall, they highlight that the key overhang is now behind us. Long-term growth potential looks quite promising in their opinion, and they believe that any meaningful correction in the stocks is an opportunity to add. So therefore, BSE is relatively better placed as compared to NSE, and resultantly in an otherwise weak market, the stock is surging higher.
Okay, all right. Thank you so much for joining in with those details, Vamakshi. But we'll slip into a short break. As we do that, here's some good news for our viewers. India's business news leaders now click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store.
Cautious, we can cut 25 and store something for the next time. Or we can take front-loaded cut of deeper thing. There are two ways of creating competition in the system. One is really letting new private sector banks to come in. The other is privatize some of the nationalized banks or increase the private content in the United States. We have now reached a stage in which we should really be able to get more banks in the private sector. So I would really say that let an atmosphere and environment be created where new private entities can enter.
We are revising 100% booking value guidance to 4,800 crore to be done in FY25. So this is in summary the response to Estate 360. We have some units remaining. That's why the total 100% booking value guidance is now 4,800 crore, of which 4,100 crore has already been booked.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube.
Welcome back. So Nifty continues to be where it was, 375 points lower on the Nifty. So 25,423 is the mark that we are looking at the day's low. Midcaps too are doing the same thing. They're down around 730 points. If we talk about the broader markets though, there are a couple of movers on the upside. Jubilant Ingrevia, we spoke about that stock a while back. That stock has surged to levels of 830. That's 7% uptick that we are seeing on Jubilant Ingrevia right now. Parag Milk Foods is up around 6%. We have Petronet LNG. There's an MK upgrade that has come by on the stock. They've upgraded the stock to a buy, increased the target price by 14%. They like the demand that the company has been seeing from other sectors, barring power sectors. Utilization is something that they like as well. So those are a couple of stocks that are on our radar. But it's a good time to discuss market fundamentals. Devang Mehta from Spark Private Wealth Management is joining us now to discuss just that. Devang, good morning. Thank you so much for joining in. And what a day to have this conversation, right? So much happened in last 48 hours. We're talking about a lot of geopolitical tensions. We are talking about kickstarting Q2 earnings season as well. How are you looking at the markets currently? More downside from these levels?
Good morning, Sonal. Thanks for having me on the show. Absolutely, yes, we are seeing a bit of volatility coming into the proceedings. But honestly, if you look at the market complexion over the last 1 year, to be precise, and I keep on repeating this, last September to this September, and now it's the start of October, every now and then market has sort of started to show some bit of turbulence, and the turbulence is roughly around 3 to 5%. And at this levels of the market, when we had a fast, furious, and an extremely spectacular rally across the market caps, if I can say, be it large cap, be it mid cap, and be it even small caps, I think this should be taken with a bit of a open heart. And I think these corrections are what makes a market a little more healthier. It has to be a continual rally rather than a continuous rally. So my sense is that, yes, there is geopolitical tensions which have come to the fore. There is crude price which has risen because of that. I think also what we have seen is even the global markets and Indian markets have climbed all the wall of worries, be it the Indian elections or be it the budget or be it the first quarter earnings. Even the US rate decisions were sort of taken with a positive heart. So I think next 2 months, you will see a lot of events. I think I was listening to events being lined up right from RBI policy to the earnings season to even the US elections next month. So I think, yes, it's a heavy calendar for global markets and Indian markets. We might see a bit of turbulence. But again, as I said, this has been the complexion of the market to be buy on dips, and a lot of people were sitting on the sidelines. A bit of FOMO should sort of, yeah.
Devang, just hold on. Apologies for that interruption, but we have to cut across to our colleague Parikshit Luthra. He is in conversation with Sanjay Kapoor, the chairman of Sona Comstar at their plant in Gurgaon. The company has completed 25 years this week. Over to you, Parikshit.
Sona Comstar, one of India's largest component makers, automobile component makers, is in its 25th year of operations. We're at the company's first plant here in Gurgaon today. Today, the company has at least 10 manufacturing units across the world, also in China, Mexico, and other places. The company gets about 30% of its revenues from battery electric vehicles. To talk about the 25 years of journey and the vision ahead for the next 25 years is the company's chairman, Sanjay Kapoor. Sanjay, thank you very much for joining us today, taking us time and showing us around your plant. Give us a sense of how all of this came about 25 years ago. Actually, the company was incorporated in 1995 as Sona Okigawa Precision Forgings Limited. It was a Japanese JV, 75-25. Tell us the thinking and the vision with it came about.
So we started in 1995, you're absolutely right. My father started his life making gears. He started a company called Bharat Gears Limited. So I think he had this great passion for gears. And we had an opportunity with Mitsubishi. This is right after we started Sona Koyo. Sona Koyo, which was then called Sona Steering Systems Limited, was started back in 1987, production in 1989. In 1995, we had an opportunity to joint venture with Mitsubishi Materials, which was licensed by a company called BLW to make warm forged gears. And we took the opportunity because we saw an opportunity in the market to make bevel gears. And that's, that's how we started back in the day. It was called Sona Okigawa Precision Forging Limited because Mitsubishi's plant was in a place called Okigawa.
All right, so give us a sense of how much the company has grown in the last 25 years. We just referred to the 10 manufacturing units you have in India and abroad. but how much has the company really grown?
So we've grown almost 30% year on year. You know, it's been a great growth story for us. You know, we've grown through a lot of, you know, effort in terms of R&D, a lot of development. We've, you know, built the gear business, the differential gear business, you know, over a period of time, and we've, you know, expanded to differentials, you know, from just pure play bevel gears.
Right. Now, if we were to also ask you about your vision, every chairman has a certain vision for his company. Your father had one. What would your vision be? If I were to ask you, what does Sanjay Kapoor want his company to look like in the next 25 years?
So, you know, we've been very focused on technology. We will continue to focus on technology. I think that's the way to look at businesses like ours. We've been in the automotive space. We're now looking at mobility as a space. And, you know, who knows, 20 years from now, you know, mobility as a space will change. I think a lot of, you know, energy transition will happen in mobility. And we'll continue to grow in that space, continue to invest in technology, and continue to be a technology-oriented business.
Right. What about your growth plans in terms of setting up more capacity either in India or abroad?
So, you know, we love manufacturing in India, to be honest with you. We have assembly plants in Mexico, in the US, in China as well, you know, and we've got a facility in Serbia which does sensors. So we will continue to manufacture as much as we can in India. We have expanded capacity in bevel gears and in differentials, and we'll continue to expand capacity, you know, as the market requires it. We've been fortunate that we have close to 9% of the global market with differential gears. Our differential business itself is also expanding, and we'll, you know, continue to add capacity as and when required.
Right. Considering you're such a big supplier to the passenger vehicle industry, does the current lack of demand somehow worry you?
So, you know, our industry is cyclical, Parikshit. You know, so it goes through cycles. We supply to every segment within the automotive industry, so which we're fortunate to supply into commercial vehicles, off-highway, farm equipment. We do traction motors for 2- and 3-wheelers, electric 2-wheelers and electric 3-wheelers, you know, and we do passenger car. By virtue of size, passenger car is the largest because globally passenger car volumes are such. You know, and like I said, you know, we go through cycles, and these cycles, you know, happen in every industry, in every sort of economy as well. And you know, and we can weather the storm. It's not something that's, you know, bothering us. Our business is still growing because we're capturing more market share, you know, within customers. So, you know, it's been a good run for us.
Right.
Well, that is Sona Comstar. It's been a 25-year journey for the company. They've grown 30% year after year, expanded into 10 operating plants now all over the world in India. And the company is saying that it goes through cycles, but they're not too worried. And the company, in perhaps a little challenging time right now, is still gaining market share. Devang is now still with us. Devang, particularly talk about the auto ancillary space. And have you had a look at Sona Comstar? And if you could share your views on the stock.
I think, no, I've not looked at Sona Comstar to be precise, but on the overall space, if I can talk about the auto components / auto ancillary and even the OEMs for that matter, I think the space looks extremely interesting after a long time. I know most of the companies have rallied, be it right from Maruti to M&M, and also a lot of auto components and auto ancillary stocks have rallied. But I think getting into the festive season, the demand for the bikes, demand for even the CVs, all of these are sort of rising. So the sense one gets here is that most of these companies are going to do extremely well in the coming times. Also, I think precisely there are companies like wiring, now company which gets into the groove. When one upgrades the car from a normal car to a normal hybrid to an electric vehicle, I think there's a lot more 10x, 15x wiring more required. So I think this type of themes will play out over the longer term. So most of these companies, as I said, auto ancillaries, autos, we take as a part of discretionary consumption in our portfolios.
Okay, so that is about auto space. One space that has been defying the trend that we are seeing with markets is definitely metals. Today it's been volatile, of course, but how are you looking at that space considering whatever is happening in China? Do you think this could be a fundamental or strategic move or structural move from here on in the metal space?
I think yes, of course, mostly we have seen metals always go through that cyclicality, but this time it's I'll not say it's different, but most of these companies have a lot of tailwinds. Companies have sort of reduce their debt. Most of these companies are now working more efficiently than they were, and I think the demand cycle as well has turned. So how we play this, one is to play via pure play metal stocks, but I think the better and the more efficient way and to generate a little more wealth is to play it via companies which are proxy plays towards it. So just giving an example, not a recommendation, there's a company called Tega Industries, which is more into copper and gold mining equipments, and that is consuming. So such type of companies with a market cap of roughly around 13,000 crore, ROE of around 17.5%, ROC of around 19-20%, and a huge dominant market share in this industry, revenues and profitability growing in excess of 15-20%. I think these are type of proxy plays which one can evolve, one can buy in their portfolios for the longer term, and these are plays which will help you to ride the metal wave as such.
Okay, Devang, we'll leave the conversation here for now. Thank you very much for joining in. We'll come back and continue talking about the auto space. On the other side, we have C.S. Vigneshwara from FADA and Mumuksh Mandalesha from Anand Rathi Institutional Equities.
Welcome back. You're still tuned into Trading Hour. Well, a higher number of car buyers are now opting for CNG sales, with sales growth of CNG passenger vehicles in the first 8 months of this year outpacing all other variants. Also, many OEMs are now launching CNG variants of their popular models. Let's discuss the shift in this trend with CS Vigneshwar, President of FADA, and Mumuksh Mandlesha, the research analyst at Anand Rathi Institutional Equities. Gentlemen, good afternoon. Thank you so much. Good morning. Thank you so much for joining in. Mr. Vigneshwar, let me come to you. Currently, of the PV space, the passenger vehicle space, how much is coming in from the CNG vehicles, and what kind of growth levels have we seen so far, and what kind of growth levels are we expecting going forward in this segment? Mr. Vigneshwar, can you hear me?
Yes, I can.
Yes. So I was trying to understand what kind of growth levels have we seen in the CNG segment so far in the auto industry? What kind of growth levels are we looking at? And how much percentage of the total passenger vehicle industry volumes are coming in just from the CNG segment?
See, right now, when you look at it, nearly 15% of the vehicles which are being sold are CNG petrol vehicles. When you look at it from a year-on-year growth, probably it's gone up from nearly about 11% to about 14% right, 15% right now, which is something which is nice to see that alternative fuels are also coming in and making an impact on the market.
Okay, so we thought I thought the number would be higher, because I remember Maruti, saying that almost 1/3 of every car that they're selling is actually a CNG car.
Correct. So there are very few brands which are actually dealing with CNG. So when Maruti says 1/3, they are about 1/3 of the whole sales market share again. So we need to take that into consideration. So that's where they land up. I mean, the whole CNG vehicle sales lands up at about 15% market share. More and more manufacturers are, however, wanting to come onto the bandwagon of CNG. Yeah.
Oh, okay. Mumuksh Mandlesha is also joining in now. Mumuksh, what's your take on this? Which are the players which are benefiting the most from the shift that we are seeing? Maruti is one. Are we seeing more interest coming in from other players as well?
Yeah, hi. Good morning, everyone, and greetings for the festive season. In India, we are seeing CNG as a preferred fuel. So today, obviously, we are seeing a very good penetration in the car segment. We have seen also in the CV segment, and now even we are seeing in the two-wheeler segment. So consumer in India have seen how the CNG works in India, and there's a huge boost by the government to drive the network in India. So today I have 7,000 touch points in India, and there's a lot more options available. Today in Maruti, we have almost every model with the CNG option. You have Tata, Mahindra. So a lot of focus is happening because new launches there. And in fact, a lot of automakers have actually somewhere stopped diesel and shifted to the CNG as a fuel option, like Maruti. So that is driving a lot of penetration for the CNG market in India. And we believe this trend will continue in coming years as well.
So Mumuksh, so Maruti said, right, about their penetration for CNG is about 34%. But even peers like Mahindra and Tata Group have launched a number of CNG variants. Even for Tata's popular Nexon, there is now that CNG variant. Do we have numbers of what for Tata Motors or for Mahindra in their domestic portfolio? What is the penetration of CNG?
Yeah, so Mahindra, it's still on lower side because a lot of SUV portfolio doesn't have so much CNG. But Tata Motors also in the double-digit penetration in terms of CNG, close to 12 to 15%. And there also they are coming with a CNG option across the portfolio. Like Maruti, 33%, others are around this percent. And then obviously there are some which don't have the models. That's why the overall number is like 15 to 18% for the industry.
Mahindra is about
compared to last year.
Okay, so CNG vehicles for the market, the industry is growing 25%. Penetration stands at 15%. For Maruti, it's about 33%. Tata Motors stands at 12 to 15%. And Mahindra, when you say it's low, we're talking about 0 to 5, 5 to 10. Do we have any estimates?
Yes, somewhere around 5%, not more than that. Yeah.
Oh. Okay, so this is what the idea with the current players looks like. Mr. Vigneshwar, what is the outlook going forward? Are we seeing more launches come by? We are talking about now two-wheelers as well in CNG variants. What kind of growth is the industry anticipating here? Do you think this will outpace the traditional fuels in a big way?
30 years ago, the desktop computer was the only computer we knew. And then you had a laptop which came along, then you had a tablet, you also have your phones, which are really powerful computers these days. What I can tell you is I'm quite agnostic regarding, I don't know what's going to happen in the future, because a lot of fuels are going to come in. We're going to have hybrids, we're going to have pure EVs, we're going to have plugins, we're going to have CNG powered vehicles actually coming through. So why I mentioned about the your personal computer, your desktop, is that many years ago, for many years, we actually had only diesel and petrol. But today we have a great choice. And a lot of these choices also depend upon what kind of application is going to be used for. So the growth of alternative fuels are really going to pick up, CNG and a host of other technologies too. And of course, when these technologies keep penetrating, there would be some loss from the diesel and petrol traditional vehicles. But I'm quite gung-ho because all this needs to happen. We need to reduce our forex drain because of importing fuel. We need to also look into the CAFE norms as an industry to make sure that the vehicles are a lot more cleaner in terms of emissions. Yes, so I'm quite positive and gung-ho about alternative fuels. CNG also is leading the charge right now.
All right. Okay, gentlemen, thank you so much for joining in and giving us your take on what's happening with the CNG sales in the space. So definitely seeing a big growth versus the traditional fuels, but of course it's coming in on a lower base as well. Well, it's a 400-point cut on the Nifty. The Bank Nifty is down 700 points. So we'll keep tracking markets for you. But for now, we'll take your leave on trading hours. Stay tuned. Halftime report is up next.
How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBCTV18.com.
ما يفكروا انه بس حزب الله بوجهه، كل الشعب اللبناني كله بوجهه، وان شاء الله النصر مثل ما وعدنا فيه رب العالمين. ان شاء الله اسرائيل جربت قبل بمره وما طلع مع لبنان. مش بس في حزب الله، كل لبنان بده يحارب هالمره. كل لبنان ناوي على اسرائيل، على المجازر اللي ارتكبتها بغزه والمجازر اللي عملتها بلبنان. ان شاء الله ما حيضل واحد الا ما حيحارب. ما يفكروا انه بس حزب الله بوجهه.
Stocks see a sharp fall following renewed tension in West Asia following Iran's missile attack on Israel. Realty and automobile stocks are the biggest losers, with metals and oil producers being the two green spots.
Market regulator SEBI issues a tad less stringent final rules for F&O trades to protect small investors. Increases in minimum contract size, curbing weekly index contracts, stiffer margins and closer monitoring are some of the steps. Experts see these curbing activities in F&O going ahead.
Dabur says disproportionately higher growth in modern trade and e-commerce as well as quick commerce impacted general trade. It decides on a one-time measure of correcting traditional trade inventory. The stock dips.
Crude prices leaped following Iran's attack but cooled as OPEC Plus's idle capacity of 5.7 million barrels per day exceeds Iran's output of 3.4 million barrels per day. The possibility of a wider conflict, however, keeps the markets on the edge.
Good afternoon. You're watching us here on Halftime Report. West Asia tensions hit market. The Nifty is down almost 400 points. In fact, it's below that 25,400 mark as well. The bull market has a fair amount of walls to climb in terms of worries. We not only have the West Asian market, West Asian geopolitical tensions, we also had the SEBI circular that came by to curb F&O volumes. And at the same time, we had weak updates coming in from corporates, including the likes of Dabur. And add to all of that, just to put a little more spice to the mix, we have the Nifty weekly options expiry playing out today. I'm Manglam Malu. With me, as always, Ekta Batra. Ekta, what a cocktail of news this afternoon.
Yes, absolutely. And after the heady runs that we've seen, people are not used to seeing so much red on the screen. But definitely at this point in time, we have the markets which are under pressure as the Middle East conflict has deepened. So that's primarily one of the reasons. And what it could probably do potentially to crude prices. Asia also largely mixed while Japan rallied. We had the Hong Kong markets which were quite weak, so it's recovered from the day's low. So that index was down around 1.3%. We have Europe, which is set for a weak start as well. So maybe the CAC futures should come up for you, the French futures, and let's see what they are indicating at this point in time. Besides that, we do have potentially a lot of data to watch out for, which would determine the course of the markets, determine the course of the Fed as well. Not to mention that geopolitics would probably be key and top of mind for the US Fed going forward as well. So we have the jobs data in the US on Thursday, and we have the September payrolls data, which will be coming out on Friday as well. So a lot to watch out for. It's going to be quite a lot of information that the markets will reckon with. And over that, obviously, earnings season starting soon. So that will too determine the course of the markets. But let's focus on some stocks on the move. Manglam is tracking Dabur and Marico. Well, nobody expected this kind of an update, Manglam, from Dabur.
Most definitely, and that's exactly what is reflected in the stock price as well, Ekta, because after the fourth quarter results and after the first quarter results as well, the management did reiterate that demand conditions were improving. At the same time, they are gunning for that double-digit revenue growth in this year itself. No problems with the demand condition. They're stable and they haven't seen further deterioration. Rural still doing a lot better. But there were a couple of problems during the quarter that went by. The first one, heavy rains and floods across parts of the country have impacted their out-of-home category, which is the beverage category, most notably the juices category. And that's impacted their revenue. And secondly, because of the high growth that we're all celebrating here on quick commerce, e-commerce, modern trade, there is a fair amount of inventory which is stuck in general trade, which still accounts for nearly 90% of the sales. So the company has gone ahead and announced a one-time restructuring of all the inventory in general trade, and as a result of which their revenue in this quarter will decline in mid-single digits. And on the back of that, their EBITDA will be impacted as well. The margins will be closer to 15 to 19%, mid-teens to high teens, as the company has said, as against their earlier guidance of 20% itself. The stock had done well, but now it's off about 100 rupees from its 52-week high on the back of that. But not all is lost, because they do believe that October is going to see some sort of recovery. At the same time, the inventory realization for general trade is temporary, and parts of their business, which is the international business and Badshah Masala, which they acquired, are still growing in double digits. So we'll keep an eye out on that one. On the other hand, if you look at Marico, that stock's holding mildly in the green, in an otherwise very weak market. And why is that? Because their performance has not been bad. The consolidated revenue growth remained in high single digits. At the same time, parts of their business did well. Overall volume growth is mid-single digit as well. The most important positive for me, Ekta, is that last quarter we saw Marico see a big decline because of the turmoil that we saw in Bangladesh, because a lot of their international business comes in from Bangladesh. But out there as well, despite the turmoil, the company has reported high single-digit growth in Bangladesh, speaking about the resilience of that business, allaying some of the concerns, and that's why the stock's holding even better. The only reason why it is not booming in today's trading session is because operating margins may lag the growth in revenue, which means that there could be some compression and limited triggers for margin expansion given the sort of worries that we're seeing geopolitically as well. So base oil prices may increase. So that's one thing that we need to closely monitor. But Marico, no problems, no real problems. Dabur, there were problems. Let's see when they come out of those problems.
Okay, all right. So definitely a space to watch out for, considering the dynamics which are taking place in the QSR space as well. Thanks, Manglam, for that. So Dabur and Marico in focus. We need to take a short break on that note. But up next, we'll focus on steel stocks and a lot more. Stay tuned.
We have, there is a petition filed in Honorable Supreme Court about the constitution of the sit. So some arguments went on yesterday. So we've been informed to stall the further proceedings for till 3rd, that is till tomorrow, the day after tomorrow. In the meantime, yesterday evening we were informed that the Honorable Supreme Court said that you hang on for some time. So in adherence to the Supreme Court order, we have stopped for the time being. So once the order comes, we are very sure that the order will come, because after all, it is a criminal case which we are investigating. So is it against the sit only, about the investigation, about the case? We'll have to see once the order comes actually. But in the meantime, we have been informed, so accordingly, we have stopped it for time being.
The regulations are out. As we said, they were likely to come out today or tomorrow, and they're finally out. And I have to say, they're largely in line with expectations. So in July, SEBI had proposed 7 things. 6 out of the 7 actually have been implemented with very minor changes. So I'll start with what is going to be top of mind. Number 1, higher lot size value. This is going to be effective from the 20th of November. Basically, for index derivatives, which is Nifty, Bank Nifty, and other index derivatives, at the time of introduction, the SEBI is saying that the contract value should be between 15 and 20 lakhs at the time of introduction. At least 15 and up to 20. That is number 1. This is a simple and clean measure to limit the number of people who are able to trade this, trade index derivatives. Number 2, and I think a lot of interest around this, only 1 weekly option contract per exchange. This is also effective from the 20th of November. Remember, right now, NSE has weekly contracts, weekly option contracts on the Nifty, the Bank Nifty, the Midcap Index, and the Fin Nifty as well. BSE right now offers weekly contracts on the Sensex and the Bank X. NSE now will have to choose 1. They'll have to drop 3. Only 1, and that too a benchmark contract. So most likely they'll have to decide whether to keep a Nifty weekly.
Welcome back. Well, for the market, still weak as we speak. So the Nifty is down around close to 400 odd points. So lost that much. The Midcap index is down around to 860 odd points at this point in time. And the Bank Nifty has shed over 700 odd points. The advanced decline ratio has been weak from the get-go. So currently stands at around 1,200 stocks advancing to around 2,800 stocks declining. So it's 1:2. In terms of a ratio at this point in time on the Bombay Stock Exchange. So as you can see, extremely wide and favoring the declining stocks. But nonetheless, we have a couple of stocks which are in focus now. Jubilant Ingrevia is in focus from the agrochemical space. It surged as its subsidiary has entered a deal with an agrochemical company. Sonal is here to tell us more about this particular deal and what it means for Jubilant Ingrevia.
Well, it's a big pop-up that we're seeing on the stock, especially in a weak market like this. Jubilant Ingrevia, the wholly owned subsidiary of the company, which is Jubilant Agro Sciences, has entered into an agreement with an agrochemical company. The company says it's one of the largest that we've seen in the globe. That is the size of the agrochemical company. This is to produce an agro intermediate for one of the key agro actives of the customer. The point that the street seems to like is the consideration, which is $300 million plus, which is huge for the company, and that is something which would have a direct impact positively on the P&L as well. The company says this will be over a period of next few years after the commencement of production. It will be over years that they will get this consideration. Nevertheless, it will be positive. The subsidiary will be investing in a facility going forward. So we don't know the investment amount here. So these are some important details we'll be watching out for. What will the asset turn be for the kind of investment that they are taking here? The manufactured agro intermediate will be exported from India. So it's largely an export-oriented product. So what are the kind of margins they will enjoy? That is something we need to know from the management, but overall it's a positive deal that they have entered into, and that's why that uptick on the stock today.
Take that point, Sonal. Thank you so much for that. In fact, that's not the only stock that we're talking about in terms of gains. Steel is one sector which stands out, and two stocks in particular doing well. This on the back of notes coming in from Morgan Stanley and Nomura. Nigel joins in with why JSPL and JSW Steel are doing well, and what's the way ahead for the steel sector. Nigel.
Well, that's right. Let's start off with Morgan Stanley. They're fairly positive on steel. They say that the China's recent stimulus, well, that bodes well, both in terms of sentiment and it also could give some kind of base to steel prices. The other worry has been that we've seen a high amount of imports coming into India, but they believe that, in fact, that will cut down. And in turn, if imports stop coming in, then we'll see some support to pricing as well. And that's why they believe that in the near term, there'll be some short-term green shoots that will be visible in steel spreads. They also go on to state that domestic steel prices were at a premium by around 8 to 9% in comparison to imported steel. That always poses a risk that the domestic prices could be cut. But now they say they've evened out. Domestic price of steel, if you compare it with imported steel, well, it's more or less at par. And because of that, they're optimistic now that steel prices would have bottomed out and will move up from here on. So they are raising the pricing estimates and in terms spreads, which results in higher target prices and turning their rating on some of those stocks as well. Starting off with JSPL, they've upgraded the stock. Now they have a target price of around 1,200 rupees. On JSW Steel as well, they've hiked the target price around 1,150 rupees. On Tata Steel, from underweight, now they have an equal weight and they've hiked the target price around 175 rupees. On sale, they were underweight. They maintained the underweight stance, but now they've increased the target price around 125 rupees. That's what Morgan Stanley has to say. Moving to Nomura, they've initiated coverage both on JSW Steel as well as JSPL, and they have a target price in the vicinity of around 1,200 to around 1,220 rupees. They are citing strong demand, which will hold them in good stead. Continued deleveraging has kept some of these balance sheets in very, very good shape. And also on the cost side, since these companies are focused on the cost side, those benefits will flow through as well in the coming years. And they highlight the Chinese factor, that Chinese HRC prices are trading at trough levels. And from here on, it could get some kind of base. We had made this point earlier as well. Very few Chinese producers are making any kind of money. So that's why that was calling for a bit of a basing out in terms of Chinese steel prices. They highlight a few risks as well. Suppose domestic demand weakens a little bit. Suppose there's monetary tightening, and if there's delay in any of these projects that they are, that they have already outlined in terms of an expansion, those could be risks. But all in all, Morgan Stanley as well as Nomura, they are positive on a select couple of names in the steel space. Back to you.
Okay, all right, Nigel, thanks very much for that. So that's what's buzzing in the entire steel space. But Petnet LNG is in focus after MK has upgraded the rating to a buy. Sonal is back with us and she has more on this.
Well, yes, MK is very bullish on Petronet LNG. They've upgraded the stock to a buy. They've increased the target price by 16% to 425 rupees a share. They reiterate their positive view. They say on the back of steady outlook and attractive valuation, the hedge utilization was strong in Q1. It was driven by power sector because we saw that peak summers as well. That has cooled off, but they expect higher utilization levels to continue. They believe 100% is achievable for the rest of the fiscal as well. The commencement and ramp up of Exxon's contract with higher Kochi tariffs, these would be the two big triggers going forward for the stock as well. And this is something which will lead to EPS upgrades of around 7 to 9%, better than what they had expected earlier for FY 26-27. The tariff outlook following Qatar gas renewal and calendar year 2028 has been a concern because a lot of the customers, they have been asking for revising those tariffs downwards. However, the management has reiterated any cut won't be material and minority shareholders' interests would be protected under this. So they build in reasonable assumptions, but they still see a lot of value in the stock. They think it is trading at around, they're valuing it at 14 times 1 year forward earnings. So they see a lot of value going forward.
All right, take that point. Thank you for that. And in light of all the stocks which are buzzing around, another one to that list is BSE. Following the SEBI's measures to curb speculative F&O trading, Vamakshi joins in with what brokerages have to say on this up move. Does this, Vamakshi, mean that, people curbing trading on NSE is advantage BSE?
Well, absolutely, Mangalam. NSE's, pain is expected to be BSE's gain. And, of course, this is on the back of the measures introduced by SEBI. One of these measures is limiting weekly expiries to one benchmark per exchange with effect from November 20th, 2024. And, in fact, analysts are expecting the highest impact to come through this particular measure. Now, IIFL Security says that the impact for NSE is expected to be relatively higher, given that it has 4 weekly expiries as compared to BSE, which has 2 weekly expiries. In fact, they've gone ahead and quantified the impact of the same. Around 35 to 40% impact on NSE option premium turnover is what they expect, and for BSE this is much lower at 15 to 20% impact. Earnings impact, however, for both of these exchanges is expected to be lower as compared to the turnover impact, and that is because they've now moved away from a slab-wise structure to a flat tariff-based structure. They're estimating a 15 to 20% hit on NSE's FY26 EPS. For BSE, again, this is much lower at 5 to 7%. BSE's option tariffs additionally are nearly 7% lower as compared to NSE. So IIFL Security says that to that extent, BSE does have an opportunity to offset the lower volumes impact. Additionally, BSE's market share gains could accelerate, and thereby it could further negate the earnings impact that could come through from these tightened F&O regulations. The key overhang, they say, is now behind us. The long-term growth potential remains quite intact. They continue to be quite constructive on the sector, and they have highlighted that any meaningful correction in these stocks is an opportunity to add. So overall, BSE is relatively better placed as compared to NSE, and that is the reason why the stock is surging in the trading session today.
Okay, all right. Well, somebody's loss is somebody's gain. Thanks, Vamakshi, for that. Well, for the markets, we have only just about 5 stocks which are in the green for the Nifty. So it gives you a sense about the kind of declines that we're seeing. So only around 45 stocks which are trading in the red. We'll do one thing. We'll take a break, but we'll full tilt on the markets. Up next, Aditya Agrawal will join in to tell us what his technical calls are in what is quite a weak and volatile day.
Or a Bank Nifty weekly option contract. Similarly, the BSE will have to choose between the Sensex and the Bankex. The benchmark is the Sensex, so most likely BSE will offer the Sensex weekly option contract. So I think this is the one which I think is going to dominate headlines and market participants, most impacted exchanges, brokers, everybody most impacted from this one. Number 3, intraday positioning, monitoring of position limits. This is effective from the 1st of April 2025. Currently, position limits are monitored on an end-of-day basis. Now, this is to be done on an intraday basis. Remember, The limit which was set, I think in 2020 during COVID period, was 500 crores based on notional value of trades. So this was monitored, but at the end of the day, now they're saying it has to be done on an intraday basis. Lots of feedback in terms of how this is going to be finally implemented. There is time, as I said, only effective from the 1st of April 25. Number 4, increase in tail risk coverage on the day of options expiry, effective November 20th. Basically, if you are carrying a position or if you take a position on the day of expiry, all existing positions on the day of expiry, old and new, will attract an extra ELM, which is extreme loss margin of 2%. So this is number 4. Number 5 and number 6 are pretty straightforward. Number 5 is upfront option premium, effective 1st of February 2025. And number 6, removing the expiry day calendar spread benefit, which is also going to be effective from the 1st of February. So I think these are the 6 changes which SEBI has implemented, largely in line with expectations. But I think the lot size increase and the fact that SEBI is limiting weekly options contracts to 1 per exchange will attract maximum amount of discussion and debate in terms of what this does for market volumes, exchange volumes, and what this does to market intermediaries as well. Back to you.
Right, Prashant, very quickly before I let you go, a lot of comments coming in, a lot of questions and queries coming in from the viewers as well on our social media handles, asking about the impact and the implications. Just in the near term, from a market perspective, you've probably been speaking with experts. What's the impact likely to be on the markets when we open tomorrow?
Shireen, so through the course of the day, we spoke with lots of market participants. Markets are prepared for this. I mean, we put out the story in the morning that this is to be expected very soon, that this is imminent. There was some expectation in some quarters, and we had clarified yesterday as well that this was not to come up along with the board meeting. And we said that, well, this is going to come soon this morning. So I think this is widely advertised. And the fact that what has been done is largely in line, actually mostly in line with what was proposed in July, I think does not come as a shock or a surprise. And also the important point is this.
You're watching us here on Halftime Report. Perfect time to get you, the market set up at midday itself. It's a big fall that you're seeing, almost 1,000 points of the mid-cap index, which was a relative outperformer in the first hour of trade, but thereafter has seen a big decline. The Nifty now below that 25,400 mark as well. These, numbers don't do justice to the pain that we're seeing in the overall market itself. So the next plate comes up for you. All the sectors, it's a sea of red and near ocean of red, 2% lower for the Nifty Auto Index. Even the metal sector, which is actually a relative outperformer today, has declined by almost 0.4%. The pharmaceutical index lower by 0.33% as well. Some of the high beta names like Nifty Realty, as well as some of the financials doing even worse. And we have the energy stocks as well, lower. A large part of that are crude sensitives too. So just keep an eye out on this space, led lower, of course, for the energy sector by all the oil marketing companies. When everything falls, what rises is the volatility in the market. And that's exactly what we're seeing here. The India VIX is up nearly 10%. In fact, from earlier this week levels, it has actually rallied about 25 odd percent itself. Add to all of this, we have the Nifty weekly options expiry playing out today as well. And we've broken important levels, the 20-day moving average on the Nifty Bank as well as the Nifty. Now the next level of support for the Nifty at the 50-day moving average comes in closer to 25,000 itself. Let's hope that level, for the bull's sake, does not come in today's trading session at least. So we'll watch out for that. Why do I say that? Because if you look at the way up, there has to be a lot of call writing that we're seeing today, closer to that 25,500 mark, telling you that levels upwards of 25,500 will continue to see some amount of supply. These are options that expire today. 25,400 put has some writing as well, 1 crore shares outstanding. So if we sustain below the 25,400 mark where we are at right now, there could be further unwinding out there all the way down to 25,250. Why do I say that? Because 25,300 put has the maximum open interest in all the options that expire today. So keep an eye out on that. And a lot of individual stocks in focus as well. So in particular, I'm watching out for Granules, which is doing well in today's trading session, may enter FNO ban, and Manappuram Finance as well. Down 3% today, may enter FNO ban too. So that's about the market setup at midday. Good time to get in a quick technical check as well. Aditya Agarwala joins in. Aditya, your thoughts on the indices and individual stocks? It's really a sea of red.
Oh, absolutely, Mangalam. And then this is something which I think a lot of analysts and traders were hoping for, a correction in the market, because we had seen a one-way rally in our markets as well. But yeah, the magnitude of the correction has been massive just in one trading session. We are coming very close to key support area of 25,300, which you also pointed out as the zone where maximum put open interest is also built up. This is the place from where we had seen that sharp rally in just few trading sessions from 25,300 all the way to 26,100. So now that should act as a key support area on the downside. If somehow bulls are able to hold that area of 25,300 in today's trading session, and we get a kind of a consolidation in maybe second half of the trading session or tomorrow, then I think we could be in for a short covering rally at least to levels of 25,500 to about 25,600 on the upside. The bank Nifty is where we are seeing the maximum pain point, and NBFCs, which had been outperforming all this while, are seeing a bit of correction in trade today. So 52,000 on the downside for bank Nifty is a key support area for me. If 52,000 is broken, then we could see further downside in some of the banking names, especially the large cap banking stocks. So both 25,300 on the downside and 52,000 on the bank Nifty is somewhere I'm eyeing very closely. If we're sitting on shorts, maybe we can continue to ride onto the short positions, especially on the Nifty and the bank Nifty. If somebody is looking to enter fresh short on the index, I would avoid now the index short trade. Maybe one can go for a stock-specific short trading ideas, which still offers some downside there in a lot of these stocks.
Okay, so any specific stock trading ideas that you would recommend at this point?
Yes, I've got a couple of short trades. The first is Apollo Hospital. If you take a look at stock, had been going up one way, and in trade today, stock has broken down from a rising channel on good volumes. Looks like there is more downside here. So at current levels, one can initiate fresh short in Apollo Hospital for a target of 6,700 on the downside, with a stop loss at 6,950 to about 7,000 on the upside. The second is from the auto name, auto major Tata Motors. This is one stock which has been underperforming for some time now, even before the market started to correct. And in trade today, it's broken down from its 200 DMA, which was a key support area all this while. So a trade below 200 DMA doesn't augur well for the stock. So I think there's more downside here. One can initiate a fresh short for a target of 890 on the downside with a stop loss at 940 on the upside.
All right, take that point. Thank you, Aditya, for joining in and giving us your stock picks. Ekta, you had a question?
Well, you know, just wanted, if we still have Aditya with us, Aditya, I just wanted your sense, because just in the past couple of minutes, there's been an extension in terms of the losses that we've seen. We have the Nifty, which is now down over 400 odd points. We have the Midcap index, which is, possibly going to race towards a 1,000-point cut. In such a market, where would you find spaces of, say, safety?
So Ekta, clearly the two spaces where we can actually look as safe haven, one is IT, even though IT is correcting today, but I think IT will be the first to bottom out and we can see a reversal in the IT sector. The second will be FMCG for sure. And these are both the sectors, if you take a look at the way these both sectors have been performing for some time, they have been outperformers. This showed that people were moving away from high beta names to low beta ones, run for safety, which is FMCG and IT. So my sense is, if you see further downside in the market, these will be the two sectors to hide and maybe go long on. So IT and FMCG. Within IT, maybe look for large cap names like an Infosys, TCS or NCL Tech. Within the FMCG pack, Colgate, Palmolive, or Britannia, Hindustan Unilever, all of them look attractive to me. And this minor decline that we are seeing in trade today offers an opportunity to go long on these two sectors, especially the IT and the FMCG. So for me, two safe havens are FMCG and IT as of now.
All right, take that point in particular on the IT and FMCG space and those names as well, because Dabur is actually underperforming from the FMCG pack. Just before we slip into a short break, pull up the intraday chart of Alembic Pharma. It's a big surge that we're seeing, counterintuitive to how the market has been for all the other broader market names. Midcap index is down 1,000 points, but Alembic Pharma at the high point of trade, having rallied about 8% from today's low itself. Take a short break, come back. We speak about, fundraise, our PE corner. And today we have with us the experts from Grant Thornton.
manner. It's not as if everything is being implemented by the end of the month or from a certain date. I mean, there's November 20th, there is April 1st, there is February 1st, all the way into 2025. I think that also kind of eases the impact a little bit.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and CNBCTV18.com.
First of all, I mean, we are seeing very strong momentum in the market, and clearly this is on the back of some very good rainfall. Of the 36 agri-climatic zones that we have in the country, 33 zones have got either normal or above normal rainfall. And even in terms of, if you see the state stratification, for only the states of Bihar and Punjab do we see little bit deficiency in the rainfall, but broadly all the agri states also have very good rainfall. In terms of revising the guidance, no, we will still maintain at 5% level because we want to see through the festive season and then maybe take a call at the end of Diwali. That would be our view. But most of the heavy lifting will happen in H2 of this year, and that would give us an overall 5% growth rate. September has been a slow month for us in exports, and there are 2 factors to it. One is that in our neighboring countries, there are some geopolitical challenges being played. These are all very big markets for brand Mahindra and Swaraj. And even in the US market, we are seeing that 11 quarters of continuous degrowth in US tractor industry. Now that is, we know the factors, that is on back of very high interest rate cycle, and people were waiting for Fed to start cutting. And now that has happened, I think the transmission will take 3-4 months time. And even in our US, which is our second largest market after India, the sentiment will revive. So that will again give us growth getting into our Q4. But I think for next 3-4 months, the exports might be a little slow.
Welcome back. Still tuned to Halftime Report on CNBC TV18. Well, it's turning out to be a rough session for the markets. The India VIX, like we pointed out earlier, has also spiked up quite considerably today. So up around 10-odd%, giving you a sense in terms of the volatility or the anticipated volatility, which is expected currently up around 10% at 13.2. But let's talk about the deal activity, which has been positive. Q3 2024, in fact, has witnessed a notable surge in deal activity with 618 deals valued at $26.9 billion. M&A volumes reached a record high, witnessing 214 deals valued at $11.4 billion, 337 PE and VC deals worth $7.6 billion, and Q3 also saw 42 QIPs worth $6.5 billion. What's the way ahead? Sumit Abrol, the partner at Grant Thornton Bharat, joins in now with his perspective. Sumit, hi, welcome to the show. If you could just start by giving us a sense about what the deal activity is looking like in Q4, because we're coming from a really big pedestal in terms of the M&A as well as the PE/VC deal activity. But is that going to continue into Q4? What's the pipeline looking like?
Thanks, Ekta, for having me on the show. And as you rightly pointed out, I think Q3 has seen a very significant surge after a rather subdued 2023 that we saw for deal markets. I think 24 has been a much better year, where I think corporate India's appetite for growth and inorganic expansion continues to be high, both in terms of domestic M&A activity and also on the cross-border side. I think outbound is something that really stands out, with about 50% increase in volumes on domestic M&A, doubling of volumes on cross-border outbound. I think some very clear, interesting themes playing out there. And also on the private equity side, and that's a segment which has seen very stiff competition from public markets with a surge in IPOs and new public market listings that we've seen. But despite that, I think the private equity trades have also held up very consistent across all quarters and are looking strong in terms of pipeline for Q4 as well. But at the same time, also I think some interesting themes there lined up for Q4, where I think Indian corporates will continue to buy for capability, for filling in the capability gaps, versus just to buy for scaling up and bulking up their positions or for consolidation. That's, I think, one theme which is likely to continue into Q4. And also on the private equity side, we are likely to see more control deals, more buyout deals, more platform deals. In fact, an interesting publication that GT Bharat has, we call it the fourth wheel publication, which tracks the financial sponsor activity. And one of the recent surveys that we did there very clearly talks about 86% of those investors on the street expecting far more increased allocations for the country in the coming times. And 48% of these investors foresee an exceptional activity for Q4 and beyond. So I think overall belief in the Indian corporates to create value continues to be strong.
Well, the expectations on one side, the activity is on the other side, because yesterday we heard from, notable investors looking to trim their positions in India as well, Peak XV, and we also have Chris Wood looking to reduce their exposure to India. I wanted to ask you, Sumit, is there anything underlying which this data is perhaps unable to capture also? Because while the activity has been high, the volumes have been high, they've also been fat-tailed by a couple of things. One, Zepto, the kind of fundraise that it has been doing over the last few quarters, that's one. Second one is Bharti Enterprises acquiring 25% stake in British Telecom. That's a one-off. It's a $4 billion deal. And then you had about 8, acquisitions made by Nazara Tech. If you take those off, which, one may think of as non-recurring in nature, then does this hold up in terms of a trend?
So, Mangalam, I think one of the other things which also needs to be seen in conjunction here is how are some of the other sectors playing out. I think the unicorns are back in flavor. The trades in early stage businesses, startup ecosystem have gone up considerably. Consumer and retail, for example, we saw volumes of over 100 deals in this quarter. Technology, which is IT and ITCS, saw close to about 80 deals there. BFSI, again, a sector in motion with seeing a lot of investor activity and M&A, about 60 plus deals there. So some of the larger deals that you're speaking about, I think some of those outliers have existed across all quarters. And even in previous years where we've seen activities surging to excess of $120 billion in overall values, which have been the highest recorded values for the deal street. Even those have been characterized by a few outlying large big ticket platform level acquisitions and trades. So these are themes which continue to play out. But in addition to this, I think some of the sectors, and within those sectors also, there are certain sub-segment themes which are gaining traction. For example, manufacturing, there is high value added manufacturing is seeing a lot of action in spaces like aerospace, in defense, areas of agri. These are spaces which historically haven't seen that level of deal activity, but things which are coming out quite significantly in the last couple of quarters. For example, aerospace and defense saw like 46 deals, if I have my numbers right, for the YTD 9 months of this year. So I think overall a mixed bag. The outlook in terms of the deal activity continues, and even the pipeline that we are seeing from private equity investors and the kind of platform transactions that are being put in play and that are being constructed as we speak continues to be quite strong.
Okay. Well, these are these interesting sectors that you did speak about: manufacturing, defense, agri. Is the deal activity the maximum within those sectors? Where are you seeing deal activity take place in terms of sector-wise, probably towards the close of the year and going into next year as well?
Yes, so Iqbal, I like to break that into two parts: activity in terms of volumes and activity in terms of value. Volumes, as I said, with unicorns back in flavor, we are seeing volumes go up in consumer-oriented spaces, e-commerce, startups, healthcare, which is seeing a lot of volumes, and we'll continue to see that kind of traction. On values, I think some big ticket transactions lined up in sectors in energy, particularly renewables, infra, and some of these private equity-backed consolidation control deal platforms are spaces where we see increased level of volume being values being contributed to the deal market.
All right, and final question then. We didn't see a lot of activity in the third quarter in the infra space, the manufacturing space. Do you think that's returning?
Manufacturing, as I said, the themes are around value-added manufacturing. And infra, as I said, there are deals in pipeline which will hopefully see the light of the day and closures. There is a market dislocation on pricing which public market valuations have created, which has emerged as one of the concerns also in that fourth wheel survey that I was talking about from the financial services sponsors community. But I think that some of those trades will hold up, and we will start seeing more action in private equity-backed positions in manufacturing and infra buyouts.
Okay, all right, Sumit, we're going to leave it on that note. Pleasure speaking with you. Thanks very much for joining in and talking to us. We need to take a short break. More on the markets once we're back. Stay tuned.
CNBC TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC TV18 India's #1 business news brand. Foreseeing change, growth, and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC TV18, your trusted partner and investment ally.
We like to stick to the fundamentals, and we won't draw first blood. But I mean, if there is a gunfight, we'll not go to it with a knife. So, one does end up participating. But having said all that, it just serves to advance the customer, the sales, but the customer expects it because that is the whole atmosphere during the festing.
Welcome back. The market continues to be lower, almost 400 points lower for the Nifty, but there is some sort of recovery for the mid-cap end of things. We're seeing a couple of stocks pick up from lows of today's trading session. Why do I say that? Because pull up, not only the mid-cap index, there you have a smidge higher from the lows. You have L&T Finance trying to make a bit of a comeback, Navin Fluorine trying to make a bit of a comeback. Both these stocks up about 2.5% from the lows. PVR Inox 2 is closing in at the lower, off the lower levels of today's trading session. Mind you, they're still in the red, but have seen some recoveries. No such respite for the frontline indices, still sitting at the low point of today's trading session, with the stocks in the broader markets the decliners far outnumbering the advancers. Almost 1,800 stocks in the red for just about 600 in the green itself. Good time to, throw it open then to the commodities arena. Manisha Gupta, as always, joins in.
Well, thank you for that. And I have a very special guest with me. Sachin Jain is India head for World Gold Council. Sachin, thank you so much for joining us. And it is a time when most of the tangible commodities really seem to be doing well. So whether it's energy or base metals and especially precious metals as well, if you look at the geopolitics kind of global trend data in sense of debt that we have, which is near record highs, and of course, expectation of another rate cut coming in the month of November. But even with all of this, we haven't seen yet another leg up in sense of rally. I mean, I do get a point that it is nearly $600 up from the lows of this year. But how are you reading the global markets and what's your sense on the gold?
Thanks, Manisha. Thanks for getting me on. And as you said, it's kind of a dichotomy that we are sitting on in terms of where the prices of commodities are heading, and of course the precious commodities as well. If you reflect just in the last 3 weeks, the first increase, of course, was an outcome of the Fed cut, how the US dollar weakened, and of course gold becomes more interesting for whole investor community. That compounded by the current geopolitics hasn't seen that much up, as you said. But I think a large part of all these, perhaps, these triggers were already incorporated in the way prices of gold are today. So we have to really be very carefully watching out the price of what's happening in the geopolitics situation. And I think that the large jumps that were based on any logic and based on reasoning and based on statistics have been very well incorporated already in the current pricing that you see.
Sachin, we've been talking to a lot of jewelers, as you would have been doing as well, and they tell us that while August was good, September must have seen a 10 to 12% of a decline in sense of sales. And if the prices continue where they are and if move any higher from here, then the Diwali quarter isn't going to be so strong.
Well, I think it's something that we've seen, year on year, and I would say through a decade, Manisha, where whenever the prices of gold have gone up, consumers tend to sort of slow down, watch it, and then get used to a certain price. We saw it. I mean, this year, 2024, has been a record year, as you say. We've seen 30 price, highs ever, 30 of them this year. Now, if you do a bit of analysis of these 30, most of them have been similar, where price went up, consumers get warmed up to that price, and they come back. Now, of course, it's going to impact, because if for an X price point you could only get a certain jewelry, yes, I mean, the household incomes haven't gone up in that fashion. The only, I think, I would say the sublime factor that we have to keep in mind is there are prices of gold in July were at a certain level. With the custom duty, it went down. And with the increase of gold price, it's going to be at the same level. So I think Indian consumers are quite, I think, inclined towards gold purchases. There's of course a great love for gold, and in the current pretext of how gold has performed financially, I believe that consumers will come back. Yes, September has been a slow month, and for the right reasons of same economic and same sort of always response from the consumers that when prices go up, they tend to be a bit of hold.
Going forward from here, and I do understand that World Gold Council has been doing a lot of gold campaigns across the country. What is the kind of feedback, partnerships that you are looking at during this festival season inside?
I think the interest of gold is an all-time high, Manisha, for all right reasons. When in terms of diversification of your portfolio, the interest of ETFs on one side of the financial markets, and also if you look at the jewelry side, the consumption, the inclination of consumers coming into the stores will be very, very high. The market is getting ready. We've seen in the last 2 months, right from IHS onwards, and recently there was a GJC show, we've seen that the industry from a jewelry perspective is getting ready. I'm very certain that the consumers will be witnessing some great creativity and some really amazing products on the floor. But I think also on the other side, the financial markets in India are doing really well. And gold is really has been a glittering factor in that area as well. So I think for the balance of the calendar year of 2024, we're pretty positive as to how gold should be rallying out in the next 3 months, 4 months.
Also, Sachin, there are various reports suggesting that the way the gold prices have been rising, the budgets have been as much, so you might see a decline in volume rather than value, which continues to be higher, but also on how gold really soon seems to be becoming a more of an investment product rather than jewelry. How are you looking at those numbers?
Well, actually, Manisha, if you look at the Indian context, this change of pretext of whether gold is a investment product has it's been a part of our culture, of our veins through ever. Now, there are more financial products that are of course getting more popular, And I only see one direction of travel. That is the younger consumers getting more and more interested in gold as a financial product. But I think if you look at India in a overall as an overall market, then you have to keep in mind that 70% of our market consumption happens in rural markets. We've come out with a very positive monsoon. Those are things that are underlying factors which we have to look at. And they all have always, I mean, historically and even today, connect to the consumption of gold. So, I think investment and jewelry tends to be a bit of confluence in a large part of India. I mean, you look at the gold loan market, which primarily runs on jewelry, so it's a financial sort of an asset that you can leverage. And on the urban side, we certainly are seeing much increase in the financial products. So I think both are here to exist, both are here to stay. But I think in the coming years, you'll see more technological sort of products going in. Even I think that both these industries would influence together and be almost similar.
All right, interesting conversation there out on gold, which is the only metal which is closer to an all-time high in a time when the markets are seeing a bit of a decline. So what we'll do is we'll take a short break, come back, get you more on other side of the equity markets, which is basically all the frontline indices and individual stocks. Wrap up on halftime report. Business Lunch takes all the market action ahead.
Participates in it, but once the dust settles down, it's back to good product proposition and customer care.
Let me address that constituency that you just spoke of, which is, of course, one of the most crucial constituencies, which is the regulator. And I think that is the big overhang today as far as the Kotak Mahindra Bank story is concerned, with the RBI imposing restrictions on account of deficiencies in the digital and IT infrastructure, not allowing you to onboard mobile as well as digital customers, as well as putting restrictions on your credit card business. Now, if you can share with us details on what you've been specifically able to do to demonstrate to the Reserve Bank that you are adequately or appropriately addressing those deficiencies, and where do you believe that you stand? I mean, there is, of course, an external audit that's also been sought, but where do you believe you stand in the remedial measures?
So, Shirin, first things to start, where we started with is, look, India has the best digital public infrastructure compared to any other place in the world. I've worked in every other place in the world. I've never seen anything like this, right? Now, obviously, that has led to the demand for digital services having gone up dramatically. And it's about the bank systems having to keep up pace with that. So we've been spending the last couple of months really focused on how we grow and make our systems foolproof. And like in every crisis, there's an opportunity. So we've taken this as an opportunity to really say how we'll really leapfrog and make our systems really resilient and relevant for the days to come. So I think we've made very, very good progress. Obviously, we've been in continuous touch with the RBI, sometimes even every week, updating them, getting their guidance, making sure we're on the right path. And I think we've made tremendous amounts of progress, and we'll continue to do it. Obviously the RBI is exceedingly important, but the customer, I've got to get it right by the customer.
Yeah.
I got to stay resilient for the customer. I need the best customer experience for the customer. And, RBI has told me, you got to do it. So.
CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories.
Welcome back. You're watching us here on Halftime Report. We're speaking about the markets. Keep an eye out on a couple of these stocks which are now trading the lower end of today's trading range. Interglobe Aviation is the most notable of them. Buoyed also further by lower demand environment and also higher crude prices. Crude prices hovering towards that $75 per barrel mark. Interglobe Aviation at the low point IRCTC itself too has moved towards the lower end of today's trading range. Persistent Systems, a stock that did well all of last week, has now moved to the low point of trade as well. So just keep an eye out on that one. A bunch of stocks which are trading the lows of today's trading session, along with the frontline indices, where you do have the Nifty still sitting with a cut of almost 415 points. An important next session of trade coming in after this short break. We've wrapped up on halftime report.
Agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Two 6-week periods during which the inflation rate has fallen, that can give a lead to cut the repo rate. Choice is between 25 basis points and 50.
Stocks see a sharp fall following renewed tensions in West Asia following Iran's missile attack on Israel. Realty and automobiles are the biggest losers, with metals and oil producers being the two green spots.
Market regulator SEBI issues a tad less stringent final rules for the F&O traders to protect small investors. Increase in minimum contract size, curbing weekly index contracts, stiffer margins and closer monitoring are some of the steps. Experts see these curbing activities in F&O going ahead.
Dabur says disproportionately higher growth in modern trade, e-commerce and quick commerce has impacted the general trade. It decides on a one-time measure of correcting traditional trade inventory. The stock dips in today's session.
Crude prices leaped following Iran's attack but cooled as OPEC's ideal capacity of 5.7 million barrels per day exceeds Iran's output of 3.4 million barrels per day. The possibility of a wider conflict, however, keeps the markets on the edge.
Good afternoon, you're watching Business Lunch here on CNBC TV18. I'm Hormuz Fatakia. With me is Vinny Motiwala, and over our heads you can see a very, very red looking screen on expected lines, if you could say that, considering the rising geopolitical tensions in the Middle East. It's also the weekly expiry today. A lot of factors playing out for our markets, but as of now, for the Nifty, it does not look a very good afternoon whatsoever. Down to the lowest point of the day, 450 points down on the index now, well below some very important levels. The 20 DMA was the one to track. It's well below that now, 25,350. Where the Nifty has fallen to. 45 stocks on the Nifty trading with losses. 11 out of the 12 stocks on the Nifty Bank are also trading with losses in today's session, and the Nifty Bank too is a key culprit for this downfall that we are seeing on the Nifty in today's trading session. Remember, this 8-day rally that the Nifty Bank had seen earlier has now almost tapered off in its entirety, because it had gained some 3,000 points during those 8 days, and now it has given up almost well over 2,000 points from the highs that it made on Thursday afternoon, which was 54,467, and from there it's down almost 2,500 points. And there you can see the contributors to the Nifty Bank's fall: HDFC Bank, ICICI, almost all banking heavyweights contributing to the fall, and Reliance Industries, of course, that too is contributing to the fall on the Nifty. Almost 65 points to the Nifty downside are coming from Reliance Industries. The broader markets too not doing very well in today's trading session, and both mid-cap and the small-cap indices too are seeing some bit of pain. Vinny, good afternoon.
Good afternoon, and not much of a good afternoon or a good day that we're seeing, at least coming in for the markets. Nifty mid-cap also, like you were saying, broader markets too are under pressure as well. Look at it, that is also trading near the day's lowest point. You know, just marking some of the stocks that are among the top losers today. We do have Dabur that's down and out after a weak Q2 update. HPCL, Godrej Industries, BPCL, IRCTC among the names that are trading in the red and seeing cuts of more than 4 to 5% that we're seeing. Petronet LNG, on the other hand, managing to hold on to some bit of a gain. We did have a brokerage note that came in from MK, so that's holding on to good gains of almost 6%. Petronet LNG. Let's pull up BSE as well as Angel One. They are holding on to some bit of a decent gain today, more than 5% gain that we're seeing for both these stocks as well. And that's what we'll be focusing on. And let's begin today's business lunch by focusing on that important story that we have. Shares of BSE, which is surging today. Why? Because SEBI has put out some measures to curb speculative F&O trading. Vamakshi is here with us to highlight what does this mean, as well as what the brokerages have to say on this move as well. Vamakshi?
Well, absolutely, Vinny. NSE's pain is BSE's gain this time around. When we look at the measures that were introduced by the SEBI, one of the measures is limiting weekly expiries to one benchmark per exchange with effect from November 20th. Now, keep in mind that analysts expect the highest impact to come in from this particular measure. IFL Securities says that the impact for NSE relatively could be higher as compared to BSE, because NSE has 4 weekly expiry as compared to BSE's 2. 35 to 40% impact is what they expect on NSE's option premium turnover, as compared to 15 to 20% in the case of BSE, which is much lower. Earnings impact, however, could be offset due to shift to flat tariff structure. In fact, they're estimating a nearly 15 to 20% hit on NSE's FY26 EPS estimates, but for BSE, this impact is much lower at only 5 to 7%. Additionally, BSE's option tariffs are nearly 7% lower as compared to NSE, and to that extent, BSE has an opportunity to offset the lower volumes impact. They also believe that BSE's market share gains may accelerate and thereby further negate the earnings impact that could come through. Overall, IFL Securities has highlighted that the key overhang is now behind us. The long-term growth potential looks quite strong, and they continue to be constructive on the sector. They highlight that any meaningful correction in these stocks is an opportunity to add. So therefore, relatively, BSE is better placed as compared to NSE, and that is the reason why the stock is standing tall in the trading session today.
Off the highs of the day, though, is BSE, but on a day when the markets are down almost 400 points, you take a 5% gain with both hands and some more. Vamakshi, thanks a lot for that update and putting all of that together for our viewers. But Rajesh Baheti, who is the Managing Director at Cross Seas Capital Services, also commented about the recent changes in these F&O rules and explained how they could impact the exchanges. Listen to what he said.
My suggestion to the NSE would be to retain the Bank Nifty as a weekly contract and move the Nifty to the monthlies. I think that would mitigate some of the losses we are talking about in terms of volumes for the NSE. Because clearly the day trading and market making and the weekly of the Bank Nifty is far more lucrative, both for the traders' point of view as well as the NSE's point of view. If that were to happen, then I think the losses can be contained at 15 to 20%. But if they decide to retain the Nifty, then I'm afraid, we're looking at a 30-40% drawdown for the NSE in its earnings.
Okay, let's move on and talk about some of these FMCG stocks and what they are doing in trade. Dabur is down and out, but Marico actually managed to report a decent quarter two update. Mangalam is joining with us to give us more of the details. Mangalam, good afternoon.
Good afternoon. So if you look at Dabur, the stock is down about 6% because it is a dampener that has come in terms of the Q2 update. And the biggest reason for that are two. The first one is that there were, a lot of heavy rains in some part of the countries with a lot of floods as well. So that impacted the beverages part of their business. But that's not as much as the second part, and which is the rise that we've seen in modern trade, e-commerce, quick commerce in particular, has led to a lot of inventory stockpiling in a lot of the general trade players, and as a result of which the companies decided to correct the inventory in that channel, and because of which the primary sales in this quarter are lower, and the company will report a decline in mid-single digits. And that's, in opposition to what the management had said over the last couple of quarters as well, guiding for a double-digit revenue growth in this particular fiscal. Lower primary sales and higher ad spends meant that the EBITDA will be impacted as well. Mid-teens to high teens is the margin that the company will report as against their guided band of about 20% as well. So let's see where that pans out. Though going forward, remember, the company believes that this is just temporary and it will see a recovery from October itself, and parts of their business, which include the likes of the masala business and the international business, have done well. So let's see whether there would be recovery from the stock after having corrected about 100 rupees from its 52-week high as well. For Marico, on the other hand, the stock is holding resilient in today's trading session because they've reported a single-digit growth in their consolidated revenue, led by mid-single-digit growth in India volumes. What really stands out is in the last quarter, the stock was an underperformer because of the domestic turmoil in Bangladesh. The Bangladesh business for the company this time around, despite that turmoil, has reported a resilient high single-digit growth, and that explains why the stock is higher. Though it's not running away because of two factors. One, the market itself is weak, and secondly, there is some moderation in operating profit, and with the rise in commodity prices, maybe further margin expansion could be under pressure or could be skeptical, which is why we're seeing a mild green in Marico and a bigger red in Dabur.
Mangalam, thanks a lot for that. Not a very good afternoon for Dabur. Indeed, 6.5% lower now at 580. But another pocket that is holding on to some bits of gains this afternoon is the steel sector. And stocks like JSPL, JSW Steel are doing well in today's session after bullish notes from brokerages like Morgan Stanley and Nomura. Nigel is joining in with more details. Nigel, tell us what they had to say.
Well, that's right. Morgan Stanley, they are quite positive on steel on the whole. They say that China's recent stimulus, that holds in good stead, and that's what will support pricing from here on. They're also addressing the recent problems like imports that are coming into India. They believe that that will stem from now on. And in turn, when imports reduce, it will support, the spreads as well. They're also saying they're beginning to see some green shoots in the system, and that's going to be positive in terms of profitability from here on. The biggest problem for the last few months was the street was very, very nervous about pricing. Domestic pricing was at a big premium in comparison to imported steel. So you always fear that pricing will be pulled back 5 to around 8% odd. But they say that gap has narrowed down, and now domestic pricing is at par with what imported steel is. Now, on individual stocks, they've gone ahead and upgraded the stocks. So they've upgraded all of them, and let's run you through the list. On JSPL, they've upgraded the stock. Target price moves to around 1,200 rupees. On JSW Steel, they've upgraded the stock. The target price is at around 1,150 rupees. On Tata Steel, they have upgraded from underweight to equal weight, and the target price moves to around 175 rupees. And on SAIL, they were underweight, they're remaining underweight, but they say that the target price now they've upped it to around 125 rupees. The key reason that the target price is moving up is because they have upgraded their steel price estimates, which is reflected in better spreads. Moving to Nomura, they have initiated coverage on two stocks, JSW Steel as well as JSPL. Target price they have is in the vicinity of from 1200 around 1220 rupees. The few factors that they are stating is that domestic demand is strong, so that's great news. Deleveraging by the Indian ferrous companies has been good, and that's held the balance sheet in good light. So that's good news. Now pricing, yes, we believe that in fact there could be some kind of recovery from there, but the companies have also focused on the cost side. So lower cost is what will support profitability going ahead. They, however, highlight a few risks as well. In case domestic demand gets weakish, suppose you have some changes in monetary policy, and suppose the expansions that already have been announced, suppose there's a delay out there. Well, those factors could be a bit of a risk. But otherwise, both Nomura as well as on Morgan Stanley, they're positive on some of these steel stocks, namely JSW Steel and JSPL. Back to you.
Okay, JSW Steel, JSPL, keep an eye on that. As of now, JSW Steel holding on to more than 1% of gain. But on that note, let's just take a very short break. After the break, we'll return and put the spotlight on Israel and Iran as tensions in West Asia lead to a surge in crude prices. Stay tuned in for all those updates.
Points. If we want to be cautious, we can cut 25 and store something for the next time. Or we can take front-loaded cut of deeper thing. There are two ways of creating competition in the system. One is really letting new private sector banks to come in. The other is privatize some of the nationalized banks or increase the private content in the national. We have now reached a stage in which we should really be able to get more banks in the private sector. So I would really say that let an atmosphere and environment be created where new private entities can enter.
We are revising 100% booking value guidance to 4,800 crore to be done in FY25. So this is in summary the response to Estate 360. We have some units remaining. That's why the total 100% booking value guidance is now 4,800 crore, of which 4,100 crore has already been booked.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube.
Welcome back. You're watching Business Lunch on CNBC TV18, and let's talk about the tensions that are escalating in West Asia as Iran has actually launched a heavy missile attack on Israel on Tuesday following a strike by Israel on Hezbollah in Lebanon. Now, Israel has vowed to retaliate to the Iran's missile attack. NBC's Richard Engel is bringing us more details from the war front.
After Iran's most intense strike ever against Israel, raining down almost 200 ballistic missiles, nearly all of them shot down, including by interceptors from a U.S. destroyer. American and Israeli officials tell NBC News Israel is preparing its response. A senior Israeli official says the response will come swiftly. While in Israel, no fatalities, but they were assessing the damage, including from an Iranian strike on a school, visited by NBC's Erin McLaughlin.
This is what remains of one of the classrooms. They say the missile struck just over this way and then blasted into the side of the school. Israeli officials say no one was injured, but this could have been so much worse.
Israeli Prime Minister Benjamin Netanyahu said Israel's fight is not just with Iran, but its network of militias across the Middle East. We are in the middle of a tough war against Iran's axis of evil, which seeks to destroy us, he said. President Biden said he supports Israel's right to retaliate, but said it must be proportionate and that he would not support an attack on Iranian nuclear sites.
There are things that have to be done. And it's obviously Iran has gone way is way off course.
The administration is seeking to avoid a regional war, but that ship may have left port too.
Israel's war here in Lebanon is escalating. After initially holding back, apparently to assess Israel's strength, Hezbollah is now engaging Israeli troops directly in close combat as towns and cities are emptying out.
As the Israeli military released images of what it says are Israeli troops operating inside Lebanon, it also announced its first casualties. At least 8 soldiers killed.
And in an immediate response to a conflict like this, the first impact is always on crude oil prices that have been on a tear over the last 3 sessions. Manisha Gupta is here with more. Manisha, the response may or may not be swift, but the recovery in oil prices has been pretty swift.
Oh, well, absolutely. You know, when something like this happens, Hormuz, you will always see tangible commodities gain up. We've seen safe haven buying in precious metals, and with the kind of damage and destruction that we have seen, even base metal prices, recovery metals, property metals also start to do well, and energy prices clearly saw a knee-jerk reaction. The best actually 5% of gains immediately after that news came in, and we still are trading around those higher levels. Today is a third straight day of gains coming in for the crude oil prices, and this is after the damage that we have seen on the screens right now. Well, also when you look at the Middle East overall, and there are concerns of all of this escalating, 1/3 of global crude oil production comes in from Middle East. So if this spreads further east, then we are looking at some concerns coming into the markets there. But in the meanwhile, the markets also are looking at the overall global supply and demand. Remember, with all of this happening, we haven't seen any oil facilities being damaged. The production continues as swift, and so has been the case with logistics as well. This is the number that the street is watching at this point in time. The OPEC plus spare capacity stands at 5.7 million barrels versus all of Iran production at 3.4 million barrels. So we are looking at higher supplies, excess inventories, and that is keeping the crude oil prices in check. For this current year, the overall high for Brent prices has been at 91. We've seen a low of around 68 as well, but from those kind of levels as well, 75 is still $15 lower from this year's high. This is what we've done in the previous month, 9% of a decline, and a near 17% of a decline for the third quarter as well. So from that, October month has started on a positive note there. The markets also will watch out for the US production, which has been on the higher side and could be ending this year much higher at 13.5 million barrels per day there. The US gasoline demand in the meanwhile is the lowest in 6 months. 3.9 million barrel of a buildup is what we've seen in case of the US inventories. And even as yesterday was an OPEC meeting where they have kept the policy unchanged, told its members to keep up to its production quota. And then the street is also looking at the 1st of December. That is when the OPEC will have a full-fledged meeting as well. Well, going forward, it is going to be about supplies and the Chinese demand as well. A very interesting report from Wells Fargo tells you that this year production is at 102.8 million. Next year could be much higher at 104.8, while the demand is anticipated at 101 to 102. So we are looking at higher supplies. Even interestingly, that even as all of this is happening, the street believes that going forward in the next year, you could be looking at an average of best perhaps at 77, most believe 75, and Citi talks about 60 as an average for Brent in the next year as well. So not too much higher prices is what the street is factoring in.
Okay, thank you so much for that, Manisha. But on that note, let's just slip into a very short break. Don't go anywhere. More updates after the break.
How about listening to global market maestros before crafting your investment strategy?
Investing.
Welcome back, and it's only getting bad to worse for the markets now. The Nifty is down below that mark of 25,350, now closing in on 25,300, almost 500 points down on the index. The Nifty Bank has already slipped 1,000 points now in today's session, below that mark of 52,000. 2% lower on the Nifty Bank, and some flashes on your screen as well with regards to some issues with HDFC Securities, where investors and traders are facing some issues in placing orders at the HDFC Securities platform, and CNBC TV18 has reached out to HDFC Securities and are awaiting comments from the same. So only getting worse for the markets on this weekly expiry session. But ChatGPT maker OpenAI is now more valuable than Goldman Sachs and Uber. Now, this comes after the company successfully completed a $6.68 billion fund round. CNBC's Kate Rooney has more on this.
OpenAI has officially closed one of the largest private funding rounds in Silicon Valley history. The total coming in at $6.6 billion. This was at a $157 billion post-money valuation. I'm told by a source it was led by Thrive, SoftBank also invested in this round. Microsoft doubled down. You had NVIDIA, UAE-backed fund MGX, Khosla Ventures, Altimeter Capital, and I just confirmed that Kathy Wood's ARK Invest was also in this round. OpenAI says the cash is going to help them with AI research and then to increase compute capacity and build tools that help people solve hard problems. OpenAI is, of course, the maker of ChatGPT. We learned today it has 250 million weekly users. That's more than double what it had about a year ago, and then up by 50 million or so in just the past 2 months. It's now one of the most valuable private American companies just behind SpaceX, and it is ahead of Stripe at this point. To put the value in context, at least on paper, this company is now more valuable than Goldman Sachs. If you look at market cap, Uber, Lockheed Martin, and it's about double the value of Chipotle. OpenAI is still, I'm told, in the process of becoming a for-profit company.
Okay, and moving on to some more updates. From the Google for India Summit, availing credit on Google Pay app will now be easier with personal loans now available on the platform in association with Aditya Birla Finance, and gold-backed loans will be also made available courtesy of Muthoot Finance. Okay, that's all the time we have on this edition of Business Lunch. Thank you so much for tuning in. From Hormaz, myself, as well as the team who put the show together. But don't go anywhere. Midcap Radar up next.
Deep insights into their businesses from top Indian honchos before putting your money on the line. How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBCTV18.com.
ما يفكروا انه بس حزب الله بوجهه، كل الشعب اللبناني كله بوجهه، وان شاء الله النصر مثل ما وعدنا فيه رب العالمين. ان شاء الله اسرائيل جربت قبل بمره وما طلع مع لبنان. مش بس في حزب الله، كل لبنان بده يحارب هالمره. كل لبنان ناوي على اسرائيل، على المجازر اللي ارتكبتها بغزه والمجازر اللي عملتها بلبنان. ان شاء الله ما حيضل واحد الا ما حيحارب. ما يفكروا انه بس حزب الله بوجهه.
Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me is Vivek Kayar. The sell-off has intensified. It's a 500-point cut on the Nifty that we are looking at. Midcaps participating too. We have the Bank Nifty, which is sitting with cuts of almost 1,000 points. Almost all the sectoral indices are in the red right now. We had metals which were doing well, but that's been quite volatile as well. And usually we talk about the mid-caps on the show, but just look at the way some of these large caps are falling. HDFC Bank, ICICI Bank, SBI, all these major names at the day's low. The question is whether there is more correction ahead.
The question is whether there's more correction ahead. We've started off the second half of the trading week, after a midweek holiday on quite a negative note. It's a screen and it's a sea of red that you can see on the top of your screen as well. So quite a lot of correction is seen both in the front line and even the broader end of the markets, especially if you look at the advanced decline ratio across the NSE 500 mid-cap, small-cap index, it is extremely weak. So indicating that, declines are far outpacing the advances. But quite a lot lined up on the show. Let's start off with the top headlines. Stocks see a sharp fall following renewed tension in West Asia following Iran's missile attack on Israel. Realty and automobiles are the biggest losers, with metals and pharma trading flat.
Steel stocks like Jindal Steel, JSW Steel, Tata Steel buck the overall market trend after Morgan Stanley says China's recent stimulus should drive positive sentiment and support steel prices. Nomura initiates coverage on JSW Steel, and JSPL says continued deleveraging to support Indian steel majors.
Dabur trades under pressure. The stock is down more than 6% following a guidance of decline in revenue as well as margins in the second quarter in the company's Q2 FY25 business update.
Crude oil prices hold gains post Iran's attack on Israel. OMC paints and aviation stocks under pressure. Okay, so Nifty is below that 25,400 mark, just at the 25,300 mark as we speak. It's almost a 500-point cut that we are looking at the day's low. It's been a one-way slide since the time we have opened and we have started trading today. And this comes in after that holiday that came yesterday. And a lot happened in the last 48 hours. It's been really busy. Whatever we've seen in terms of tensions across West Asia, and that's something which is impacting the markets. Reliance is a big drag today, almost 76 points there, followed by HDFC Bank and ICICI Bank. So all these major movers are leading to the losses that we are seeing today. Mid caps again lower in trade today. We have the Nifty small cap, which is sitting with cuts of 2%. Actually, there's none of the sector which is in the green.
That's right. Oil prices aren't up by too much. It's not a very sharp spike that you're seeing, just $2 to $3 a barrel. But all of the oil sensitives, look at all of the OMCs, HPCL, BPCL, all of them are taking quite a deep cut. Even paint stocks today, even aviation stocks, all of them actually seeing quite a bit of correction. But I'm sure Hormaz has these as well as a whole host of other names on his list. This is our special segment, Midcap Movers. Hormaz is at the wall and he'll take us through the midcaps that are moving.
The color is red, and a very deep red for the benchmark indices and for the broader markets alike in today's session. The sell-off just intensifying. The mid-cap index is now down 1,200 points at the lowest point of the day. So we'll start off with some of the losers within the broader markets, and there are plenty of them, mind you. Dabur is now down 6.5% after the business update, as is HPCL. Almost all the oil marketing companies are down in today's session after that rally in crude oil prices. Godrej Industries and Brigade Enterprises are some of the other losers within the broader markets. Now, a sector that we used to talk about at its prime almost every single day, but we don't talk about it anymore, is the railway stocks. And these railway names have now corrected anywhere between 30 to 40% from their peak. And today is no different. Titagarh is the worst performer among those railway names, is down 40% from its peak now. IRFC and Ircon are some of the other losers in today's trading session. Some of the other names that are not doing so well in today's session, actually some of them yes, some of them not. The FNO norms, the impact that it has had on BSE and Angel One off the highs of the day, but still holding on to gains. Can't say the same for IIFL Securities and 361 WAM. Stocks doing well or not so well on the back of volumes in today's session. And Just Dial, Jubilant Ingravia, Amber Enterprises, some of them bucking the trend, gains of around 3.5 to 4%. And lastly, a lot of brokerage commentary that emerged from the morning, and JSPL is one such stock still holding on to gains. Petronet LNG is an outlier, 6% 2% higher after that upgrade that has come in, as has KPIT Tech, almost 2% higher in today's session. But overall, the color is a deep red. Back to you guys.
It is, but some of them are defying the market moves today. But take that point. Thank you so much, Armas, for joining in as always. It's time to get a technical check on the markets. Vinay Rajni of HDFC Securities is joining us for that. Vinay, tell us what are the next important levels to watch out for on the Nifty and your individual picks.
Yeah, good afternoon and thanks for having me on the show. So from the all-time high of 26,277, Nifty has fallen by 1,000 points, and the next support I see in the Nifty is around 25,070, which is nothing but the 50 days exponential moving average. Earlier in the August when Nifty fell, it found support at 50 days EMA and bounced back nicely and again registered a new all-time high. This time the 50 days EMA is placed at 25,070 odd level. So this is the only support I see, and this correction is deep and sharp, and this can continue to be like this. We are not getting a 50 points bounce back in the intraday also. So there is a huge amount of selling pressure which is there in the Nifty. So I see a support around 25,070, which can act as a support for the short time. So on the higher side, 25,400 now becomes a strong resistance. So unless we close above this level, the trend should go like this only. So the next support is 25,070, which is 50 days EMA. The stock I like in the mid-cap segment is relatively can do well is the diagnostic stocks like Vijaya Diagnostic, which is placed around 970 odd levels. So the entire diagnostic space has been resilient, and I think Vijaya Diagnostic stock can outperform this market. So around 972, one can take risk. Stop loss can be kept at 950. On the higher side, I'm expecting a target of 1010. So this could be on the long side. On the short side, I would go with the selling Ashok Leyland, which has given a fresh breakdown. So if somebody wants to look for the short trades in this kind of markets, Ashok Leyland can be shorted around 232. Stop loss can be kept at 236. And on downside, I'm expecting a target of 224.
Okay, thank you so much, Vinay, for joining us and giving us both a view on the market as well as your individual picks for the day. Let's now slip into a short break. Jitendra Adya from Atul Auto joins us next to discuss September sales as well as business outlook going forward. Stay tuned.
There is a petition filed in Honorable Supreme Court about the constitution of the sit. So some arguments went on yesterday. So we've been informed to stall the further proceedings for till 3rd, that is till tomorrow, the day after tomorrow. In the meantime, yesterday evening we were informed that the Honorable Supreme Court said that you hang on for some time. So in adherence to the Supreme Court order, we have stopped for the time being. So once the order comes, we are very sure that the order will come, because after all, it is a criminal case which we are investigating. So is it against the sit only, or about the investigation, about the case? We'll have to see once the order comes actually. But in the meantime, we have been informed, so accordingly, we have stopped it for time being.
The regulations are out. As we said, they were likely to come out today or tomorrow, and they're finally out. And I have to say, they're largely in line with expectations. So in July, SEBI had proposed 7 things, 6 out of the 7 actually have been implemented with very minor changes. So I'll start with what is going to be top of mind. Number 1, higher lot size value. This is going to be effective from the 20th of November. Basically, for index derivatives, which is Nifty, Bank Nifty, and other index derivatives, at the time of introduction, the SEBI is saying that the contract value should be between 15 and 20 lakhs at the time of introduction. At least 15 and up to 20. That is number 1. This is a simple and clean measure to limit the number of people who are able to trade this, trade index derivatives. Number 2, and I think a lot of interest around this, only 1 weekly option contract per exchange. This is also effective from the 20th of November. Remember, right now, NSE has weekly contracts, weekly option contracts on the Nifty, the Bank Nifty, the Midcap Index, and the Fin Nifty as well. BSE right now offers weekly contracts on the Sensex and the BankX. NSE now will have to choose one.
Investing.
Welcome back. Well, a quick look at the Nifty, because we've fallen below the 25,300 mark. It's a more than 500-point cut that we are looking at. And it is led by a lot of components, but HDFC Bank, that is one name that you should watch out for. That also is at the day's low. So we'll keep tracking all these market moves for you. But let's move on and talk about a corporate conversation. Atul Auto is in focus. For the month of September, company witnessed total sales of 3,361 units, which is up 26%. They also sold 978 units for EVs. Jitendra Adya, the President of Finance at Atul Auto, is joining us now. Mr. Adya, good afternoon. Thank you so much for joining in. Well, your total sales year to date are up 47% across all the segments. Is this something you will be able to do in the second half of this fiscal as well? What is the total growth you're anticipating in volumes? And ultimately, what would that mean for your revenue growth?
Very good afternoon to you, and really excited to see the September numbers. Obviously, in the first half last year, the first quarter was disrupted because of non-availability of OBD2 compliance. So, obviously, we cannot expect the similar growth in a second half, but definitely it would be more than decent. And in overall sales, we expect that we will be able to deliver much better numbers compared to the last year.
Okay, so you're expecting year-on-year growth. Can we pin you down to a specific guidance in terms of volume growth that we can expect of FY25 compared to FY24?
Absolute numbers would not be possible, but obviously
a range maybe.
Looking at the first half numbers, definitely it will be much better than the last year.
So you had earlier indicated it would be a 20% growth in FY25. You would be back to pre-COVID levels. EV contribution should stabilize at 25 to 30%. Is that a doable number, or you'll actually exceed this guidance as well?
I am still on that stand only, and definitely expect a similar pattern of growth going forward as well. As long as EV is concerned, as you have mentioned earlier, almost 1/3 has been contributed by EV in our overall sales. That really gives us more confidence. We are setting up exclusive as well as composite dealership for sales of EV. Along with that, alternate fuel is getting settled into the market, and we expect that in whatever overseas market we have exported the volume, where we have repeat orders, and going forward we will be able to gain numbers from export market as well. So in totality, all three fuel is definitely going to contribute.
Okay, so you're speaking about the export markets. Give us a sense of how numbers there are panning out. Give us a sense of the targets you've set for yourself, and also give us a sense of the margin differential you enjoy, by exporting your products versus the domestic market.
See, let me answer your last question first. The margin profile is more or less same, not much of a difference, but obviously export gives us a little better margin compared to domestic one. About volume, we are still into a seeding phase. Currently, 10% is revenue is being earned from export market. I believe that going forward, this may increase anywhere between 15 to 25%.
All right. Most of your volumes are coming in from the Ahmedabad plant. The last known utilization was 50%. How much has it increased to by end of this year? What will the utilization number look like?
See, as a part of economization and considering the current situation, we are operating from Ahmedabad plant only. Rajkot plant, we are doing machining and engine assembly is being done over there. So that capacity is intact, and once we are able to utilize our current plant capacity that is from Ahmedabad, we will activate that plant as well. As of now, the total utilization is Ahmedabad capacity utilization is anywhere between 60 and 70%.
Mr. Ajay, just to give us a sense of how policy action is actually helping you currently, and also, going forward, do you expect some of these incentive schemes to eventually wane, and do you expect that will have an impact on your demand? You've set very, ambitious targets as far as the electric part of the business is concerned, but do you feel that the waning away of, some of the incentive schemes that are currently present could have an impact on demand?
As long as EV is concerned, yes, it will definitely have, as long as, lithium-ion prices are not stable, and it is expected to drop further. So once it comes into stable form, and once the technology itself is stabilized, because when we are talking about lithium-ion, people started talking about solid-state battery as well as sodium-ion as well. So from OEM point of view, we would definitely like to see how the trend moves. But as long as government incentive is concerned to promote use of EV, definitely it will help. And this time, PM E-Drive, which is covering comprehensively, even for testing agency and putting up public infra, that will also going to help OEM to accelerate their sales process.
All right. Mr. Adya, thank you so much for joining in today with that take. Would have liked to talk a little more about markets, a big fall that we are seeing there, but we'll be speaking to you very soon again. So we are below that 25,300 mark and just at the 25,250 mark right now. So there's a further fall that we are seeing right now. We'll discuss that. But as we slip into a short break, here is some good news for the viewers. India's business news leader is now click away, introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store.
Only one, and that too a benchmark contract. So most likely they'll have to decide whether to keep a Nifty weekly option contract or a Bank Nifty weekly option contract. Similarly, the BSE will have to choose between the Sensex and the BankX. The benchmark is the Sensex, so most likely BSE will offer the Sensex weekly option contract. So I think this is the one which I think is going to dominate headlines and market participants, most impacted exchanges, brokers, everybody most impacted from this one. Number 3, intraday positioning, monitoring of position limits. This is effective from the 1st of April 2025. Currently, position limits are monitored on an end-of-day basis. Now, this is to be done on an intraday basis. Remember, the limit which was set, I think in 2020 during COVID period, was 500 crores based on notional value of trades. So this was monitored, but at the end of the day, now they're saying it has to be done on an intraday basis. Lots of feedback in terms of how this is going to be finally implemented. There is time, as I said, only effective from the 1st of April 25. Number 4, increase in tail risk coverage on the day of options expiry, effective November 20th. Basically, if you are carrying a position or if you take a position on the day of expiry, all existing positions on the day of expiry, old and new, will attract an extra ELM, which is extreme loss margin of 2%. So this is number 4. Number 5 and number 6 are pretty straightforward. Number 5 is upfront option premium, effective 1st of February 2025. And number 6, removing the expiry day calendar spread benefit, which is also going to be effective from the 1st of February. So I think these are the 6 changes which SEBI has implemented, largely in line with expectations. But I think the lot size increase and the fact that SEBI is limiting weekly options contracts to 1 per exchange will attract maximum amount of discussion and debate in terms of what this does for market volumes, exchange volumes, and what this does to market intermediaries as well. Back to you.
Right, Prashant, very quickly before I let you go, you know, a lot of comments coming in, a lot of questions and queries coming in from the viewers as well on our social media handles asking about the impact and the implications. You know, just in the near term, from a market perspective, you've probably been speaking with experts. What's the impact likely to be on the markets when we open tomorrow?
You know, Shireen, so through the course of the day, we spoke with lots of market participants. Markets are prepared for this. I mean, you know, we put out the story in the morning that this is to be expected very soon, that this is imminent. There was some expectation in some quarters, and we had clarified yesterday as well that this was not to come up along with the board meeting. And we said that, well, this is going to come soon this morning. So I think this is widely advertised. And the fact that what has been done is largely in line, actually mostly in line with what was proposed in July, I think does not come as a shock or a surprise. And also the important point is this is being done in a phased manner. It's not as if everything is being implemented.
Welcome back to Midcap Radar. Well, all of the key indices continue to see accelerated selling pressure. The midcap and the small cap index now have seen cuts of more than 2% in the intraday session. On the other hand, the India VIX is spiking. India VIX is now up almost 14% in the session. And which are the sectors that are seeing the most amount of pressure? Well, the OMCs for one. So look at names like HPCL, BPCL, IOCL. Also look at some of the paint companies. So look at names like Asian Paints, Berger Paints, even Grasim, you know, with its paints for it, that too is seeing quite a bit of cut today. And one pocket of the market today that is seeing quite a bit of sell-off is actually the realty pack. So if you pull up names like DLF, Godrej Properties, Oberoi Realties, all three of these companies, along with some of the other real estate names, are seeing quite a bit of a sell-off in the session today. The realty index is down over 4% in the intraday session. But moving on, you know, there was a stellar listing. KRN Heat Exchangers made a stellar debut on the exchanges and listed at a premium of 118%. Upasana is here with more details.
Well, that's correct. KRN Heat Exchangers makes a stellar debut on the exchanges with a 118% premium, lists at 480 per share versus the issue price of 220. The issue size was around 342 shares with a fresh issue of 1.5 crore shares, and post-issue, the promoter holding now stands at 70%. Now, let us look at what the company exactly does. The company mainly manufactures aluminium and copper tubes, condensers, and evaporator coils, which are mainly used by OEMs in heat, ventilation, air conditioning and refrigeration industry. Now, the entire manufacturing operations of the company takes place in Rajasthan, and company derives 33% of its revenue from a single customer, that is Daikin Air Conditioning India Private Limited, and 72% of its FY24 revenue was contributed by its top 10 key customers. Now, in terms of key customers, it includes some notable names such as Schneider Electric, Blue Star and Voltas as well. Company aims to expand its customer network in Europe and North America, and FY24 exports stands at 15% of its revenue. Now, what was the key objective behind this listing? The company aims to enhance its existing product base by setting up a new wholly owned subsidiary, that is KRN HVAC Products Limited, mainly to manufacture value-added products in heat exchanger category, which are currently not manufactured by the company. Now, let us look at FY24 key financials. The revenue has seen an uptick of 24% on a one-year basis, while the gross profit remains flat at 26%. EBITDA margin has seen a downtick of 100 bips on a year-on-year basis, stands at 18.9%, while PAT has seen an uptick of almost 22% on a one-year basis.
Thank you, Upasana, for joining us with those details. Let's now hear in what the management of KRN Heat Exchanger had to say on the capacity plans and demand outlook. Listen in.
We call our industry like HVAC and R industry, heating, ventilation, air conditioning and refrigeration. So it's, to be honest, it's really growing in India as well as maybe in North America and Europe also. So we are the main product manufacturer for this industry, heat exchanger. So for us it's really good, and you can see our last 6-year journey. So we achieved the data as well. No, for us, if you study our RHP or something, we going for 6x capacity increase. So we feel there is a demand. So that's why we are increasing our capacity in 6x. Some data in air conditioning we have in India only 8%, and in China I think 80%, and USA 90%. So we have long journey to achieve this. So based on that, we increasing our capacity, and it's I think next 20 year in India time for in this industry as well.
Well, a stellar listing as far as KR and heat is concerned. But with that, it's all the time we have on this edition of Midcap Radar. Closing bell when we return.
Of the month or from a certain date. I mean, there's November 20th, there is April 1st, there is February 1st, all the way into 2025. I think that also kind of eases the impact a little bit.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBCTV18.com.
First of all, I mean, we are seeing very strong momentum in the market, and clearly this is on the back of some very good rainfall. Of the 36 agri-climatic zones that we have in the country, 33 zones have got either normal or above normal rainfall. And even in terms of, if you see the state stratification, for only the states of Bihar and Punjab do we see little bit deficiency in the rainfall, but broadly all the agri states also have very good rainfall. In terms of revising the guidance, no, we will still maintain at 5% level because we want to see through the festive season and then maybe take a call at the end of Diwali. That would be our view. But most of the heavy lifting will happen in H2 of this year, and that would give us an overall 5% growth rate. September has been a slow month for us in exports, and there are 2 factors to it. One is that in our neighboring countries, there are some geopolitical challenges being played. These are all very big markets for brand Mahindra and Swaraj. And even in the US market, we are seeing that 11 quarters of continuous degrowth in US tractor industry. Now that is, we know the factors that is on back of very high interest rate cycle, and people were waiting for Fed to start cutting. And now that has happened, I think the transmission will take 3-4 months time. And even in our US, which is our second largest market after India, the sentiment will revive. So that will again give us growth getting into our Q4. But I think for next 3-4 months, the exports might be a little slow.
CNBC TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy.
It's a mixed picture from whichever Asian markets are currently open this morning.
The 20-day moving average at 25,500 is the important downside level for the Nifty.
Their consolidated revenue will decline in mid-single digit.
First measure that has been announced is limiting weekly expiries to 1 benchmark per exchange.
One factor that might even affect the markets even more is the intraday monitoring of positions.
Monday down sharply, Tuesday up sharply, and today it's down sharply once again.
Try to be 50, but we should be comfortably at around 48, should be comfortable.
That 1/3 of global crude oil production comes in from Middle East, and this is the area that the markets are keeping a keen eye on.
A 300-point cut on the Nifty. We saw a recovery, but again, that is sold into, and we are at the day's low right now.
We've grown almost 30% year on year. It's been a great growth story for us.
Definitely at this point in time, we have the markets which are under pressure as the Middle East conflict has deepened.
So quite a lot of correction is seen both in the front line and even the broader end of the markets.
Sharpest strategies, top market trends, unmatched perspectives. The trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC TV18 Motilal Oswal Studios in Mumbai.
Well, that is the day so far, and what a day we've been having on the downside. And, lower and lower levels pushing down as we speak, hour after hour. So we're down 500 points now. We're starting closing bell half an hour early to provide you all of the perspective, both local and global, and we'll do that. I'm Prashant. With me, my colleagues Surabhi and Rima, and of course, Nigel is joining us from the newsroom floor. Guys, hi, good afternoon.
Hi, afternoon. There's absolutely been no respite for the markets, for the bulls. And the second half could also be shaky because frontline European indices have opened with a cut of about 1%, 1.1% lower on the CAC, and the DAX too is reeling with a cut of about 0.9%. So not looking good on the Western shores.
Yeah, and also the futures. I mean, Wall Street futures are down by about 0.5% as we speak. So let's see, I think tomorrow is also the non-farm payrolls data, and then we were not trading while the rest of the world was grappling with a lot of these, Middle East developments. So I think all things put together, it's turned out to be a heady cocktail for the bulls.
By the way, today's FII selling number will again be interesting. Somebody was talking to saying that it's going to be very large volume of selling. So the talking point, of course, and I think it is true, and I think we've been discussing this. Does China doing well mean that money flows out of emerging markets like India? We've kind of got all kinds of views, right? But I think it's undeniable now that because the rally has been so furious and so sudden, and it kind of has, I think, gotten so many people straight away into the FOMO bucket, that maybe there is some rotation, at least in the near term, which is happening. We had Ben Powell of BlackRock with us in the morning, who was making the same point, that maybe in the very short term that is true. Although, the larger point that when EMs do well, everybody gets money. But I think that is for maybe a week down, 2 weeks down. But for now, that shock is underway. By the way, China mainland markets are shut all of this week. Hang Seng is trading, and that is a China proxy. But Hang Seng also at one point during the day was down 5%. I think it closed down about 1.6, 1.7% or so. So that's the sort of quick picture on your screen now. So again, understandable, healthy pause, consolidation, what you want to call, because of the very sharp moves that we've had. Let's welcome in Adrian Movat, who's with us. Needs no introduction, veteran investor in emerging markets. Adrian, great to have you with us here on the program. Thanks for your time. We're not used to 2% down days. We've got one today. What's the big driver, in your opinion?
There are two things, and you already talked about some of these in the introduction. At the market fundamental level, we probably got ahead of ourselves in terms of US interest rate cut expectations, particularly as expressed in 10-year bond yields moving as low as 3.7%. The ADP report indicates that perhaps the non-farm payroll that will come out tomorrow morning US time will show a more robust number than we've seen in some of the more recent prints, perhaps something around 150,000. So remember about the context of this is that the economic bears are looking for the increase in the non-farm payroll to continue to narrow as indication of the economy slowing meaningfully. If the decline in the non-farm payroll increases, which is still quite high at 150, stays at this level, then that narrative looks weaker. So the interest rate cutting support for the market may be more modest than the market was expecting a week or so ago. Clearly, situations in the Middle East are escalating. You've had the President of the United States having to make a statement about whether the US would approve Israel attacking Iran's nuclear facilities. So I think just indicative of how rapidly this situation is escalating. We're seeing some impact in the oil markets as well. So we're seeing markets selling off after what has actually been a pretty decent September. Now within emerging markets, as the gentleman from BlackRock then was indicating, we have got this rotation story where Chinese markets have stood on their tails and are moving up so rapidly that active fund managers who've been underweight China, overweight India, need to address that position. And it is worth highlighting that the Chinese equities that they're buying into are still very inexpensive despite the moves that we've had. And the level of policy support does look very significant. I think it is on par to Mario Draghi when he was heading the ECB, coming out of the GFC into the Euro crisis, indicating he'll do whatever it takes. And in doing whatever it takes, first thing you need to do is inflate the value of financial assets, so both equities and bond markets. That's very important at improving the collateral within the financial system, which takes some of the stress out of the balance sheet recession that's been building in China. So you can overthink this and think, oh, is this really going to fix the economic problems? Don't look at it that way. Look at it as the medicine is going to be good for the stock market. We can answer the economic story a little bit further on. So short term, I think India is under particular pressure because it's been a terrific market, a long-term bull market, big outperformer. Positioning is bullish there with foreign investors. They need to sell some of that to buy some in China in order to reduce their underweight, reduce the pain that they're experiencing in underperforming a rallying China.
Adrian, hi. Thank you for joining in. You've laid out the various moving parts that impact the global markets and macros very beautifully, whether it's, what happens in terms of Fed rate cuts, the Middle East conflict. But the question is, how does one price in the Middle East conflict? Because there are huge implications for markets like India, the way crude behaves. So when you look at the short to medium term, you spoke about how India has been an outperformer, the overweight positioning is there when it comes to investors. But how would you price in the Middle East conflict from here on? How does it play out in your base case?
It's always very difficult. Generally, the story with geopolitical events is there a short-term impact on markets. Now, what you've then got to caveat that statement and look at more recent events, such as Russia's invasion of Ukraine, that caused quite a significant energy shock, particularly in the European community, where the price of gas went up dramatically, which hit the price of electricity. And then you had a fundamental impact which needed to be priced in. I think the issue with crude oil is that it's a very fungible asset, an easily moved asset. It's not like gas, which requires pipes, degasification if you're using LNG. So I think you probably might see a temporary spike in the oil price as the fundamental factor here, even if this is to escalate a bit further. So definitely risk premiums will rise near term. Whether it is a medium-term fundamental impact, I'm not so sure.
Adrian, hi, great to have you on the show. And you make that really interesting point. And I think we started this debate right when the Chinese market did that, recoil spring effect as it completely started pole vaulting, 24% up on Hang Seng in the last 1 month. The question is how much more FPI selling? Because anyway, foreign investors have been largely underweight or neutral in best case on India for a long time. So perhaps we're talking about funds or passively or actively managed funds which already have positions and are booking profit. Are you expecting this to really increase in a more meaningful manner? And if that happens, would you expect that whole wave of domestic liquidity to still support the market? I mean, the Nifty is down only 4% from the peak. What do you see ahead in the coming few months?
So my understanding of the positioning of active managers is they are overweight, which is a good place to be because India has been a significant outperformer. It is about a quarter of the EM benchmark these days. So if you wanted to outperform as an active manager, you needed a big exposure to India. And you wanted to be very underweight China because up until about 30 days ago, or even actually 14 days ago, being underweight China was the smart move to have. So I do believe that active managers are overweight India and they're having to sell down where they're overweight in order to find cash to put into the China market. So India is the wrong side of that flow story. Now, it's always difficult to measure the overall size of these positionings. We do get some data from the ETF markets about the positioning of active funds, but it's relatively limited.
Hi, Adrian. Good afternoon and good to see you in. So you're pretty clear on that. Since fund managers were overweight India, maybe taking some money off the table and deploying some money into the Chinese market. But with regard to the Chinese market pop that we've seen it before, right? In the last couple of years, we have seen them bounce up and then those markets give it away. Do you think this time around the measures that have been announced are good enough to hold the economy in good stead and in turn boost up the stock market as well? Or do you believe that again it could possibly fizzle away?
So I think we need to phrase it the other way around, that you need to push up the value of financial assets to help the economy. So if your test is, I need to see the economy being better, then don't bother buying China because you'll have missed the rally. So I think the level of policy support this time is very significant. So if we think about the other rallies that we've seen in China, we had a rally in China early in the COVID story because their zero COVID policy did allow them to basically open up the domestic economy. And the Chinese equity markets did extremely well in 2020. You had a sharp rally in late 22, early 23 on the opening up story, but there wasn't any real policy support beyond the opening up. If we go back to a market like the US market, the US economy is opening up in 2021, 2022, and the US government's providing very significant fiscal support. So I think the way to look at it this time is the Chinese policy makers realize that they have a serious structural issue, and this requires dramatic policy action, both in the monetary field as well as the fiscal field. And I think the monetary policy is quite innovative. When we look at what's going on with how they're supporting the housing market, making sure the banks have got a bit more capital to play with, these all look like smart, innovative things. And remember, they're doing it against a backdrop of deflationary pressures, which does give central banks a lot more flexibility. If you're not worried about inflation, if you're worried about deflation, we know how innovative central banks can be. And I go back to that Mario Draghi ECB analogy, which was a very, very significant event for capital markets and resulted in many years of risk assets doing well.
Absolutely, whatever it takes. How can we forget those big lofty words? That was a phrase that became, I think, capital market history, right? Adrian, but just to go back to the point on India, you explained why the shift is happening, active managers selling down a bit of India and maybe moving that money to China. But the second part of my question was how much more? The Indian market hasn't seen a meaningful correction in, I don't know how long, I think 2-3 years since COVID. So what sort of a correction would you expect in India? And would you be advising to buy the dip?
So firstly, I'm not aware of any significant negative delta on the local fundamentals of the Indian economy. I think we've continued to got inflation coming down, economic growth is robust. There's maybe a modest negative story in that the oil price is moving up, but it's moving up from an extremely low level. And that the Indian bull market has been driven, as you've indicated earlier, by local investors, not by foreign investors. So I think if there is a correction in the Indian market because of the events we're talking about, it is a little bit of pressure from foreign selling and local investors concerned about the geopolitical risks rising. So I would view it as being a modest correction. And, there's nothing wrong with a bit of a correction in what has been a very powerful bull market. At best, you're sort of up 20+% year to date. I think it's moderated to around 16 as I look at the sort of international indices. But I think that's fine. Maybe another 5% to go. But I don't see anything in the Indian fundamentals justifying a more dramatic sell-off.
Just a couple of rapid-fire ones, Adrian, if you're up for it. You said a couple of times the stimulus in China seems to be very big, but we've not really heard anything concrete, right? Essentially, it's media reports still, international media. On the monetary side, what got people excited is fiscal. And there, those numbers of 2 to 3 trillion renminbi, I mean, that is still in the realm of sort of news reports, etc.
So what we have so far is a lot of statements from the PBOC, and the PBOC has been criticized for not doing enough considering the deflationary forces that are in place. And so the actions in terms of pushing capital into the financial system, both into brokers, into banks, providing capital for SOEs to buy property and take this excess property supply and turn that into government social housing, where there is a chronic shortage of housing for the lower income groups in China. These are all quite significant statements. So from what I see at the monetary level, and I use the monetary level in terms of what the PBOC is allowing to happen, I think those are very significant. We do expect further fiscal policies. Although China's fiscal position is currently very supportive, it has quite a high fiscal deficit already, but I would expect more from the government there. But this, to me, I go back to the ECB, Mario Draghi analogy. It's what the central bank is doing. And remember, it's again, powerful analogy. The ECB was heavily criticized for being very slow in the GFC. They were putting up interest rates as we were beginning to see the subprime housing crisis build in the United States. They were slow to appreciate the deflationary pressures. They were slow to appreciate the pressure that was on the peripheral bond markets in Spain, in Greece, even to some extent in Italy. And then eventually Mario Draghi came in and he got that they had to do something dramatic. So we have a central bank that was viewed to be very behind the curve, and it's come through with what looked like dramatic measures, certainly relative to what we've been seeing from them in the past.
Adrian, just a quick word on India then, back to India. Are investors concerned about SEBI tightening the F&O regulations? Have you picked up anything on that?
I haven't, but when you're watching some share prices go up 25% in the day in China, sometimes you miss the small print from SEBI.
Okay, all right. We'll leave it there, Adrian. Great conversation. Appreciate you joining in, and it's a good chat. And hope you'll sort of join us over the next couple of days as well as we continue to track this. I mean, the big move in sort of Chinese equities via, of course, Hong Kong listed securities for now this week because China is shut, and of course what's happening here in India. We'll take a very quick commercial break here. We continue, of course, our market chat. Rohit Srivastava of India Charts will be joining in with what you should be doing. Large caps, mid caps, everything. Rohit tracks a whole host of data sets, both local and global. So that's coming up.
Consistency and trust, giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order, setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence and in-depth reporting that makes CNBC TV18 India's #1 business news brand. Foreseeing change, growth and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC TV18, your trusted partner and investment ally.
We like to stick to the fundamentals, and we won't draw first blood. But I mean, if there is a gunfight, we'll not go to it with a knife. So, one does end up participating. But having said all that, it just serves to advance the customer, the sales. But the customer expects it because that is the whole atmosphere during the festive. One participates in it. But once the dust settles down, it's back to good product, proposition, and customer care.
Let me address that constituency that you just spoke of, which is, of course, one of the most crucial constituencies, which is the regulator. And I think that is the big overhang today as far as the Kotak Mahindra Bank story is concerned, with the RBI imposing restrictions on account of deficiencies in the digital and IT infrastructure, not allowing you to onboard mobile as well as digital customers, as well as putting restrictions on your credit card business. Now, if you can share with us details on what you've been specifically able to do to demonstrate to the Reserve Bank that you are adequately or appropriately addressing those deficiencies, and where do you believe that you stand? I mean, there is, of course, an external audit that's also been sought, but where do you believe you stand in the remedial measures?
So, Shirin, first things to start, where we started with is, look, India has the best digital public infrastructure compared to any other place in the world. I've worked in every other place in the world. I've never seen anything like this, right? Now, obviously, that has led to the demand for digital services having gone up dramatically. And it's about the bank systems having to keep up pace with that. So we've been spending the last couple of months really focused on how we grow and make our systems foolproof. And like in every crisis, there's an opportunity.
Welcome back. Trying to see if there's any improvement, but unfortunately that's not the case. We're still dealing with almost the lowest point of the day. 25,230 thereabouts is the low, and we're just a couple of points above that. As you can see, it's been a sliding slope all the way down. Look at the India VIX. That's surged in a big way today. I think 13% up last I checked. Yeah, make that 14% right now. So it's been that kind of a session. Rohit Srivastava is joining in from India Charts. Rohit, great to have you on today. You definitely need some perspective, because I think traders and investors in India tend to forget what market falls look like, right? We've been in that kind of a market. But you tell us, what sense do you make of this? We're down 4% from the top on the Nifty. It's not much. What do you see ahead?
So it's interesting, and we'll have to break it down into 2-3 different time frames. One is the very short term, because we have seen this fall go on consecutively for like 4 to 5 days now, I think starting from Friday. And that puts us in the short term at a very, very oversold condition. The way it's falling, the RSI indicator, for example, is at almost 16. That's an extreme. We have our own proprietary momentum swing indicator dropping below 20. So that's entering oversold territory. What this all tells us is that we should be overdue for a bounce back from here. Not necessarily today, because it's the weekly expiry, and all that puts additional pressure on the market bouncing back immediately. But definitely tomorrow, I would like to see it retrace some of these losses, whether it retraces 38%, 50%, or the classic 61%. That we will, of course, go ahead and see. But the other change which is happening with this breakdown is that it is starting to break the trends on the weekly and monthly degrees, which means the medium term, longer term setups. I'll not say long term yet, but definitely medium term, which means for the month of October, we should stay prepared, not just for more volatility, but let's say for more downside, because volatility and downside come sort of together. In other words, going forward, every bounce we will be looking at skeptically, possibly with the intent that there may be a opportunity to sell. But here's the good side between the broad market and the Nifty is when we are looking at September, the weakness in the broad market was almost telling that the market is not in good health. But here, when we're actually falling over the last couple of days, we are not seeing the broad market fall that much. So it's actually giving you a different sense of safety that fine, we are falling, but we are not falling so much. So maybe things are not so bad as far as the investment side is concerned. So we are not seeing a breakdown in many charts individually. Some of them are weaker than others, but it's not like across the board. So that is giving us a slight sense that we can allocate to stocks, based on some kind of bottom-up picking or some kind of trend picking. And so that is good news for investors that you don't really have a major breakdown on the long-term trends, but you'll have to be selective. But on a 1 month basis, I would still expect more downside, for various reasons. Like I said, one is we are breaking several levels today. These are rising trend line from the August bottom. We are breaking the 20-day average. And, we have an extreme positioning also in the futures market where the client side is extremely short and, the FI side is extremely long. And the third reason why October could be bad is it is seasonally bad before the US election. If you just look at the last 3 election cycles, October month, the market was down. And November, once the election results were announced, you had what is usually called the presidential rally. The next couple of months, it just goes up. And this is a pattern that is repeated since 1992. I've not gone further back and checked. But that gives us a couple of elections which have followed the same pattern. And would this time be the same? So we should be prepared for something similar.
Interesting data points. Thanks, Rohit, for joining in here on CNBC TV18. I wanted to focus on the larger constituent of the Nifty that actually led us up to that 26,000 mark, the Nifty Bank. In a matter of 3 sessions, it's lost 2,500 points, close to around 5% odd. How is that shaping up? Because that's been the rock, that's managed to start performing, and now it's underperforming yet again. So levels you're tracking on that one.
Yeah, so Bank Nifty is, I think, at a very critical support. I'll put out a number that's around 51,500, let's say. If we do close below 51,500, it'll be breaking the trend line again from the June lows, and that would not be a very, very pretty thing to happen. So we do hope that if the upward trend towards say 55,000 is still intact, that we don't really break 51,500 on a closing basis. So that is going to be the hope. So we've still not done that. And so it leaves us open with some case that, Bank Nifty may still have something to show us. But what we'll also do on the upside is that as this market does bounce from an oversold state, which I'm talking about, we need to watch the 61% retracement as well, which means can the bounce really make a new high? Can it get past that critical level? And that level is going to be at around 53,370. So if we get past that, then there are odds that we get to 55,000. If not, any failure to get past that level would again open up another selling to the downside.
Got it. So on the mark on the downside, 51,500. On the upside, 53,370. Got both those two numbers down. Rohit, I also wanted to ask you the largest constituent, the other large one on the index has been Reliance Industries. And it's, been absent from any kind of move in the last 6 months. If I'm not mistaken, Reliance is down close to 3-4%, while you have the Nifty that's up 12-13% in the last 6 months odd. What's going on there? Because now it's broken the 20-day MA, even the 50-day MA, and it's testing lower levels. Your take at it on this 2,820 rupee mark?
Yeah, so Reliance has not been the best stock within the entire setup. I do have an important support level coming in at around 2,743. Since we are talking of stocks, let me just highlight, we don't really give advice, so you should not really take anything as a buy or sell recommendation. But the trade setup, like I said, if I look at daily or weekly momentum indicators, both of them are, bearish signals. The monthly one has still not done that. But breaking last month's or previous, I think last 2 months ago's low, which was at around 2,866, is a not very good sign, because it's the first lower high, lower low pattern that we are seeing since the bottom that we made in March of 23. And that tells us that, that we should be open to more downside for Reliance. That's the basic indication from there.
On the Nifty, Rohit, you spoke about downside for the month of October. What would be the key levels?
Yeah, so initially, like I'm thinking right now that we are getting oversold. The immediate support right here is at 24677 or sorry 2550. Well, we've broken that. Yeah, so around 25229 odd. So we're sort of at the support, I would say right now. And if this breaks, then where do we go? Then it's around 24,700. That would be the next level, maybe 24,400. So we would be open all the way to the 20-week average, which is 24,500. But I don't expect that to happen one way. That's all I'm saying, because if we get oversold, again, we look, just like I mentioned in Bank Nifty, we would look at the 61% retracement of this fall, which comes in closer to around 25,870. And we'll have to get past that if anything new has to happen on the upside. If we don't get past that, we will look at this as a sell-on rise market.
There's a flash at the bottom of the screen as well. Lots of viewers have written in, by the way, asking about HDFC Securities and the fact that they're not able to conduct trades, etc., in a proper, seamless way. So these are comments from HDFC Securities. Important on a day like today. I mean, I think unfortunate, but they're saying we are facing intermittent issues with respect to NSE derivative segment, working with our vendor TCS to resolve the issue. So that is coming through from HDFC Securities. As I said, many of you have written in with asking us to try and contact HDFC Securities and ask them what's going on. So that's essentially what's coming through, and we hope the issue is resolved speedily, because on a day like today, you don't want, to be frozen out in that sense. You want to be able to do what you want to do in terms of trades. Rohit, so that's a very holistic kind of picture as always. So maybe a bit of a bounce in the near term, but you're saying over the next 1 month, maybe even lower levels from where we are now, right? I'm paraphrasing you.
That's right.
Got it. So two things. One, if you can tell us, is the global cycle looking pretty good? Pretty okay still? Or you think that's also going to go into a bit of a funk? And second is, you said you can take individual trades here and there because broader market is not falling like it was in September. So if you have any specific pockets that you're looking at or stocks, go on.
So what has happened on the global space and where you will find comfort is easiest place to find comfort is going to be in the commodities part of the market. Not just for the geopolitical risk, which makes it positive for oil, but we've seen most of the metal prices rebound since the sell-off in the dollar happened on the back of interest rate cuts, right? So that theme doesn't really go away. So we have two things here. One is the presidential cycle, which means a weak October followed by a post-election US rally. So we would still not, until we don't really get a major breakdown of certain weekly levels, which is pretty far away, I think, for the S&P. We'll not be too negative on it. In fact, we'll just expect a routine cyclical correction for October based on the past data. Having said that, the easy trade here, therefore, is if rates are going down, interest rate sensitives and specifically commodities and metals do well. So if you look at it, metals rallied pretty hard last week. They're not really falling much today. Some of the steel stocks are even up. There could be potential upside in particular oil stocks based on how oil does. So if oil prices actually move up, you look at upstream companies and see whether they can really benefit. You can actually see ONGC mildly positive today. But Reliance is doing something different. So I'm asked that question, okay, why not both? So I don't know the answer. The charts don't look so good on one and look a little better on the other. So these are individual places. I think within mid-caps, it's very, very varied. It's not sector specific. So you have to pick individual stocks that are probably holding on to maybe their weekly averages. If you watch a 50-week average and you say, fine, this is a stock which is closer to the bottom end of its range, I would be more comfortable buying there. If I find some which is at the top end of the range, which means, up above the 2 standard deviation mark, then I would not really be comfortable buying there. And you have to really make those picks individually as far as stocks are concerned. So that helps in cleaning your portfolio as well. Yeah.
So Rohit, I know that you don't like to talk individual stocks, but maybe some clues, not mid caps, but maybe large caps. I mean, till there's clarity, and we were saying that on the Nifty, we are at support levels. So unless there is a very decisive breach of those supports, if this continues to amble along, what are the immediate trades that perhaps someone can look at? Maybe just 1 or 2 examples here and there, large cap trades perhaps for the next couple of weeks.
So yeah, I'll mention the simple single sector, and I mentioned it. It is metals. And pretty much across the board. So it's not like I like the aluminium stocks more than the steel stocks. I pretty much think the whole segment does well. And
apart from that, so metals absolutely. I mean, and even on a day like today, these are the only stocks in green. Apart from metals, anything else?
So there is a hope around banking. Nigel was asking me for key supports. I did give one. If that holds, then I would have some hope around banking coming back, because that was a space that has been undervalued. I think a lot of funds have been nibbling into it because valuations were like at -2 standard deviations on the 10-year chart. If I even look at a big stock like HDFC Bank, and it's already rallied from there, but it's still, that doesn't make it overvalued anywhere close. They're all like fag end of the bottom end. Same with a lot of the NBFCs, which are there. Like I had earlier talked about, say, Shriram Finance also, which is in the index, which also had very low valuations. But the whole point is, will they continue to hold out, and not break down in this correction? If they do, and you get a decent level of entry, then I would probably look at financials as well. But yeah, but it's all tricky, because they are not a direct trade. We are betting on that the interest rate cycle triggers a credit cycle and, many other things. But that in the face of valuations, and then if you get a bigger correction in markets, can those stocks really hold up? Or do they also continue to go into a deeper correction? So that is where we get caught in that argument. But these are the places that we'll be really looking for.
All right, Rohit, we'll leave it there. Thank you very much for that perspective. Very useful and very pointed and specific with regards to positioning levels and the broader global picture as well. Thank you very much for that view. We'll take a quick commercial break here. We're going to come back in just a bit from now. Markets, no real recovery. I think 530 points lower, 25,263. Devin Choksis will be with us on the other side. We continue talking markets. We'll give you some global opinion that we got from BlackRock earlier in the day as well. Stay tuned.
Opportunity to really say how we'll really leapfrog and make our systems really resilient and relevant for the days to come. So I think we've made very, very good progress. Obviously, we've been in continuous touch with the RBI, sometimes even every week, updating them, getting their guidance, making sure we're on the right path. And I think we've made tremendous amounts of progress, and we'll continue to do it. Obviously the RBI is exceedingly important, but the customer, I've got to get it right by the customer.
Yeah.
I got to stay resilient for the customer. I need the best customer experience for the customer. And, RBI has told me, you got to do it. So.
CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
A slim recovery is what we're seeing from the low point of the day. Nothing, can't even call it a recovery, but at least some kind of bounce is what we're seeing. You just want to focus on one stock, NBCC. You should pull up the intraday chart out there. It's trading at around 170 rupees. The stock is down 4%. But intraday it went slam dunk, hit 152, and then it bounced. Just take a look at that intraday chart out there. Fair bit of volatility. It suddenly fell close to around 18 rupees and then it bounced back up there. So just keep an eye out on a couple of these counters. Maybe there was a large sell order that suddenly came in there, which explains why this one did that volatile move. Mitesh Thakkar is back with us. Mitesh, it's a down day. You were sounding cautious this morning and you've got it bang on. What's your view at around this 25,250 odd mark?
Actually, it's been stronger than what I expected, Nigel. I think, I was cautious. I was looking at a pullback, but then this fall has been much more stronger than what I thought it would be. One, there was, good support around this 25,400 mark. 25,400, 450 zone, which is where a couple of averages were converging. I think we've just sliced through that. So that makes me slightly worried. And the Bank Nifty fall also, if you look at it, it's about now 1150 odd points. And the structure remains negative. So the Bank Nifty possibly, there's mild pivot around these levels of 51,700, 51,710 zone, and we are just about 50 points away from that. So if that breaks, then it'll be a worrisome thing for me. So I think, the markets, even if they recover now, I think what will be important is that today's gap also becomes a significant hurdle, because from the highest point of the day, which is 25,639, we are roughly about 400 points lower. And no sign of a recovery. So, the texture for me is that one, don't try to do any kind of bottom fishing. I think, avoid till you get some kind of stability and clear signals of an up move. And we have also, pruned down a lot of our long exposure. It wasn't much any which is because for the last 2-3 days we have started declining, but not venturing into this market on the long side and seeing, whether it goes, because not the best time to short because we've already fallen in the last 4 days, but avoid longs and see if the bounce backs are slightly on the weaker side, and then maybe we'll trade more on the short side.
Okay, got it. By the way, some alerts coming in. Our colleague Harmaz is just pointing this out. Put up some of the stocks like HDFC Bank, ICICI Bank. For HDFC Bank, he's pointing out the levels that if the stock falls below 1643, then it will be giving up all of the gains that it saw from the 11th of September. So 1676, we're still some way off that mark. It's only in the recent past, in the last 2-3 weeks, that bank stocks started their uptrend. And let's see if that will remain intact or whether it gets truncated. Mitesh, great to have you with us this afternoon. So tell us, individual stocks, it's all over the place, but individual trades, what would you look at for the next 1 hour?
So on the stock side, since I'm not venturing long, the metal pack is the only area where we have some longs, and that's the saving grace. But otherwise, mostly, I think, we are looking at short ideas. Right now, I have a sell on HDFC AMC with a stop at 42.55. Look for targets of around 41.30, 41.40, that zone on the downside. And that apart, I think HUL is also slightly turning negative. So a sell on HUL will take a tight stop here, not a very big stop of about 29.21, and a target of 28.30 can be looked at.
Okay, all right, got it, Mitesh. Thanks very much. We'll come back to you in a bit and get some more trading ideas going. We have Devin Choksi of DR Choksi FinServ joining us on this leg of the show. Devin, good to have you on. So it's after a long time that we are getting a day where there's a lot of momentum on the way down. Otherwise, this has been a bull market through and through. Bears rarely get their day. But now that we're seeing a lot of these, issues and concerns play out, what is your advice? Would you immediately go in and start sort of adding stocks to your shopping bag? Or would you wait a while and let the market settle?
Yeah, good afternoon, Surbi. Well, I think that's always a difficult question to answer, because I think in a falling market, more than the fundamental reasons, I think there is a technical aspect to the market, I think, which leads to this particular fall. And the kind of collateral damage, I think, which it may extend to the good quality stocks, I think is something which is unpredictable. So what we keep it simple, I think in this particular scenario, when I think we get some of the good quality fundamental stocks at a given valuations, I think it's a time to keep them adding into the portfolio. Because I think in most of the negatives, I think which we are talking about is more of a possibility and a speculation, particularly on the global escalation side, on the war front and everything. In my viewpoint, I think rest of the conditions in India remains, I think, pretty stable as far as corporates are concerned, earnings are concerned. There might be challenges, of course, I think, on the cost front because of the logistic getting haywire. But the fact remains that I think overall the environment looks, I think, stable as far as I think our corporate earning outlook is concerned. So we would consider buying at a appropriate level individual stocks more than I think looking at the market in general.
No, absolutely, and hopefully we'll get some of your top buys at the in this kind of a market as we go along. But first question on the OMCs, there are sharp cuts coming in on stocks like HPCL. Look at it, HPCL is down 7% right now, BPCL is down 5.5%, and IOC also losing about 4.5%. Devin, the market is reacting very sharply. These stocks obviously had a good run up as well. Now, the whole narrative has changed, right? Till Monday, we were talking about how on the marketing side, they're very comfortable. They're making a lot of windfall gains. And now there's so much of uncertainty with the rise in crude oil prices. OMCs, do you like them, dislike them? Would you buy?
Yeah, I think more or less the GRM margins have basically, I think, started bottoming out. And even except, I think, last 2 days of, I think, spike that we are seeing in the crude oil, I guess, I think by and large, the GRMs are bottoming out, and that's positive, I think, for most of the refining companies per se. Given that situation, I think one should argue for going ahead with buying on the list. However, I think the major challenge has now once again popped up about the logistic management. On one side, I think your import of crude oil is taking place. On the other side, I think the tankers availability would be suspected, given the kind of tension that we are having in this part of the world. So to a greater extent, I think that is a cause for worry at this point of time and not anything else. In my viewpoint, I think other views are not changing. We remain selectively confident about the entire space. But more importantly, I think the comfort level remains higher with Reliance vis-a-vis, I think, the other oil marketing companies or the exploration companies at the public sector levels.
Okay.
All right. Yeah. Devin, just coming to you, we want to play out the soundbite that we got as well. This is BlackRock Investment Institute's Ben Powell. We spoke with him in the morning. This is again about flows more than anything else. This particular soundbite will play out more for you. India, China. Listen in.
The combination of demographic plus productivity gains, digital inclusion, infrastructure, and so forth. I think the big picture in India continues to look very, very favorable. I actually think the short-term issue is nothing really to do with India. It actually could be the gravitational pull of China. So China, as we're all aware, India has become, recently, a few weeks ago, became the biggest constituent in MSCI emerging markets, taking the crown from China. And that's great, right? We've all enjoyed that. But I do think if China is going to follow through on its stimulus promises, which we may see as soon as next week, it's quite likely that some of the money that global investors have put to work outside of China, be that in other emerging markets or other parts of Asia, probably gets pulled back into China. So I think there might be a little bit of a headwind, really nothing to do with India, but to do with global capital flows moving back into the world's second largest economy.
Okay, that's an interesting opinion coming there. By the way, one of the big, pockets which are, under pressure today are Dabur and many of the other companies where you have this beverage portfolio. So something like Varun Beverages is down 4%, Tata Consumer Products is down 3.7%. So these are the stocks impacted by Dabur's Q2 commentary. Devin, comment on Dabur and what they had to say, and is there a broader read-through for the FMCG sector, the kind of impact we would see on account of floods to demand, etc.?
Generalization won't help actually at this point of time. In selective pockets, I think there could be some situations where I think some disruption may take place because of the supply chain logistics. But beyond that level, I think that overall demand scenario remains, I think, pretty comfortable for home care products, for personal care products in the FMCG, or even the food category of products within the FMCG basket. So where Dabur is operating, I believe that I think most of the category of products, I think, are going to see the steady demand continuing. At the same time, I think in these festive months, you are likely to see the surge in the spending. So certainly, I think that is good news for many of the FMCG companies. And fortunately, the favorable pricing scenario on the input side is definitely helping protect margins also. So selectively, we remain confident about the business environment. Of course, most of the things are in price. In the last few weeks, I think the FMCG companies have had a good run. So from that perspective, most of the positive news are already in price, as I would like to add it.
All right, Devin, I wanted your view. You know, sometimes these weak markets gives you an entry opportunity, and one of those outperformers has been Mahindra and Mahindra. They're guiding for better times in the second half of the year with regard to tractor sales. And you know, in the first 60 minutes itself of their openings of bookings for rocks, that's the 5-door, you know, they had got bookings of around 1.76 lakh. Wow, within 60 minutes. What's your view on the stock? Seems, you know, most of their launches are being met with a very good response.
Yes, absolutely, Nigel. I think if you look at last 2 years of launches that they have done and the kind of booking that they have created, probably I think they have been sustaining this particular move on every successive launches that they do. It's a good comeback, I think, as far as I think their portfolio of passenger vehicle products are concerned. One would tend to remain bullish about M&M per se, given the kind of visibility that you get. And comparatively, they face less amount of pressure on discounting side of their vehicles. At the same time, I think the tractor business, which is up till now, I think not contributing enough, is expected to contribute better because of the good monsoon in almost all districts, I think, where the rains have been, I think, on a positive side. So from that point of view, I think we are likely to see a better demand scenario emerging for the tractor and the farm business as well. So both the portfolios likely to show relatively better performance going forward.
Okay, all right, Devin, thank you so much for joining in, giving us perspective on the market. Appreciate you making the time, and we look forward to the next conversation soon. We'll take a break. On the other side, we have with us Varun Goyal of Mirai Asset Investment Managers to get some more views on how you navigate this fall and what should portfolio positioning look like now.
Two 6-week periods during which the inflation rate has fallen, that can give a lead to cut the repo rate. Choice is between 25 basis points and 50 basis points. If you want to be cautious, we can cut 25 and store something for the next time. Or we can take front-loaded cut of deeper thing. There are two ways of creating competition in the system. One is really letting new private sector banks to come in. The other is privatize some of the nationalized banks or increase the private content in the United States. We have now reached a stage in which we should really be able to get more banks in the private sector. So I would really say that let an atmosphere and environment be created where new private entities can enter.
we are revising
investing.
Okay, markets are down, and we've been sort of reporting on the 500 plus point, make it 550 now, point cut that we have. And some of the other market indicators are at the bottom of the screen, Dow futures and a few others as well. Let's welcome in Varun Goyal, who's with us of Mirae Asset Investment Managers. Varun, good to have you on the program. Prashant here. First, quick comment on what your sort of perception. What are you hearing? This kind of selling. What's it on the back of, in your opinion? On the domestic inflow side, again, it's too early, but so far, if you have any sense whether the numbers remain as strong as ever, monthly inflows are to the tune of some $4 billion over the last many months. So this month, what's it looking like? Actually, over the last couple of days, what's it looking like if you have a sense? But start with the drivers for what's leading the market lower.
Yeah, good afternoon, Prashant. Thank you so much for having me. I think as far as the monthly numbers are concerned, we have to wait for, I think, 7th of the month. That's when the industry data comes out. I would not have any latest data that I would be able to comment on. But from broadly what we have been seeing, the domestic inflows seem to be on track. I don't think there is any major deviation, but let's, of course, wait for the data when it comes on the 7th of the month. Broadly, I think if you look at the valuations, we are trading at around 20 times FY26 earnings, which is around 8 to 10% more expensive than the historical average. So I think a 5-10% kind of a correction, if it happens for geopolitical reasons or otherwise, could help take away some froth from the market and make the medium to long-term outlook more attractive. So as such, we would not be too concerned about what has happened in the last few days, and hopefully the medium to long-term India growth story and the earnings outlook remains largely the same.
So is that the view that from the top, obviously no one can forecast, but it's possible we get to between 5 to 10% kind of a pullback? We perhaps get that?
So we don't know, of course, Prashant, we need to monitor the geopolitical developments very closely. And of course, just to add to that, if you look at the domestic data points, they have been little on the soft side. The high frequency data in terms of GDP growth, the PMI for manufacturing services, auto sales data. And of course, today being the first day of Navratri, this is the beginning of the festive season. We do hope that the domestic consumption really picks up during the festive season. Also, if you look at the capex data a little bit, roads, railways, defense, in the first 6 months of this fiscal, it has been a little subdued. Of course, there were elections and all, and one hopes that in the next 6 months, it can catch up to meet the full year budget target. So these are some of the data points that we should also track from a domestic perspective. I think as far as earnings are concerned, FY20 to 24, we had almost 18 to 20% compounding in Nifty. Going forward, at least for FY25-26, our expectation will be a little more muted. Maybe 10 to 13, 14% kind of earnings CAGR from this point onwards looks more likely, and that is how we should be looking at the market.
Varun, hi, afternoon. You said that how some of the high-frequency domestic economic indicators are a bit subdued and tepid. So how are you positioning yourself in your portfolio? Are you positioning that the domestic economy continues to remain a bit subdued, or are you penciling in a pickup in the second half of the trading session? Because you have been bullish on some sectors like travel, tourism, hotels, etc. What's the expectation on the domestic front for the next 6 months?
Yeah, good afternoon, Rima. So I think while I was just mentioning that some of the recent data points have been a little subdued, one definitely hopes that the festive season is good and the growth really comes back. I think for the year as a whole, RBI continue to expect a 7% kind of a real GDP growth. I think if you look at the budget estimates, we are looking at 10 to 11% nominal GDP growth. So broadly, we are there in line. Of course, if the incoming data points suggest otherwise, we may need to revise it differently. So our sense is broadly we are at that 10 to 12% kind of a nominal GDP growth, and earnings growth as far as Nifty companies are concerned will broadly be around the same lines. Last year, of course, we had the big benefit of commodity prices coming down, and therefore margins expanded. So while sales growth were in single digit, the EBITDA and PAT numbers are much higher. I think this year we may not have that kind of benefit on the commodity side, and therefore the top line and the bottom line growth may be in line. So that is the point I know that I was trying to to talk about. I think broadly, as far as India's domestic growth story is concerned, we remain pretty much on track. Both the investment side and the consumption side largely doing okay. There might be 1 or 2 quarters of seasonality-driven slowdowns and all, and one hopes it kind of picks up along the way.
Okay, Varun, hi, good to have you on. So the commodity side of the market is getting more and more interesting, right? There's a huge focus on metals, courtesy what's going on in China. Then there's a lot of volatility on the oil and gas side. What has your approach been, and are you willing to look at some changes if you believe that the China rally is durable and therefore perhaps the metals move has more steam?
Yeah, I think almost half of the commodity demand for the world, take all industrial metals, take steel, comes from China, and China remains a very big driver of commodity prices. One needs to watch out whether the current stimulus measures announced and discussed and debated actually come through and they help in stabilizing the economy. I think the jury is still out. We'll have to wait and watch. While the market's definitely excited, one needs to really wait and watch out to see if the Chinese growth can really stabilize. And because if Chinese growth comes back, the metal prices can definitely see an uptrend. But I would still want to see more concrete evidence of that stimulus having an impact on the ground. At this point of time, we're more like an equal weight stance on the metal space as far as I'm concerned.
All right. Hi, Varun. Good afternoon. Good to hear your thoughts. What about the IT space? In the next week or so, we'll be getting those numbers that start trickling in. And, most on the street believe that maybe the worst is in the price. From the second half of the year, you could see some increase in spend. And that's what will give a bit of a runaway for growth for FY26 onwards. How do you see things panning out and your approach to the sector?
Yeah, definitely positive on the IT space. I think clearly there are signs of turnaround as far as the US BFSI demand is concerned. I think the mortgage space, wealth management space, all are seeing green shoots. I think the interest rate cut which has happened in US is also very welcome. Over the next 6 to 12 months, we expect the North American banking, which contributes almost 1/3 of the top line of the Indian IT sector, to see better prospects. A lot of deals which were kind of under discussion, there were pressure on pricing. I think some of those concerns can get addressed. So incrementally, we would be positive on the IT space. I think one really has to pick and choose those names which have a significant exposure to the BFSI as a vertical, because that will be the first one to recover from the slowdown that we've been seeing in the last 1.5 years.
Any changes, Varun, to your portfolio, the way you've aligned it in the last 2 or 3 months, given the different winds that are blowing geopolitically on the domestic front? How is your portfolio positioned now, and how has it changed?
So broadly, we remain overweight on pharma, IT, private sector banks. I think these spaces continue to do quite well. We believe residential real estate, we are still in the midst of a big uptrend, and we are only in the mid-cycle. So we remain positive on developers as well as the building material companies. I think power capex continues to be a very, very strong theme, both conventional and renewable. And we continue to see major investment being undertaken by both public and private sector. So continue to be constructive on that side. So these are some of the themes I know that one would prefer. The portfolio is largely stable with some minor changes.
Okay. Varun, just a quick, just to sort of tie in the earnings bid, overall, right, across your analysts that you've spoken with, Q1 was, a lot of companies said, well, there was that heat wave and there was elections, etc., which marred numbers. But Q2 also, across sectors, generally, sense is that it's going to be not such a great quarter. Is that the view you're getting across the board?
Yeah, our sense is the second half is really, post the festive demand comes in, and we see recovery in domestic consumption, and some of the export-related demand also comes back. So I would expect the first half of this year to be a little weak, and the second half is really when we expect the earnings growth, also driven by some of the government capex, which has been a little slow to start to come back.
Okay, all right, got that. Varun, on the capex side, because even before we got into this volatility and this whole global fall, in any case, the market was undergoing a bit of a texture change, right? There was some profit taking in capex plays and PSUs, and we saw that money start rotating back into areas like banks, financials. So have you been tweaking portfolios accordingly as well? And what is your own stance on financials, especially capital market plays? Look at all the policy moves that have finally happened, and stocks are reacting in a very interesting way.
Yeah. So I think if you look at the capital market story, I think there was a very interesting study done by one of the brokers there that from 85 to 2004, if you look at the US, that is the time when inflation got tamed in US, post the Volcker really coming in, and then a very consistent set of low inflation, decent economic growth. For 20 years, the financialization of the US savings really played out, and the sector really multiplied 20x from where it started. I think for India, we have seen almost a 6x. We have come in the last 10 years, and I think we have a long way to go. So continue to be very constructive on the financial savings as a theme, as long as we have an inflation targeting framework, as long as RBI remains determined to keep inflation within that 4% plus minus 2% kind of a range. I think we would have a fairly long period of financialization of savings, where more and more money can come into financial instruments, on equity, on debt, on various other instruments. And therefore, that is a theme that like in US, played out for almost 2 decades before peaking out sometime in 2003, 2004. I think we are still midway, and we have a long way to go.
Right. Varun, Mirai has a China fund as well, right? It's a FOF?
So we do, but Prashant, I would not be able to talk on that. I'll be happy to connect you to the right person for that.
Okay. All right. No, fair enough. I was just checking whether that is seeing any.
No, we do
happening
have.
on that.
Yeah, yes.
Yeah, absolutely. We'll leave it there, Varun. Thank you very much for your time. Appreciate it, and good speaking with you as always here on CNBC. We'll take a break. We're back, and we do a quick check on what's happening with dealing rooms. D Street Chatter with Nimesh coming up. We'll get you all the going-ons in dealing rooms and all the sort of gossip and buzz. Of course, after that, we'll also welcome in our technical analyst for some trading ideas. Stay tuned.
Booking value guidance to 4,800 crore to be done in FY25. So this is in summary the response to Estate 360. We have some units remaining. That's why the total 100% booking value guidance is now 4,800 crore, of which 4,100 crore has already been booked.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube.
Welcome back. Market still sitting with a cut of around 550 points, and the problem pocket is the Nifty Bank, which has lost close to around 1,000 points. But the person who can give us an insight into what he's picking up with regard to D-Street chatter, Nimish is with us. Nimish, it's a truncated week. The bulls would have not wanted to come back, and I think the stop loss today is 330. But tell us, what are you picking up in D-Street chatter?
Well, it's largely a global risk off, which is putting India also under pressure. But today's sell, and it's largely backed by large FI selling as well. We saw on Monday, we saw on Tuesday. Again, there is a very large sell-off. Is what I understand. Imagine the buy-sell ratio at FI desk is nearly 1:3. When I mean one buy and there are 3 sells. So that's the kind of intensity which is there within the FI selling. And even that is largely in the large cap names. Look at the fall in the large cap names like Reliance, HDFC Bank, ICICI Bank, Kotak Bank. That's where the pain point seems to be. There is passive selling happening. And maybe one reason to explain is that maybe the money is moving out of India to China. So that's something which potentially is playing out, and we will further see that once China reopens on Monday. And we spoke about it, right? That's the potential risk for India, at least in the near term. So that's playing out. I think barring metal names, there is selling across the board today. And that explains, Nifty, Bank Nifty, Midcap, Small Cap, all the indices are down nearly 2%.
Yeah.
Having said that, a couple of things to watch out for. We are very close to the crucial technical level of 25,200 on the Nifty on the downside. So we are pretty much around that. And also, if you look at intraday, the PCR followed was almost at 0.7. We're now at 0.75 odd. Normally, we've seen markets bottom out around 0.7 on the PCR. So that needs to be taken into account.
Yes.
Closer to the technical level, so watch out for that as well. But there is clearly selling pressure from larger FIs in the large cap names, and that's the reason why you're seeing intense selling and Nifty largely under pressure, largely led by the likes of Reliance, HDFC Banks, and Kotak Banks of the world.
Well, point well taken, Nimish. What about individual stocks? What are you picking up?
Nigel, while markets have been down another 500 points today, the breadth doesn't seem to be that bad.
Yeah.
And there are a lot of mid-cap and small-cap which are buzzing in trade. So the first name on my list today is R Systems. Not buzzing in trade, but it's been consolidating in a very narrow range. But now I understand there's going to be a very large block in R Systems very soon. I'd spoken about it a couple of weeks back as well. There is one large NRI investor who owns close to 29%, and he can potentially sell around 10%. So that's the buzz that I've picked up in our systems. The second name is Strides Pharma. That's been buzzing in trade almost at 52-week high. The volumes are on the higher side. It's been buzzing largely because one of the subsidiaries of Strides Pharma has recently raised close to $100 million from very large influential investors at a very high valuation. So that explains a big up move in Strides Pharma of late. The third name is EPAC, a recent listing. But again, that's been buzzing off late. The volumes on the higher side, few HNI investors seems to be active buyer as well. I believe one PE fund was to sell a partial stake. That's largely been done with, and there is a very strong buzz that maybe over the next couple of months the company is likely to back few large orders as well. So that's a trigger on EPAC. And the last name is Paytm. This is going to be interesting. We saw a big move on Paytm yesterday as well. The volumes have actually picked up of late. A leading domestic mutual fund has been an aggressive buyer in the last few days. And also there is a very strong indication that maybe a corporate development is lined up in Paytm very soon.
Thank you very much for that. So EPAC, Paytm, some stocks which Nimish is watching out for. For the markets, the sell-off took place from 10 a.m. to 2 p.m. But after that, we've pretty much been stable with about a 550 point cut. No incremental selling, but there is no recovery. Mitesh is now with us for a few BTST calls. Mitesh.
So I think, one difficult to guess whether it will be gap up after the decline or gap down, depending upon how the international markets behave. But we'll go with some stocks, when the patterns are slightly biased on the negative side, given the fact that, we're trading below support levels on the Nifty. So M&M Finance is something, which is on my list. I'll pick a STBT with a stop at 324.5 for targets of 316, 317, maybe even lower. But yeah, let's see. And the other one is a BTST, which I would recommend a BTST on Lalpath Labs with a stop at about 395 and a target of around 34.50.
Okay, thank you very much for that, Mitesh. Ambrish Balika is also with us on the show. Ambrish, afternoon. What have you made of the kind of session we've had today? And what are you doing? Have you used this opportunity to buy some of the stocks that you like? Or are you a bit cautious now from these levels?
No, I've been cautious for a while. And this fall, we don't know whether this is the beginning of a fresh fall or whether it would be like, similar to the earlier falls where we fell about 3-4% and then at lower levels the buying came in. But whatever said and done, I think overall for the index, I think the valuations were getting a bit too expensive, and liquidity was the only driver, and it required an external factor to break that rally, and that's been Iran-Israel war. But then at the same time, there were other negative news which was getting ignored by the markets, which was the PMI manufacturing, which has started falling. We had the GST numbers where the growth wasn't as good as what we've seen in the past. And at the same time, I mean, if you see the last at least 3 to 4 weeks, although the index was touching new highs, the portfolios were hurting because most of the stocks in the portfolios of retail investors, basically, I mean, who had bought defense, railways, and all the other stocks which were not performing, that has started hurting. But still, liquidity was flowing in. But I don't know whether, I mean, if this issue carries on for a while longer, in the sense, if the war escalates, then the sort of sentiment and liquidity which you're talking of can disappear overnight. So after that, the fall can be much deeper. But I think at this point of time, we just need to wait and watch. And as far as buying is concerned, yes, I mean, surely with the fall of about 1,000 points from the top, you should, in fact, if you're sitting on cash, yes, it makes sense in buying to a certain extent. For example, I've been telling you that we've been in cash of about 40 to 50%. And in that sort of a scenario, I would possibly deploy 2 or 3%. I'll not really go out and buy 10% today.
So one of the stocks that you're recommending is Dhampur Sugar, which looks attractive to you.
Yeah. I mean, typically on a day like this, I wouldn't have recommended a small cap stock, but then this seems to be a compelling one. That's the reason I'm recommending on a day like this. It's one of the leading sugar mills in India, and in addition to sugar, they produce power through cogeneration, where they have a capacity of 126 megawatts, ethanol 350 kiloliters per day, ethyl acetate, as well as potable spirits. In fact, they've achieved about 20,000 cases per day last quarter. And in fact, last year, the ethanol capacity was increased. And in addition to molasses, they've been able to use damaged grains as well as maize, which is a very positive thing. Last quarter, the crushing was much lower. And that's one of the reasons for the performance to be weak, like the earnings were weak last quarter. And because of which we have seen the stock underperforming. And this is one of the reasons why it came as a contra buy for me. Because going ahead, clearly, sugar and ethanol scenario seems extremely good. Prices have moved up, so margins for Dhampur should start moving up from here. And all the capex has been completed. So there is no further capex, at least for a year or two, which has been confirmed by the management. And the benefits of the capex already done, I think, should start accruing now. So expected EPS for FY26 is about 33. And with that, my target price is about 330.
Okay. By the way, looking at some very interesting moves in the broader market, while it's a down day, let's pull out some stocks that are managing to buck the trend. Some of those names would include ITT, cementation, obviously, because there's so much of buzz around the company on whether there's a deal coming up with Adani or perhaps a different suitor. So that's one.
They also won an order worth more than 1,900 crore rupees. So that was announced early in the morning, and that's when the stock went up, locked in an upper circuit.
Yeah, so that's been an early mover. There is KRN Heat, which is a new listing, which has been definitely a very hot listing, 117% up on KRN even now. And by the way, Amber Enterprises, as we speak, is surging 8%. There's been some buzz and chatter that is there some rub-off effect because of the kind of valuations and the interest that KRN has generated in the market. They're into the business of heat exchanges and management of heating systems and cooling systems, actually, for a lot of industrial applications. Amber obviously has a very big room air conditioner market. So I'm not sure if there is any immediate parallel, but something that the market wants to believe or is sniffing for sure. 7.5% up on Amber. Just very, very quickly, Ambrish, any thoughts here on Amber or today's listing?
I see. In fact, Amber, we've been positive for a while because if you see, they have one of the largest market shares in room ACs, and where we have seen the demand continuing to increase because it is no longer a luxury; it's a necessity, especially in tier 1 and tier 2. So clearly, I think Amber will still see further up move. And the other stock which we discussed about was ITD cementation. Frankly, this was my pick for the day today. But then I had to drop it after the stock moved up 100 rupees, and that's why that's the other reason why I came up with Dhampur. My original pick for the day was ITD cementation. Clearly, the way the order flows are happening, 18,500 crores of order book, and in fact for the current year, the expectation for the next 12 months is another 10,000 crores of order flow. In fact, here I have a price target of about 712, but then it didn't make sense. I mean, giving the call at 645 and saying 712, so that's one of the reasons I dropped it.
Okay, Amrish, to stay on, we need to slip into a very short break. We'll come back in about 9 minutes left for markets to close. It's been a painful session. The Nifty is around 25,250.
How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC TV18.com.
ما يفكروا انه بس حزب الله بوجهه، كل الشعب اللبناني كله بوجهه، وان شاء الله.
It's been a disappointing trading session. We're going to be ending closer to the low point of the day, just around 5 minutes to go before the final bell. And as we said earlier, it appears there was only one stop loss today. That is 3:30 p.m. and we're almost there. Well, we're still in conversation with Amrish Balega. Amrish, good afternoon. Wanted your view on a couple of these names, BSE as well as Angel One. See, there was this probability that we're going to be getting some notification coming in from SEBI, and it's more or less in line with what the proposal was. Today, these stocks opened up mildly low and they just took off. You know, BSE, Angel One, both of them are trading well in the green. Your view on this pack?
No, I would be cautious at this point of time because most of the volumes were coming in from the F&O side. And with like F&O being out of reach for most of the retail going ahead from November onwards, clearly I think the volume will suffer. Along with that, the brokerage will suffer. And don't expect these traders, who are living day to day, to come back as investors. I think that's one talk which is going on, that most of these people will become investors. I don't think that's possible, because that's not the mindset. So I would be cautious at this point of time. In fact, something like a BSE at these levels, I would possibly go ahead and sell.
Okay, that's BSE indeed one of the big newsmakers of the day. By the way, Petronet LNG is up 5.5%, a distant cry from a lot of the other oil and gas names, the OMC stocks, for instance, that have fallen quite a bit. So Petronet is managing to hold ground. And as we are finally closing down, if we talk about some of the key losers, where the profit taking has come in, DLF, PFC, these are some of the weaker names. Amrish, finally a word on Dabur, because Dabur has kind of, taken the market by surprise by talking about the possibility of revenues falling when we're talking about a rural revival. What do you make of it?
I think, it's fallen because of the management commentary which had come about the weak possible sales. But then, I would utilize this as an opportunity to buy, because in fact, we bought to some extent in the morning. At the same levels, about 575, 580. I'll not be surprised if it falls more, but then I would possibly utilize that to buy and add more to Dabur. Again, it's not a one-quarter story. We are looking at it at a much longer term. The next 12 to 18 months, if you have a view, I think it's a great time to buy Dabur.
Okay, Amrish, thank you very much for joining in. We're wrapping up Thursday's trading session, and we're ending with a cut of about 2%. Global markets were in a tizzy because of rising Middle East conflict, so that weighed on sentiment. Brent crude prices have crossed $75 per barrel. Added to that was the SEBI curbing the F&O regulation, making expiry just once a week for NSE and BSE, so that hurt sentiment on the side. So lots of factors at play, and by the end of it, the Nifty and the Sensex down 2%. The Nifty ending around 25,250, more than 500 points lower. The Sensex down 1,700 points. Advanced decline ratio stands at 1:4, more than 2,000 stocks declining, ending in the red, with the Midcap index down over 2%. All the sectors ending in the red. I think metals tried to put up a bit of a fight, but by the end of it, I think metal index too seeing a little bit of a downtake. But the sectors which took it on the chin today were realty, so that's down 4.5%. Banks continued to get hit. The Nifty Bank is down for the fourth day in a row. Autos, oil and gas, PSCs also under pressure.
Absolutely. So those are some of the key trends that played out. Just to continue, some of the names that we were highlighting where the profit taking was very, very visible. Look at names like Cummins, 5% down. Dabur, we've discussed. DLF has lost almost 6% as the market's closing down. A couple of the wealth managers, 361, Novama Wealth. These are stocks on the lower side. KFin, down about 6%. So a lot of the market infrastructure plays, capital market-related plays, and the wealth managers, they've been under pressure. JM Financial, for instance, is down 6%. But against this backdrop, look at Angel One. Angel One saw a bit of perhaps a relief move now that the news is formally out. 5% up move on Angel One, and Amber was the other highlight, up about 6%. And ITD cementation, by the way, final count continues to be that 20% circuit on the stock. So the bell has gone, the day has ended with a 530-point drop on the Nifty, and the Midcap index losing a little more than that, down about 2.3% on the Midcap index. Okay, that's a wrap on this edition of Closing Bell. Thank you very much for watching. But don't go anywhere. A special edition of Markets Forward coming up on the other side. The market sell-off in just a moment.
مثل ما وعدنا فيه رب العالمين ان شاء الله اسرائيل جربت قبل بمره وما على مع لبنان مش بس في حزب الله، كل لبنان بده يحارب هالمره، كل لبنان ناوي على اسرائيل، على المجازر اللي ارتكبتها بغزه والمجازر اللي عملتها بلبنان. ان شاء الله ما حيضل واحد الا ما حيحارب، ما يفكروا انه بس حزب الله بوجهه.
there is a petition filed in Honorable Supreme Court about the constitution of the SIT. So some arguments went on yesterday. So we've been informed to stall the further proceedings for till 3rd, that is till tomorrow, the day after tomorrow. In the meantime, yesterday evening we were informed that the Honorable Supreme Court said that you hang on for some time. So in adherence to the Supreme Court order, we have stopped for the time being. So once the order comes, we are very sure that the order will come, because after all, it is a criminal case which we are investigating. So is it against the SIT only, or about the investigation, about the case? We'll have to see once the order comes actually. But in the meantime, we have been informed, so accordingly, we have stopped it for time being.
A sea of red on Dalal Street as geopolitical concerns roil sentiment. Sensex and Nifty post the biggest single-day decline in over 2 months. More than 10 lakh crore rupees in investor wealth wiped out in a single session.
Crude oil prices rise as conflict in West Asia deepens, but gains remain capped by weak global demand outlook. Top brokerages do not expect prices to cross $80 per barrel on Brent.
Steel stocks like Jindal Steel, JSW Steel and Tata Steel buck the overall market trend after Morgan Stanley says China's recent stimulus should drive positive sentiment and support steel prices. Nomura initiates coverage on JSW Steel and JSPL says continued deleveraging to support Indian steel majors. Well, rising geopolitical tensions in West Asia pushed Dalal Street into the red territory today, deep into the red actually. Markets saw a sharp fall after Israel and Iran engaged directly in airstrikes. Markets, of course, are still waiting for Israeli retaliation. Nifty tumbled below the 25,300 mark. Sensex lost nearly 1,800 points. You're with us here on this special broadcast. I'm Prashant. With me, my colleague Rima. Rima, hi.
Hi, Prashant. And let's take a look at what we have for you in store today. We start with the top movers and shakers of the day. Vivek will join in. We'll tell you why Dabur was in focus. The stock ended with a cut of 6%. That's not all. We'll discuss the massive sell-off on Dalal Street, get you the cues for tomorrow's trading session. Harish Krishnan, the co-CIO and head of equity at Aditya Birla Sun Life Mutual Fund, will decode the market sentiment and trends. He'll also be joining in shortly on the show.
No, absolutely. So yeah, I mean, deep in the red. And just a couple of points because the indices will come up on your screen. The starting point, of course, is the fact that we were basically making newer highs. Last week, for example, was incredible. The Nifty, you took out 26,000, then you took out 26,200 in a single day, right? I mean, that seemed a bit stretchy. And then as we came into this session after a midweek holiday, you had a couple of things all coming together. One, of course, is this rise in tensions in the Middle East. It seems a little more, the risk of escalation seems a little higher as compared to previous episodes. We've been tracking the big China rally, and I think it's seemingly undeniable. We'll get the flows picture today as well. But for the last 2 days, FIIs have been big sellers, outsized sellers. And I think, you got to consider the possibility that some of this money actually is going to China. When, longer term, when EM gets money, everybody gets money. But I think the shock rally in China is so large that I think there is some, FOMO out there. So maybe money out of India into China. The start of the second quarter earnings season seems to be a little weak as well. Dabur, for example, was a bit of a shocker. And generally across sectors, most preview notes are in. And people are expecting a very subdued start. Maybe H2 will be different. And of course, you also had the SEBI F&O numbers, the rules which kicked in, the curbs which kicked in. By and large, that didn't do very much. Stocks actually, if you look at BSE or a broker like Angel One, they ended higher. But what does it mean for the market? We'll only sort of know at the margin once these actually go into effect, which is only from the 20th of November. So, I mean, those were 3 or 4 things all coming together as we came in into today's sort of session. The Nifty is down about 1,100 points, I think, from the highs. That's about 3.8%. The Nifty Bank is down about 4.8%. Midcap index is down 3. The small cap index is down about 3.5%. These are all changes from the recent highs. Rima.
Well, the high was just 26,277 that we hit on Friday. So in a span of few days, and this week was a truncated week, we've lost, as Prashant pointed out, about 1,100 points on the Nifty. Sectorally, realty took the biggest knock today. The Nifty Realty Index was down 4.5%, followed by auto. Autos were down 2.8%, and banks continue to remain under pressure for the 4th day in a row. In terms of individual stocks, the rise in crude prices is hurting oil marketing companies. So BPCL was the top loser. Big cut seen in Reliance Industries, L&T. So some of these heavyweights under pressure. And in the banking pack, it's Axis Bank with a 4% cut. Lots to discuss in terms of individual stocks. So let me go across to Vivek now. He's at the big wall with the top movers and shakers of the day. Vivek.
Well, thank you so much. Like you mentioned, the sea of red actually was a bit of a struggle to see stocks that did quite well. But some stocks did stand out and quite a few laggards that we'll see later on. First on the list, of course, BSE as well as Angel, like you pointed out, the overhang going away and the stocks actually saw quite a bit of a sharp recovery from the day's lowest point. The second stock on the radar was Jubilant Ingrevia. From the broader end of the markets, a large Arduin coming in from a global, agri player, and this particular stock ended over 4.5% higher in the session today. The relative pocket of strength in the market today, of course, was the metal pack. Within that, JSW Steel managed to hold its head above water, despite the fact that you actually saw a couple of brokerage upgrades coming in. The stock's still just up 1% or so today. The other stock on the radar was Petronet LNG. Brokerage firm MK went ahead and upgraded the stock. Very sharp rally today, almost 6% higher as far as Petronet was concerned. But now coming to the list of laggards, quite a few laggards. First up, consumer discretionary names. After the very weak quarterly update coming in from Dabur, the entire consumer discretionary pack, look at names like Dabur, GCPL, all of them, Warren Beverages, United Spirits, all of them took quite a bit of a knock today. The other stocks, of course, was the list of stocks that generally tend to decline when crude prices go higher. So all of the OMCs and also, the paint companies, so Asian Paints, Berger Paints, took quite a bit of a knock. Like you mentioned, realty stocks, amongst the top laggards today. All of the realty stocks today, in fact, saw quite a bit of a deep knock. DLF, Godrej Properties amongst the top laggards as far as the F&O space was concerned. And lastly, the BFSI space too, after a while, saw quite a bit of a sharp correction today. So names like HDFC Bank, Axis, Kotak, and even, some of the larger NBFCs, so Shriram Finance, Cholafin, all of them too saw quite a bit of selling pressure. Overall, advanced decline ratios skewed towards the declines in a very large manner.
All right. Well, a lot of red, right, Vivek? Thank you very much for that. Harish Krishnan is with us. He's Co-Chief Investment Officer and Head of Equity at Aditya Birla Sun Life Mutual Fund. Harish, good to have you here. As they say, markets fall, reasons follow. I outlined 4 reasons. But what's the dominating driver right now, to your mind, Harish?
So I think I'll just add to the set of reasons that you put out, which is that over the course of the last 2 quarters now, earnings have actually not gone anywhere. For the broader markets in aggregate, even as markets have continued to climb up despite a poor election result, despite the capital gains tax and poor earnings trend. So I guess it is some amount of normalization is what one is seeing. The second, as you rightly pointed out, is the function of what's happening in China. Year to date now, China outperforms the US, India in a surprising turn of events, right? 2 weeks ago, they were at 52-week lows. Come this week, they are at a massive 52-week high, outperforming almost all other markets. And this was a consensus sell, given various geopolitical measures and going into the US elections. And therefore, I guess some of the flow data that you spoke about, I think a lot of that has also got to do with the fact that there is some amount of serious money that is possibly going now towards China in the wake of a significant short squeeze that we've seen in Chinese market. So I think India is a low beta defensive market in the emerging markets. It typically does well when emerging markets, flounder. it's like the FMCG of the emerging markets, and therefore, when the emerging market rises, I think there is money that potentially moves out from the defensive basket, moving into more aggressive corners of that emerging market, and that's possibly what we are seeing over the course of the last few days.
Harish, on earnings then, you said that the last 2 quarters, the earnings haven't gone anywhere. What should we expect this time in the current quarter? Will we see earnings downgrades? Will the breadth of the earnings be negative this time? Is that going to be a risk factor for our markets?
Yes, it does appear that it's going to be a lot more subdued. I mean, even if you look at, say, high-frequency data, like, say, for example, the GST print that came through, we're talking about growth in single-digit numbers, right? These are nominal high-frequency data. So therefore, from that context where we saw in the whole of FY24, even as we looked at the numbers, while the numbers were very strong, they were coming from broadly 2 pockets. One was the financials, which saw a very strong print, primarily from very low credit costs continuing into FY24 as well. The second was margins moved up significantly, even as sales were tepid. We did see in the last 2 quarters that the margin normalization trade is almost behind us, and therefore now earnings is more tracking sales growth. And therefore, when we see a GST print which is in the 6-7% handle, it doesn't really paint a very strong earnings momentum coming through even into Q2. Having said that, Q2 is generally a bit softer. I think we all know that the big quarter lies ahead, which is the Diwali quarter, which is Q3. And then moving into Q4 where government spending really kicks up. So therefore H2 is typically the heavier quarters, but I would not be surprised if Q2 follows the same trend as what we've seen in Q1, which saw more downgrades than upgrades in totality.
Okay. Harish, to stay on, Nimesh is now waiting by. It's an important day today, so let's find out what the D Street chatter is. Nimesh.
Well, reminder, market ended at day's low. All the indices were down nearly 2%, and this is backed by very aggressive FII selling. In fact, the feedback is the buy-sell ratio is close to 1:3 on the sell side at most institutional desks. Barring metals, every other sector saw selling pressure today, and within that, the large cap saw the large brunt on the back of the FI selling. Having said that, the Nifty is now very close to the crucial support of 25,200 on the downside, so that needs to be seen. And also the PCR is almost at 0.75. Normally, we've seen in a market bounce back when the PCR falls below 0.7, so that needs to be tracked over the next couple of days. But today's sell-off was largely on the back of very aggressive FI selling.
Yeah, no, absolutely. Nimesh, thank you very much for that. Harish, there were many who were just beginning to, over the last fortnight or so, starting to say, well, maybe, this broader market, mid and small cap kind of rally is going to go sideways, and large caps will take the lead. And boom, you got today, and what we've seen over the last couple of days. So how do you look at that, and what should one do? Because the view was that maybe move into safety, move into large caps. Well, the Nifty is down 4% from the recent highs.
Sure. So I would still think that the breadth of the market is narrowing quite significantly. So the number of names that were participating on the upside has definitely come off over the course of the last 3 months or so. More importantly, the nature of the names that were driving the market up has also changed. So I mean, of course, you have data of today, and we don't really read too much into one-day moves or any near-term moves. But I would think that in an environment where earnings is starting to be sluggish, it does pay to be in pockets where there is more visibility of growth, in areas where there is better quality, better capital efficiency ratios. And I would still, an unabashed view that, all small caps or mid caps will do well, possibly may not necessarily hold. So I would say that, the larger companies, of course, I'm not saying that all large cap companies follow that script, but I would think that the larger companies do tend to be the better ones at this point of time, notwithstanding today's move.
And which of the sectors or companies at risk of an earnings downgrade, at least in the current quarter, according to you?
So I think banks is clearly an area where I would think that there can be a potential downgrade in earnings, but we think that would be welcome news. I think earnings are very super more than super normal earnings have come through over the course of the last 6 quarters or so. So I would say that a normalizing of earnings is actually welcome news from a stock perspective. But I would think that this is a quarter where earnings from the financials could be a bit softer. You would also see pockets, for example, in say cement prices or cement as a space that could see some kind of an earnings pressure coming through. Auto is another area where we've seen some amount of discounts, especially in the auto majors. I think that can play a spoil sport from a margin point of view. Of course, we do hear about a reasonable amount of inventory that is kind of moved up in the case of few auto in the case of few auto majors. So that's the other area that we could see some kind of a softness as well. Then you have broadly, we've seen a quarter where commodity prices first decline, and then over the course of the last quarter end, we've seen some kind of a rally. And typically, such volatile commodity prices do tend to take a toll on margins. Of course, Street will invariably tend to overlook that, but I think that again could be some nature of volatility that can come through from that perspective. So I would say, it's not that there are too many pockets where there is growth. It has to be more bottom up. It has to be more company specific, and that is where we think that better managed companies, better quality companies will actually hold the fort over the medium term.
All right, got that. Harish, stay with us. What we'll do is we'll take a quick commercial break here. But as we do that, we'll leave you some more market opinion that we had coming in from BlackRock Investment Institute's Ben Powell. And this is specifically with regards to floors. And we also had Adrian Mowat for some perspective. Listen in, we'll take that break and be back.
I think, look, there's a lot to like in India, as you guys are extremely aware. So the combination of demographic plus productivity gains, digital inclusion, infrastructure, and so forth. I think the big picture in India continues to look very, very favorable. I do think if China is going to follow through on its stimulus promises, which we may see as soon as next week, it's quite likely that some of the money that global investors have put to work outside of China, be that in other emerging markets or other parts of Asia, probably gets pulled back into China.
We're seeing markets selling off after what has actually been a pretty decent September. Now within emerging markets, as the gentleman from BlackRock then was indicating, we have got this rotation story where Chinese markets have stood on their tails and are moving up so rapidly that active fund managers who've been underweight China, overweight India, need to address that position. The story with geopolitical events is there a short-term impact on markets. Now, what you've then got to caveat that statement and look at more recent events, such as Russia's invasion of Ukraine, that caused quite a significant energy shock, particularly in the European community, where the price of gas went up dramatically, which hit the price of electricity. And then you had a fundamental impact which needed to be priced in. I think the issue with crude oil is that it's a very fungible asset, an easily moved asset. It's not like gas, which requires pipes, degasification if you're using LNG. So I think you probably might see a temporary spike in the oil price as the fundamental factor here, even if this is to escalate a bit further.
The regulations are out. As we said, they were likely to come out today or tomorrow, and they're finally out. And I have to say, they're largely in line with expectations. So in July, SEBI had proposed 7 things. 6 out of the 7 actually have been implemented with very minor changes. So I'll start with what is going to be top of mind Number one, higher lot size value. This is going to be effective from the 20th of November. Basically, for index derivatives, which is Nifty, Bank Nifty, and other index derivatives, at the time of introduction, the SEBI is saying that the
Welcome back. You're watching our special broadcast market sell-off, and one stock in particular which was under pressure today was Dabur on the back of its Q2 business update. The company is talking about negative revenue growth in Q2. Mangalam joins in for more. Mangalam.
Well, the street was coming to terms with this second quarter update, largely because prior to this, all the communication, the management had guided for double-digit revenue growth in this financial year. Come the second quarter, because of heavy rains and flooding in parts of the country, there was impact on out-of-home consumption, but more importantly, there was a lot of inventory stockpiling in general trade channel because of the fast growth that the company has seen in its quick commerce and e-commerce channels. So to that extent, they are looking to rationalize that, and as a result of which, primary sales in the second quarter would be lower, and that means a double-digit, mid-single-digit revenue decline. At the same time, margins coming back to mid-teens to high teens as against their own guidance of close to around 20% as well. Though the company says that this is temporary and come October, they are expecting demand to pick up. This lost quarter is something that the street is rationalizing for, as a result of which the stock was lower by 6%. No major change in underlying demand conditions, however.
Got that. Mangalam, thank you very much for that. Harish, I was just looking at what is given up gains, right? The most, and I'm just looking at the Nifty here. Reliance is down about 8%, but it's a lot of auto. Tata Motors, Bajaj Auto, Maruti, they're all down between 7 and 8% from the recent Nifty high. L&T is down about 6%. You look at the banks, Axis, HDFC Bank, ICICI Bank, anything between 5.5% to 8% lower from the recent highs. If you had to sort of, put 2 or 3 names on the watch list that you'd look to sort of accumulate at lower levels, which ones would those be?
Prashant, we can't speak on stocks, but let me give you some perspective on how we think about sectors. Right, so we think that there are 3 dark horse sectors out here from a 2-3 year point of view that we want to further add on to our positions. First is consumer durables. That's a space that we think has done quite well, but we think that there is more margin pickup story out there as a segment as a whole. Second is metals. I think we've come to a zone wherein the metal stocks have delivered quite well. The balance sheets are in very good shape. And of course, there is the Chinese stimulus angle, but even otherwise, I think that metal stocks are something where ownership levels are very low, and we would want to add on to that. The third is cement. This is a space where near-term earnings can look potentially disastrous, but this is a space where there is massive amount of consolidation happening. Again, a space where ownership levels are low, and that is something that we want to pick up into. On the sectors which were in momentum or which are in momentum and which can continue and where we want to add on and buy on dips, I would say IT would be high up on that list. We also think pharma is an area where we want to add on dips. Third would be capital goods. Fourth would be auto, and real estate selectively we would be looking at buying on dips. So these are the broad sectoral, sectors, kind of a footprint that we would want to buy on dips into this fall in anticipation of creating greater value to our unit holders.
Harish, thank you very much for your insights. It's been a tough day today. Thank you for joining us. Before we wrap up on the show, we'll get you the key market events to watch out for. Abhishek is here.
Well, Rima, to begin with, tomorrow HSBC composite PMI will come out. It was at 60.7% last time around. HSBC services PMI will come out. It is estimated to come at 58.9% versus 60.9% that it had come out last time around. Watch out for RBI data with respect to business momentum of banks. So deposit growth number will come out. Remember that last time it was at 11.1%. Credit growth number will come out. It was at 13.3% YOY last time around. And RBI will give out the forex forex data as well. So 692.3 billion was the forex reserve with India last time around. In terms of USA, non-farm payrolls will come out. It is estimated at 1,40,000 versus 1,42,000 last time around. And unemployment rate will also come out. It is estimated to be at 4.2% versus 4.2% that they had reported last time. In terms of ex-dividend, Axelia Solutions final dividend of rupees 40 will be in tomorrow. Stock split, Godavari Power and Ispat, it will be a split of from rupees 5 to rupee 1, and Real Eco Energy from rupees 10 to rupees 2. In terms of bonus issue, Classic Electricals bonus issue is of 5:1, and Shikhar Leasing and Trading, which will have a bonus issue of 3:1. Back to you.
Abhishek, thank you very much for that. So lots to track when we come back tomorrow. It's a wrap on this edition of the special broadcast. Stay tuned. There is more news and updates coming up on the other side of a quick commercial break.
Would be between 15 and 20 lakhs at the time of introduction. At least 15 and up to 20. That is number one. This is a simple and clean measure to limit the number of people who are able to trade this, trade index derivatives. Number two, and I think a lot of interest around this, only one weekly option contract per exchange. This is also effective from the 20th of November. Remember, right now, NSE has weekly option contracts on the Nifty, the Bank Nifty, the Midcap Index, and the Fin Nifty as well. BSE right now offers weekly contracts on the Sensex and the BankX. NSE now will have to choose one. They'll have to drop three, only one, and that too a benchmark contract. So most likely they'll have to decide whether to keep a Nifty weekly option contract or a Bank Nifty weekly option contract. Similarly, the BSE will have to choose between the Sensex and the BankX. The benchmark is the Sensex, so most likely BSE will offer the Sensex weekly option contract. So I think this is the one which I think is going to dominate headlines and market participants, most impacted exchanges, brokers, everybody most impacted from this one. Number three, intraday positioning, monitoring of position limits. This is effective from the 1st of April 2025. Currently, position limits are monitored on an end-of-day basis. Now, this is to be done on an intraday basis. Remember, the limit which was set, I think in 2020 during COVID period, was 500 crores based on notional value of trades. So this was monitored, but at the end of the day, now they're saying it has to be done on an intraday basis. Lots of feedback in terms of how this is going to be finally implemented. There is time, as I said, only effective from the 1st of April 25. Number four, increase in tail risk coverage on the day of options expiry, effective November 20th. Basically, if you are carrying a position or if you take a position on the day of expiry, all existing positions on the day of expiry, old and new, will attract an extra ELM, which is extreme loss margin of 2%. So this is number four. Number five and number six are pretty straightforward. Number five is upfront option premium, effective 1st of February 2025. And number six, removing the expiry day calendar spread benefit, which is also going to be effective from the 1st of February. So I think these are the six changes which SEBI has implemented, largely in line with expectations. But I think the lot size increase and the fact that SEBI is limiting weekly options contracts to one per exchange will attract maximum amount of discussion and debate in terms of what this does for market volumes, exchange volumes, and what this does to market intermediaries as well. Back to you.
Right, Prashant, very quickly before I let you go, a lot of comments coming in, a lot of questions and queries coming in from the viewers as well on our social media handles asking about the impact and the implications. Just in the near term, from a market perspective, you've probably been speaking with experts. What's the impact likely to be on the markets when we open tomorrow?
Shireen, so through the course of the day, we spoke with lots of market participants. Markets are prepared for this. I mean, we put out the story in the morning that this is to be expected very soon, that this is imminent. There was some expectation in some quarters, and we had clarified yesterday as well that this was not to come up along with the board meeting. And we said that, well, this is going to come soon this morning. So I think this is widely advertised. And the fact that what has been done is largely in line, actually mostly in line with what was proposed in July, I think does not come as a shock or a surprise. And also the important point is this is being done in a phased manner. It's not as if everything is being implemented by the end of the month or from a certain date. I mean, there's November 20th, there is April 1st, there is February 1st, all the way into 2025. I think that also kind of eases the impact a little bit.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the team. Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. It's a sea of red on the Lal Street as geopolitical concerns roil sentiment. The Sensex and the Nifty post the biggest single-day decline in over 2 months. More than 10 lakh crore rupees of investor wealth is wiped out today. West Asia is on the boil after Israel and Iran engaged directly in airstrikes. At least 6 killed in Israeli airstrikes on central Beirut Medical Center. Tel Aviv says 8 soldiers were killed in 2 separate Hezbollah attacks. Crude oil prices rise as the conflict in West Asia deepens, but the gains remain capped by weak global demand. Top brokerages do not expect prices to cross $80 a barrel. Brokerages expect F&O volumes to shrink gradually after SEBI tightens the rules to curb the frenzy. NSE is likely to be hit harder than the BSE in the near term, but brokerages believe a key overhang is now behind and long-term growth potential remains intact. The Supreme Court allows real estate companies to claim input tax credit for construction of commercial buildings and those specifically built for leasing purposes. Industry seeks clarity on whether similar relief can be replicated for ports, airports, warehouses and data centers. OpenAI raises $6.6 billion from a clutch of investors including Microsoft, Nvidia, SoftBank and Thrive Capital. The company is valued at $157 billion. Google flexes its AI muscle in India. The Gemini chatbot goes live in Hindi and 8 other Indian languages, also launches gold loans and personal loans on the Google Pay app in partnership with Aditya Birla Finance and Muthoot Finance. Supreme Court restrains police action at Sadhguru's Isha Foundation. Apex Court transfers the case from the Madras High Court to itself. The parents of 2 women claim that they're being forcibly held at the foundation, but the women in question reject the allegation. All of that and more coming up, but first up, the market action. It's a sea of red on the Lal Street today as geopolitical concerns roil sentiment. So the Nifty and the Sensex posted the biggest single-day decline that we've seen in 2 months, closing over 2% lower. The Sensex down 1,769 points. The Nifty lost over 500 points today. Midcaps also taking a knock. 1,300 points gone on the Nifty Midcap, and the Nifty Bank lost about 2% today. Broader markets, as we showed you, also falling in line with the blue chips. 10 lakh crore rupees of investor wealth was wiped out in today's trading session. Prashant is standing by now to wrap up the market action for us. Prashant, selling pressure coming in today, but what's the market opinion on whether we are expecting a bounce back from these levels?
Shireen, markets are oversold by looking at simple indicators in the very near term. I think, RSI, etc., for example, is at about 16 or so. So it does look like it's getting a bit overdone in the very near term. But let me just tell you what's happened, right? There's a confluence of events which have come together in today's session. And I'll just quickly run you through all of them. The first one hit global markets on Wednesday, but we were saved yesterday since we were closed on the account of 2nd of October holiday. I'm talking about Iran, Israel. Global markets have... while global markets in the past over the last 2-3 years have rallied on despite conflicts around the world like Russia, Ukraine and episodic flare-ups in the Middle East, many are wondering if this will see a bigger impact now. Second, perhaps, is a short-term phenomenon, and this is the shock China rally driving almost FOMO-led inflows into that market and perhaps being funded by big outperformers like India. So money out of India, at least in the very near term, markets like India into, what is going up and up, that is China. Number 3, we're also looking at the second quarter corporate earnings season perhaps being a little subdued. Remember, Q1 was also weak, but it was explained away by companies and analysts alike by saying, well, there were elections, there were heat waves, etc., etc. Remember, we just got the pre-quarterly update from Dabur, and it was a bit of a shock surprise on the negative side. Lastly, SEBI's F&O curbs, which were
while widely anticipated and advertised, and they were in line with what was proposed in the month of July, they're ultimately at the margin, and markets move on incremental news flow, positive or negative. They are going to be negative for market volumes down the line when they come into effect. So just to summarize what we've done on the markets from the highs, from the recent highs, and the highs are different for the Nifty, Bank Nifty, mid and small cap indices in terms of dates, but from the highs, the Nifty is down about 4%, the Bank Nifty is down almost 5%, the mid cap index is down about 3%, and the small cap index is down about 3.5% as well. I also looked at banks and non-banks in the Nifty and how they've done from their respective highs. These are the top losers. Axis is down 8%, HDFC Bank is down 5.5%, and ICICI Bank is down 5.5%. Remember, bank stocks, according to many, were just starting their move higher, and well, this is what's happened. Non-banks in the Nifty, top loser from the highs is Reliance, which has lost almost about 8%. And then you've got these auto names, Tata Motors, Bajaj, Maruti, which have lost between 6 and 7%. There is also a L&T, which is down about 6% or so. Small caps, and what they've done from their recent peak. So small cap index made a peak before the Nifty or the Bank Nifty did. Sterling Wilson Solar, top loser there, 20% cut. Tita got down 18%, Data Patterns and Raymond, some of the other stocks. So you just get a sense of, the damage which we've seen. Names like Zensar, Tejas Network and Natco are some of the others. So anything between 13 and 20% so far, depending on what happens next. I just want to wrap this up with some of the very, very near-term triggers, right? And this may determine what happens from here. Geopolitics is one, of course. That is actually number one. That will be the dominant driver. Israeli retaliation, especially, one of the main channels through which these conflicts impact markets is through energy markets. And there are reports which suggest that, well, there could be strikes on Iranian oil facilities. If that happens, there could be a flare-up in oil prices. US data tomorrow will be important. We get the non-farm payrolls number, the jobs data, monthly one, right before markets open tomorrow. And that will give us a sense, weak or strong, whether the Fed is actually ahead of the curve or behind the curve. Remember, they cut 50 basis points last. With respect to China, what's gotten markets really excited is fiscal measures, right? But it's still in the realm of news reports, and this will happen, that will happen. We don't have official confirmation. And I think it'll be key to watch when China comes back from holidays, whether they actually walk the talk. And lastly, we kick off the festive season with Navratri, and demand trends will be very, very keenly watched. As I said earlier, Q2 is expected to be weak, and markets are looking ahead at H2 of FY25 for earnings to start to pick up. So some things in the very near term which perhaps determine where we go from here. Back to you.
All right, Prashant, many thanks for joining us. As Prashant was pointing out, a confluence of events weighing on our markets. But as Prashant was also pointing out, stock markets in China are shut till the 7th of October for National Day celebration. Stocks in Shanghai posted the best rally in 16 years on Monday. Before that, holiday shares in Hong Kong also rallied in tandem with mainland China earlier this week. But that rally cooled off today with the Hang Seng losing 1%, snapping a 6-day winning streak. But Japan's Nikkei gained in trade. Stock markets in South Korea are shot today, so it is that shock rally in China that's taken people by surprise. And speaking of China, Ben Powell, the chief investment strategist at BlackRock, believes global investors will look to move their money from other emerging markets into China. However, he also adds that India's long-term outlook continues to look good. Take a look.
I think, look, there's a lot to like in India, as you guys are extremely aware. So the combination of demographic plus productivity gains, digital inclusion, infrastructure, and so forth. I think the big picture in India continues to look very, very favorable. I do think if China is going to follow through on its stimulus promises, which we may see as soon as next week, it's quite likely that some of the money that global investors have put to work outside of China, be that in other emerging markets or other parts of Asia, probably gets pulled back into China.
Well, that's the markets, but let's talk about the big global story. West Asia continues to be on the boil as tensions between Iran and Israel escalate. At least 6 people have been killed in Israeli airstrikes on a central Beirut medical center that's affiliated to the Hezbollah. Residents of the Lebanese capital heard several explosions across the city. Meanwhile, Israeli Defense Forces said 8 soldiers were killed in clashes with Hezbollah. It's been more than 36 hours since Iran fired 180 missiles at Israel in response to the killing of Hezbollah leader Hassan Nasrallah. Israel's Prime Minister
Minister Netanyahu warned that Iran would pay for it and he would choose the right time to respond. Israel's ally, US President Joe Biden, has said he will not support any attack by Israel on Iranian nuclear sites. However, he added that G7 nations agree that Israel has the right to respond.
איראן עשתה הערב טעות גדולה, והיא תשלם על כך.
Iran made a big mistake tonight, and it will pay for it. The regime in Iran does not understand our determination to defend ourselves and our determination to defend against our enemies.
וכנראה יש בטהרן אלה שלא מבינים זאת.
The security of the region is the security of all Muslims, and we do not want any war or bloodshed. We were left with no choice but to respond. If Israel decides to retaliate, then it will face harsher reactions.
Iran has gone way out of, it's way off course. We're going to put together a joint statement. Hasn't been done yet. It'll be done before too long, probably by the time we land. And there's going to be some sanctions imposed on Iran. We'll be discussing with the Israelis what they're going to do, but all 7 of us agree that they have a right to respond, but they should respond in proportion.
And staying with tensions in West Asia, at least 51 people have died in southern Gaza after Israeli airstrikes and a ground operation targeting the Khan Yunis area. According to Gaza's Hamas-run health ministry, tanks reportedly advanced into some parts of the city and its surrounding area, with residents reporting gunfire and heavy shelling. Separately, the Israel Defense Forces said that they had struck Hamas targets located in 4 schools sheltering displaced people in central and northern Gaza. From one conflict to another, Ukraine has said that Russia launched a major drone attack on 15 regions in the country overnight. The Ukrainian Air Force said it had shot down 78 out of 105 Russian drones during the assault. Meanwhile, authorities in Kyiv said that the Air Force had downed around 15 drones in the city and its surrounding areas during an air alert that lasted more than 5 hours. This comes after Russia took full control of a strategic hilltop town in eastern Ukraine. Well, here's the action in the oil market. Oil prices soaring over 5% as the crisis in the Middle East deepens. However, the gains have remained capped due to weak global demand. Brent is currently hovering around the $75 per barrel mark as investors weigh the escalating conflict in the Middle East. Brokerages, though, expect prices to stay below the $80 mark in 2025. Goldman Sachs predicts $77 a barrel. Citi's forecast is the lowest at $60 a barrel. At least 45 container ships have queued up outside major U.S. ports as the biggest dock workers strike in nearly half a century entered day 3. 45,000 port workers from Maine to Texas have started picketing after talks for a new 6-year contract with the U.S. Maritime Alliance employer group broke down. These workers are affiliated to the International Longshoremen's Association. The 14 affected ports handle almost 55% of the container traffic moving in and out of the U.S. A report by Moody's Analytics has said that Indian exports, which rely heavily on these ports, will also be impacted by the strikes. Now back home, shares of the Bombay Stock Exchange surged in trade after SEBI announced measures to tame speculative trading in the F&O market. Brokerages expect NSE's options premiums to be hit harder by these norms than the BSE in the near term. They also expect a gradual shrinkage in F&O volumes. However, they do believe that a key overhang is now behind and long-term growth potential remains intact. Tata Electronics has resumed some operations at its plant in Tamil Nadu, which produces components for Apple iPhones after a fire broke out in the facility last week. The company said that all employees will continue to receive full payment after resuming work. Tata Electronics has received approval from the Director of Industries to resume operations at the fire-impacted plant. Now, the Income Tax Department has secured a major victory in the Supreme Court. The top court has upheld the tax department's power to issue reassessment notices from April 2021 under the old tax regime. Ashmit is here to give us a background to this case and explain the significance. Ashmit, many thanks. A big leg up for the Revenue Department.
Well, big leg up for the tax department, and clearly clarity coming in for as many as 90,000 reassessment cases. Bear in mind, this reassessment was for the period of between 2013-14 and 2017-18. Now, within this period, now it's important to understand that under the Income Tax Department, reassessments cannot be done for an indefinite period of time. There is a time bar that is geared into the Income Tax Act. During the COVID pandemic, the deadline, the issue that arose, and this was something that was flagged by the government, they came out with the legislation that provided for an extension of this deadline for reassessments that were falling within that COVID pandemic. This was defined, the deadline was extended till 30th of June 2021. The problem arose when through Finance Act of 2021, there was a revamped version of this reassessment scheme, which became effective as of 1st of April 2021, and thereby raising the confusion and the chaos as to what happens to reassessment notices issued between 1st of April 2021 and 30th of June 2021. There were 90,000 of them. The question that arose is that, do those reassessments have to be done under the old regime or the new regime? The tax department had issued those 90,000 notices under the old regime. That has been answered in favor of the tax department. The apex court has held that mere enactment of a new regime, which is the Finance Act of 2021, does not bar the tax department's hand from going ahead and issuing those reassessment notices under the prior regime. This, of course, is subject to a huge number of safeguards and caveats that the apex court has added. But what it effectively does is that the old regime is still kosher, is still good for reassessment notices that were issued after 1st of April 2021.
Well, Ashmit, it's also been a busy day for you in court, from ordering a reprieve for the Isha Foundation to slamming states over stubble burning. Take us through the other big developments at the apex court today.
Well, here's a quick wrap at three major cases. Number one, the Isha Foundation. As far as the Isha Foundation case is concerned, Isha Foundation Ashram in Coimbatore was subject to a police investigation. There were 150 police personnel that visited the ashram compound. Now, this is something that was falling out of the Madras High Court interim verdict, interim order, whereby the Madras High Court had taken note of a parent's complaint alleging that their children were brainwashed and were kept inside the ashram. Today, this hearing moved towards the apex court. The monks appeared virtually before the apex court. Chief Justice Chandrachud had a private hearing with the monks in question, and then finally concluded that they appear to be staying at the ashram of their own volition. And with that in mind, the apex court has stayed the Madras High Court order, has transferred the proceedings to itself, and said that there is no further coercive action that will be done by the police agencies. That's one. Second, as far as the Delhi air pollution matter is concerned, bear in mind, we are on the cusp of the winter season, and this is the time the conversation comes up on stubble burning. This conversation has already begun in the apex court. The Supreme Court is not happy. Justice Oak today made strong observations about the conduct of Punjab and Haryana government, saying that they're clearly not doing enough to check stubble burning. There are no penalties in place. Also hitting out at the CAQ and the management panel, which in fact the apex court criticized for not doing enough, not even holding enough meetings to consider solutions to that. So that is something that the apex court is seeking answers on from all stakeholders. That's the Delhi, Punjab, Haryana government, as well as the CAQM. And finally, on the issue of caste discrimination in jails, there was a PIL that had been filed before the apex court. The Supreme Court took note of that and has taken very strong objection, passed a detailed order saying that this caste discrimination that is done within jails, which is allocation of work and allocation of barracks depending on what your caste is something that is a colonial hangover, is not permissible under the Indian constitutional framework, needs to be set aside, and thereby directions being given to the centre as well as to all states and union territories to revamp the prison manuals to accommodate for those caste discriminations, to do away with that at an institutional level.
All right, Ashmit, appreciate you joining us. So the big developments in court today. We will head into a break, but up next, Google flexes its AI muscle in India. The Gemini chatbot goes live in Hindi and 8 other languages. That and more when we return. And influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and CNBCTV18.com.
First of all, I mean, we are seeing very strong momentum in the market, and clearly this is on the back of some very good rainfall. Of the 36 agri-climatic zones that we have in the country, 33 zones have got either normal or above normal rainfall. And even in terms of, if you see the state stratification, for only the states of Bihar and Punjab do we see little bit deficiency in the rainfall, but broadly all the agri states also have very good rainfall. In terms of revising the guidance, no, we will still maintain at 5% level because we want to see through the festive season and then maybe take a call at the end of Diwali. That would be our view. But most of the heavy lifting will happen in H2 of this year, and that would give us an overall 5% growth rate. September has been a slow month for us in exports, and there are two factors to it. One is that in our neighboring countries, there are some geopolitical challenges being played. These are all very big markets for brand Mahindra and Swaraj. And even in the US market, we are seeing that 11 quarters of continuous degrowth in US tractor industry. Now that is, we know the factors, that is on back of very high interest rate cycle, and people were waiting for Fed to start cutting. And now that has happened, I think the transmission will take 3-4 months time. And even in our US, which is our second largest market after India, the sentiment will revive. So that will again give us growth getting into our Q4. But I think for next 3-4 months, the exports might be a little slow.
CNBC TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC TV18 India's #1 business news brand. Foreseeing change, growth, and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future.
In what comes as relief for real estate players, the Supreme Court has allowed them to avail input tax credit on construction costs for commercial buildings. Now, this order allows players to claim the input tax credit retrospectively. We hear that industry is seeking similar relief for ports, airports, factories, warehouses and other sectors. Timsy joins us now to take us through the impact of the latest Supreme Court decision. Timsy.
Well, that's right. Fostering greater investment in the commercial real estate sector, a big GST relief has come in for this particular segment, especially which has players such as DLF, Max Estates, Bharti Realty and many others. Supreme Court today has allowed real estate players to avail input tax credit on construction cost of commercial buildings and buildings specifically created for leasing activity. Buildings can now, after this ruling, be considered as plant and machinery, thus giving a benefit of input tax credit. We are also understanding from experts that the input tax credit can now be claimed retrospectively on all these activities and on these buildings. Meanwhile, industry, however, is seeking clarity from the government that whether similar relief should be replicated for sectors such as ports, airports, factories, warehousing, data center, etc., which could be a bigger benefit for the industry. Also, it is understood that now the rental costs will get reduced for tenants as ITC will be available, thus reducing the financial burden. Just to remind our viewers, till now input tax credit was not available on these rentals or on construction of commercial buildings as it was considered immovable property. Leasing income attracts 18% GST, and Supreme Court relief came in a matter of safari retreats versus Revenue Department. However, the constitutional challenge has been dismissed by the Supreme Court in favor of the Revenue Department. Let's see what are the implications.
Timsy, many thanks. Now, Google has announced a slew of new updates at its 10th edition of its Google for India event in the capital. The company laid out its long-term plan for India and focused on boosting its artificial intelligence roadmap. Shivani joins us now with the key highlights. Shivani.
Well, at the Google for India flagship event, several major announcements were made. Google launched Gemini Live in Hindi and 8 other Indian languages, enhancing AI accessibility across the country. Personal loans will now be available on Google Pay through a partnership with Aditya Birla Finance, along with gold-backed loans via Muthoot Finance. Another significant announcement that was made was in the healthcare segment, where Google has said that over 600 million Ayushman Bharat health account holders will now be able to access their digital health cards on Google Wallet starting next year. Google has also highlighted its success in preventing scams worth rupees 13,000 crores and unveiled plans to pilot enhanced fraud protection within Google Play Protect, furthering its digital and clean energy commitments. Google announced the opening of Google Safety Engineering Center in India by 2025. Additionally, Google Cloud introduced the Gemini Agent framework to empower Indian businesses. Lastly, but not the least, Google confirmed partnerships to add 186 megawatts of clean energy to India's grid by 2026 through collaborations with the Adani Group as well as CleanMax. Back to you.
Okay, Shivani, many thanks. Now, the much-awaited Hyundai India IPO set to be launched on the 14th of October. It's started to be India's biggest IPO ever. So, 14th of October is the D-date. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV18. Do stay tuned. We're back in a moment after this very short break.
CNBC TV18, your trusted partner and investment ally.
We like to stick to the fundamentals, and we won't draw first blood. But I mean, if there is a gunfight, we'll not go to it with a knife. So, one does end up participating. But having said all that, it just serves to advance the customer, the sales. But the customer expects it because that is the whole atmosphere during the festive. One participates in it. But once the dust settles down, it's back to good product, proposition, and customer care.
Let me address that constituency that you just spoke of, which is, of course, one of the most crucial constituencies, which is the regulator. And I think that is the big overhang today as far as the Kotak Mahindra Bank story is concerned, with the RBI imposing restrictions on account of deficiencies in the digital and IT infrastructure, not allowing you to onboard mobile as well as digital customers, as well as putting restrictions on your credit card business. Now, if you can share with us details on what you've been specifically able to do to demonstrate to the Reserve Bank that you are adequately or appropriately addressing those deficiencies, and where do you believe that you stand? I mean, there is, of course, an external audit that's also been sought, but where do you believe you stand in the remedial measures?
So, Shirin, first things to start, where we started with is, look, India has the best digital public infrastructure compared to any other place in the world. I've worked in every other place in the world. I've never seen anything like this, right? Now, obviously, that has led to the demand for digital services having gone up dramatically. And it's about the bank systems having to keep up pace with that. So, we've been spending the last couple of months really focused on how we grow and make our systems foolproof. And like in every crisis, there's an opportunity. So, we've taken this as an opportunity to really say how we'll really leapfrog and make our systems really resilient and relevant for the days to come. So I think we've made very, very good progress. Obviously, we've been in continuous touch with the RBI, sometimes even every week, updating them, getting their guidance, making sure we're on the right path. And I think we've made tremendous amounts of progress, and we'll continue to do it. Obviously, the RBI is exceedingly important. But the customer, I've got to get it right by the customer.
Yeah.
I got to stay resilient for the customer. I need the best customer experience for the customer. And, RBI has told me, you got to do it. So
TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
The Iran-Israel flare-up may be shocking the world for now, but a far more sustained impact on the global economy will be the stimulus blitz announced by China's government and central bank recently. The PBOC, the People's Bank of China, announced a 20 basis point repo rate cut, but more importantly, a 50 basis point cut in reserve requirements. Now, this 50 basis of RRR cut basically gives the banks more cash, which the government intends will be used to buy government bonds. And the government is going to issue a lot more bonds. 2 trillion yuan of special sovereign bonds. This cash raised will partly be given to families who have more than one child and partly to local governments to lighten their debt and help them stimulate their economies. So is this time different? Will this stimulus work and trigger a faster growth, pull China out of its, 4-year slowdown? What are the implications for the world suffering from an onslaught of cheap products from China? I have with me economists from the 3 top global rating agencies. I have Louis Quees from S&P Global Ratings, Harry Murphy-Cruz from Moody's, and Jeremy Zook from Fitch Ratings. Gentlemen, thank you very much for joining me. Thank you so much for your time. Louis, if I may start with you, the China stimulus this time seems to be encouraging consumption. Are you on the verge of increasing your GDP forecast for the country? Do you think this one works?
Well, good question, Lata. We actually just published an outlook the morning before some of the announcements by the PBOC and other regulators came out. We are a little hesitant to make a big change to the outlook for the simple reason that, yes, we've had some monetary easing. Unfortunately, at the moment, monetary easing probably won't make a big dent in the economy. We're waiting for the fiscal side. And there are rumors that that is going to come, but we haven't had an announcement. So for now, we are, encouraged by what's happening. We see the authorities care about growth, which is a good sign. We are reluctant to already start to change our growth outlook.
No, I agree with you. What even I was speaking about distributing money to families seems to be sourced information. But if that indeed were to come, Louis, if we were to see, income transfers to families, as well as, some trade-ins for those who want to, those who are stuck with houses, do you think that will make you change your mind?
Well, I think, a meaningful fiscal easing, and hopefully also with some of those measures, that will make people feel more comfortable about spending, people feel more comfortable about, their access to health and education, so that they will reduce their saving rate. And I think these kind of measures would really help improve confidence and probably shore up growth.
Well, let me come to you, Harry. What's your sense? 2 questions, actually. Will this help China? I mean, will it propel it to even 20 basis, 30 basis faster rate of growth? And more importantly, will that mean that China will stop being such a disinflationary force? Will it consume more steel and iron and thereby push up global prices a bit?
Well, what we're most encouraged by is exactly what you're talking about, with a focus on the consumption side of the economy. If we look at stimulus in the past, so often it's looked at infrastructure, it's looked at big building, it's looked to kind of manufacture growth in tough times, whereas the reports that we're seeing on the fiscal side of the stimulus this time is very much trying to address the problems that are in China's economy. And at the heart of that is a household sector that isn't confident enough to spend. It's not confident in the future of the economy. And so righting that is going to be incredibly important. I think the supports that we saw last week, and certainly, the official announcements are what we're going to need to see before we really pull the trigger and start lifting our growth expectations. But from what we've seen, if we do see that fully implemented and implemented in the right ways of targeting household consumption and trying to, boost that consumer confidence, then we expect it to add around 0.2 percentage points to growth this year. So for us, that would push it to that around 5% growth target that officials have set. But also given that this spending is coming so late in the piece, and also that really I think it's a flag that there's more supports to come, well, that suggests that next year is probably going to look a little bit better as well.
Okay, well, same question to you, Jeremy. Would you agree that at least the outlook looks like China's on the right path, or are you still not convinced?
Well, I think with the latest announcements that we saw last week, we are seeing maybe a bit more of an effort to coordinate monetary and fiscal policy. And so this is quite an important signal, I think, in the authorities' willingness to try to tackle some of these issues when it comes to flagging domestic demand in the Chinese economy. Now, I think, the monetary measures that we saw last week, the big announcements there, again, we think those only have a relatively modest impact on the growth outlook. When it comes to demand for credit, it's really about the demand side rather than the price of credit. And so monetary policy at this point is somewhat limited in its scope. So the fiscal announcements that we have yet to see, I think, will be very important for our expectations of where growth will go this year and next. Already this year we've seen fiscal support running below our the expectations that came out of the budget in March. So we'll also have to assess whether the new fiscal stimulus is kind of filling in that potential gap. Or if this is kind of new fiscal stimulus, and again, how this is targeted, if it is targeted.
Okay. So basically, Jeremy, you're not convinced both about the quantity of stimulus, and also you're not convinced whether it is for income transfers and consumption. You would wait to see. Is that your thesis, much like Lewis?
Yeah, I think we have to wait on the details of the fiscal stimulus, because that is what will be most important.
Fair point. Lewis, the bigger problem that the world is grappling with China, before I come to the internals of China, is this huge disinflation that China is engendering. Because until now, they were, as all of you have said, they've been investing more in investment, in production. And since there's not enough people inside China consuming them, they've dumped it on the world. You have Indian steel companies complaining that the steel from China is $50 lower than their own production cost. Do you think this disinflation will somewhat recede because the government appears this time not to be concentrating on production?
Yeah, I think there are, of course, China exports a lot of things to a lot of countries, right? And I think there is a structural issue, and that is that, I'm sorry to say, the Chinese manufacturing sector is very competitive, and so they're able to crank out stuff at pretty low prices. Now, of course, that has been amplified by cyclical problems, cyclical issues, and the real estate downturn is the biggest one of them, of course. So if the Chinese government is able to turn the local housing market around, that would really change the dynamics on the steel market, its own steel market, and that would dampen a bit that pressure that you have from those steel companies. But I think the competitiveness of Chinese products globally won't go away, even when we have a pretty meaningful resumption of growth in China.
Okay, your thoughts, Harry? Do you expect that disinflation is going to remain as bad? Solar panels, EVs, steel, furniture, toys, will they continue to face anti-dumping duties from across the world?
That's certainly the global trend at the moment. We've seen that in the US, we've seen that through EU, we've seen that most recently in Canada and also parts of Latin America as it relates to steel. Now, those price